Thank you for the opportunity to be here to Dave and ValueCharts and Metastock. Uh, I don't know if what I'm about to show you is going to be the best way to determine where a market will close. I'm not that conceited that I would claim that, but I'll show you how I determine where a market would close. My original title for this presentation was a simple way to determine where a market will close, and I'm definitely going to show you that. That's what I'll be leading with this morning. But I've got a little bit more time than I thought I would have, so I'm going to go ahead and show you a little bit more detail on my 5 factors, and it's really the concept of model that I use that I think you'll find most helpful. So let me switch over my screen here. And you should be seeing my first slide. If I need to adjust my mic by chance, Dave or anyone speak up and let me know. Happy to do that. Hopefully you can hear me okay. Great, thank you. The obligatory disclaimer, right, that I need to share, but a couple points. I've personally created all this research. That doesn't mean it's guaranteed to be right, but I believe it to be right, and it's also information that I use every single day. So there's nothing I created just to make a good presentation or anything like that. I'm going to share some great data with you that I've spent a better part of a couple of years working on creating. So I'm really excited about that. But as always, there's nothing that works all the time. I wish what I was about to show you worked all the time. There's just nothing that does that. I'm a big believer, however, that the best way to predict where a market will close, or best way to predict anything a market may do, is to study history, right? So like studying the history of mankind, right? Ultimately, much of life is determined by human emotions of either fear or greed. And it's that conflict that creates repeatable patterns in life and certainly within the markets. So what I do is I like to try to stack historical odds in my favor. When I recognize that they're stacked in my favor, I like to take action. And that's the gist of everything I do as a trader. I am not one of those guru chart readers like Dave or many others probably are. That's just not my style. It doesn't work for me. And I found using the power of actual data of what's happened in the past under similar market conditions is incredibly inspiring and helpful. So hopefully you'll find the same. I'm not real salesy. I'm not going to be selling anything or asking you to sign up for anything at the end. I will show you where you can get access to my free daily research. It truly is free and will always be free, so no bait and switch or anything like that. In fact, if you want to download these slides to take notes, because I'm going to share a lot of research that will wear your hand out if you try to copy it, you can go to closingodds.com/free. Probably should have had that prepared to post somewhere, Dave. Actually, see if I can put it in the chat there. Closingodds.com/free will take you straight to the sign up page. And then you'll get a daily email at the top of that daily email. It may not come till tonight, by the way, or Sunday night or Monday night. At the top of that email will be the link to download the slides. So actually, I'm not sure you can get the slides right now. Apologies for that. All right, for the purposes of this presentation, when I talk about the close, I'm talking about the last trade, the last price print that shows up during the regular session hours of a market. Now I'm going to be talking about the financial futures indices as well as stocks and ETFs. So pretty much anything that trades in sync with the New York Stock Exchange hours. And they either end at 4 o'clock Eastern Time or 4:15. So I'm using the close of that last bar, whatever time frame you may have set up on an intraday chart. All right, and the difference here is that sometimes there's there's always a settlement price for the futures markets, for example, out of the Merc in Chicago, and that settlement will vary sometimes by a tick or two. But all the data and all my back testing is assuming you're targeting the last trade of the last bar of the regular session hours. So just to get us all warmed up and awake here on a Saturday morning, I thought it'd be helpful to ask you to put your thinking cap on and try to get in the shoes of yourself as a trader on this day looking at the following charts and ask yourself, what would you have been thinking or what were you thinking? So this is going back to February 22nd of actually last year. I should have clarified that. It's almost exactly a one-year-old chart, and this is what the spider looked like on a daily chart. We put in I believe it was a new 200-day high at that time. Big ugly bar selling off below this gold line here is the 10-day moving average. Unfilled down gap to the downside, finishes mid-range, and then the next day it gaps up, leaves a small, but it was an unfilled gap here. It's probably hard to tell with the wick there, and rallied hard on a short covering rally back up to the 10-day moving average. So ask yourself, if you were short the markets, maybe you got short as we broke down below the lows of that prior up day, or maybe as it broke down through the 10-day moving average. Uh, if you were short around this 152 area, what would your plan have been on a swing trade basis the next day, right? That's what, as traders, we all need to be thinking conditionally, right? Think like um, uh, a programming language, an if-then conditional statement, right? Is this just a normal reversion to the mean for continuation to the downside, right? Is this a shorting opportunity? What are you going to do with your position if you're short, if it gaps up above these recent highs? What if it gaps up anywhere above here? Are you going to hold on to it? Just ask yourself honestly what's your best guess with this very limited amount of information. All right, I see a couple of comments here. Short 50% bounce in the last bar. Yeah, it looks like a Fibonacci retracement, roughly a 50% retrace, right? Typical area to consider getting short. I know one person that actually did get short at the end of that day. The next morning, it gapped up. When I say the morning, it gapped up. I'm going to show you some futures charts. The futures are trading roughly 24 hours, so just one technical note. I ignore the overnight action. It creates a synthetic gap, if you will, because the markets are trading. But I simply mimic my futures charts to look like the regular session of the New York Stock Exchange hours. And you would have seen a sizable gap up 0.5% the next morning. So if you're short, you're getting a little bit nervous, right? Because this has been a relentless bull market over the prior 3 years. So this decision, what you do right at the open, is going to have a huge impact this day. And there you go. So this was the first 30 minutes of that day, I believe. Maybe in the first hour, I can't remember. And it totally dumped. Huge bearish engulfing bar, closed down almost 2%. Almost 2%. So the wrong decision at that point would have faked you out easily. Not only faked you out of a winning trade, but a nice winning trade that you would have been up big after just one day. And obviously the right decision could have made you a ton of money. Let's look at June 22nd. This one to me, a little more seductive and problematic, because I think there's a chance if I'd been swing short, my stops would have been up here and I would have survived. But you never know. But what about this one here? So now the bull market is still, clearly in place. A little interesting consolidation pattern here coming off recent highs. You have a sort of an ugly day finishing well below the lows of a prior up day, right below the 10-day moving average. What's your plan the next morning based upon if it gaps up or down? What would you have been thinking? And just a note, this blue line here is the 50-day moving average. And this is the Spider daily chart back from June 22nd, 2013. So we closed right there on June 22nd. What are you going to do? What's your if-then scenarios the next day? Gaps down 1%. I think this is the first hour bar. Now what are you thinking? You've actually rallied. What are you thinking? You're right at the 50-day moving average. I know some folks have some conversation. I don't do a lot with the longer time frames. I'm an intraday gap trader primarily, or probability trader, quant trader. Trading the gap in 15-minute and first hour ranges. So I am trying to, in fact, I should have probably shared that. I'm not a swing trader per se. I want to be clear about that. These are swing trading examples. Information I'm going to show you can be used to assist your swing trading, right, multi-day time frames, or your intraday trading. This whole project for me was all based on my personal frustration. Yes, I've been doing this 10 years, and yes, I still get frustrated with the markets as much as anyone. Frustration is maybe a strong word, but frustration with myself on not being able to better interpret historical data to determine if a market's likely to continue trending in a certain direction or not, because I would routinely capture a 30, 40, 50 cent gap well, the equivalent of a 30, 40, 50% gap in the spider. I trade the ES futures 3 or 5 point gap in the futures. Thump myself on my chest, inside my head at least, right? Thinking, way to go, you super stud trader, only to see the market collapse 20, 25 points. And thinking, oh my gosh, all I had to do was hold on a tenth of my position, a quarter of my position, and would have doubled my profits. So I started working in earnest to try to predict where a market may close by the end of the day. And I'm going to get to that in a moment. So I know here there was a big discussion with my folks that the 50-day moving average had held like a brick wall twice already. See that? These long wicks that came down? And it would likely hold again because consolidation tends to resolve itself in the direction of the trend. That was the basic theme. I had data at this time that suggested otherwise. I didn't believe my data. I did not act on my data. I was still in beta mode then, and it was just dead right. It just completely melted down there, another 1.5%. So obviously the reason, and some of you are here listening to me, hopefully all of you are here, you understand the importance of being able to predict where a market may close. You can optimize your trade entries, right? You can either delay them, know when to hold, know when to fold them. Same with your exits, ultimately resulting in the ability to minimize trade losses while maximizing your trade profits. Especially as a swing trader, if you can get off to a good start on that first trade and be in the money at the end of day one, it allows you to bank profits on locking a winning trade. That's one technique, or gives you a lot more room, a lot more flexibility in terms of your trade management. So what I'm going to start here with is show you some rules that will help you about 25% of the trading days. And I debated whether showing you the percentage or not, but I'm a very fact-based person. It's important to have proper expectations. This is not going to happen every day, but when it does, I want you to be able to recognize it. It is simple conceptually. You can get a little bit lost in these numbers I'm going to show you, but I will summarize them for you. So just hang with me, and I think it'll make sense. So it's really two factors. It's the opening gap, both the direction, either up or down, and the size of that gap, and the position relative to the 10-day moving average. Specifically, where did the market close yesterday? So the prior session, where did it close? Above or below the 10-day moving average? Got it? Gap, size, and direction, and where did we close relative to the 10-day moving average? Two critical definitions so everyone can track and understand this data. Average true range, it's simply the average daily movement of a market, defined as basically the distance between the high and the low of a given day, but inclusive of the prior closing price in order to account for any overnight gaps. So if the prior closing price is beyond the range of a given high and low of a day, then you go back to the prior closing price. That means there was an unfilled gap. You want to account for that. That's real movement in the markets. Average it up. I use a 5-day average true range, and that forms the basis of how I measure gap size. PF is a term that's in TradeStation performance reports, what I do on my back testing in, and it's a ratio of historical gains and losses. If the profit factor is greater than 1, the scenario has made money historically. If it's less than 1, it's lost money. So we're looking for PFs, greater than, generally I'm looking for greater than 1.2, 1.3. I want to know it's made 20 or 30% more in profits than losses historically. And again, if you're just joining a little bit late, as I mentioned at the beginning, you can download the presentation slides for free. Actually, you can sign up for the daily email that has a link to download the slides at closingodds.com/free. And there's a question, and I'm probably not doing a good job of keeping up with them. We'll try to power through this and come back to these questions, most of the questions at the end, but that was a 10-day simple moving average is what I'm using. The data would not change a whole lot with exponential moving average, but it would change some. So here's the data, a little bit of an eye chart. Let me just familiarize you with what you're looking at. 10 years of data, historical odds of closing above the opening price. So this is a long only strategy. The way of the testing is what the testing assumes. I'm not telling you to go long. I'm showing you the odds of what if you had gone long by buying the open and holding till the end of the day. Buy the open, hold to the end of the day in 6 different scenarios, namely up gaps, down gaps. That's relative to the prior day's close and defined at where the market's trading at 9:30 a.m. Eastern Time. I'll let that sink in. Look at where the market is trading at 9:30 a.m. Eastern Time relative to yesterday's close. Are we gapping up or gapping down? This was all run on the ES, 95+% correlated with the spider, so it's almost identical to the spider numbers if you're a spider trader or trading stocks that are related to it. The key takeaway here is actually one of the few truisms in the market that is logical to me. There is no stop here. It's assuming, by the way, this is not a recommendation to do any of the above. It's just a simple test, a hypothetical scenario. You're assuming you go long at the open, close it at the end of the day. No target, no stop. Long at the open, close at the end of the day. And what I mean by this is one of the few truisms in the market makes sense. A big gap would connote or denote, whatever the proper word is, that, wow, something unusual has happened in the market, some geopolitical event, some economic news that was released pre-market, what have you. And in this case, it tends to foretell more pressure in that direction. So a sizable gap up is defined as greater than 40% of the 5-day average true range, or even a large gap up greater than 80%, 364 trades in this sample size, have closed higher 55 to 62% of the time and have generated more than 40% more in profits than losses. This assumes 10 contracts here, by the way. So don't worry about the numbers. It's the concept that matters here. So basically, on a big gap up, when in doubt, if you don't remember anything else, you want to follow a big gap up. Don't be shorting a big gap up. That's a common mistake of many swing traders and new traders. It has nothing to do with intelligence. You read all these books. Everyone says you buy the dips, or sell the dips depending upon the direction, sell the rallies depending upon the direction you're trading in. That's really not true, at least not on the first day. And this can often be the first day. You'll get your head ripped off. And it'll make more sense in a moment when you consider the market conditions. But this averages out, what, 58%? That may not seem like much. Let's just keep this math simple. If there's a 60% chance of closing higher than the open, then the inverse of that means there's a 40% chance of closing below the open. 60 is what percentage of 40? 150%. It's a 50% greater chance of making an end-of-day directional move in the direction of the gap if the gap is large and up. Got it? Vice versa, the exact opposite is true. If the gap is, well, I said large, medium is still a pretty darn big gap in my book. It equates to like 5 or 6 points in today's terms in the spider, or in the ES, or 50 to 60 cents in the spider. The equivalent size on the downside shows only about a 50-50 because the markets do have a built-in long bias. So it's only 50-50 on which way it's likely to finish, so it doesn't give you much there, but the bigger moves have clearly been to the downside. Much more like a bigger move to the downside if you have a large, sizable to large gap down than to the upside. Again, these are gap direction and size as a percent of the 5-day average true range. All right, so key takeaway, larger the gap, the greater the odds of it moving beyond the open. That simple. Now let's add into the mix the 10-day simple moving average and where the market's closed on the prior day. Just try, see if you can follow hopefully everyone can see my cursor. Actually, I'm not sure you can. I hope you can. But I'll assume you can. I'm looking top left in the table that's above the 10-day moving average. And the one thing you should note is that same table that I just showed you, all of a sudden the bias for the long side is gone. The win rate for large gaps up is still up there at 59%, but look at these profit factors. They melted away to virtually nothing. So key note to self. What I just told you really only applies if you're below the 10-day moving average for large or sizable up gaps. If you're above a 10-day moving average and market may be stretched already, you cannot count on continuation. That's a real neutral setup. Take your lead from the intraday action, okay? And if you have a small gap up, in fact, it starts to get bearish. And again, this is a long only buy, so 0.78 means that favors the bears. Any number less than 1 favors the bears. So small gap up when above a 10-day moving average, or after closing above 10-day moving average, has been 50-50 on closing direction, but has had bigger moves to the downside. Small gap down, exact opposite. Right? When I think of these small gaps, I'm thinking of big money manipulating the markets. Now, do I really believe this manipulation? I believe there's many participants that try to manipulate the markets. There are a few that are capable of doing it, but there's probably some. But I think in general, there's probably some games that go on, and this is one of them. That these small gaps that happen in the overnight session is probably a result of some counter pressures provided by big money who wants to swing it the other way the next day. And this is exactly what this shows. The bigger moves always go in the opposite direction by the end of the day, at least for the past 10 years, than these small opening gaps. See that? So small gap down, almost a 60% chance of finishing above the open, made 30% more in profits. However, if it's a sizable gap down, went above a 10-day moving average, watch out below. Have had some big moves to the downside. And then when below the 10-day moving, basically this table that I showed you on gap size applies perfectly. In fact, even more so, right? Look at these win rates, 65% on average for medium and large size up gaps. The odds of closing above the open by the end of the day, and the profit factor on average more than 2 to 1. This does not really determine the odds of closing the gap, but you can assume safely these large up gaps, after you've been down below the 10-day moving average, these are not filling most of the time, or a large percentage of the time. So they're very risky to fade. I'm not fading these gaps. I'm a gap fader by trade. That's what I do. You don't want to be fading these. You want to be looking for opportunities to get long, because you would have made twice as much over the past 10 years. And this may not seem compelling. I'm sorry, it is. I live and breathe data all day long. This is about as lopsided data as you will ever see for breaking down a market only 2 ways over 10 years of data. And it's consistent year in and year out. Not perfect, but consistent. And then gaps down again, 50-50, but still the bigger moves have been to the downside. So when the market's weak and you get a gap down, you need to be careful. It's not a buying opportunity, okay? Wait for a little bit of strength first. All right, everybody with me so far? I know this data can get a little bit intense. In fact, I've summarized it here for you. Hold on. So some takeaways. Highest odds of closing higher, and I should have said closing above the open. This is all about closing above the open. Highest if the gap is large and up, and less than a 10-day moving average. That's when you want to be thinking, definitely not fading the gap, looking for long opportunities. And the concept there, again, is big money's been short. That's why you've been below the 10-day moving average. And then on a sizable gap up, they are all covering at, this exaggeration, many are covering at the open, and that's putting buying pressure, right? You cover a short by going long, buying pressure in the market, and that is further amplified by what? Speculative longs. Speculative longs are getting along. They're like, hey, we've had weakness. Now we've got a change of sentiment here at the open, and they're getting long bidding the market up. The odds of closing higher or lowest of a gap is large and down. So if you and you've been above the 10-day moving average. It's the exact opposite concept. It's a real reversion to the mean concept, right? Markets are stretched, and you're trading back in the direction of the 10-day moving average. Oh, sorry, folks. I didn't realize the questions were not scrolling for me. Let me just real quickly catch up here. Oh, there are too many questions. I'm for me to keep up. Again, these are simple moving averages and 10-day moving average. Fading the gap means if the gap is up and it's a strong historical setup, I will short it. So I'll go the opposite direction of the gap. If the gap is down, I will buy it. I don't really want to get into that. I have lots of information on fading the gap at my main site, which I've been running for 7 years, masterthegap.com. You can check that out. All right. So that is the simple way of assessing the odds. It doesn't happen the majority of the time, but when you see a sizable gap, at least 40% of the 5-day ATR, pay attention where you are relative to 10-day moving average. And if you're trading any of the financial indices, the Qs, Russell 2000, Dow, S&P, or any stocks that are correlated with them, then this information is going to help you out. And again, all those percentages, folks, read my charts real carefully. It's percentages of the 5-day ATR that I just showed everyone. Okay, percentage of 5-day ATR. It's a lot of information, I know. I'm going to show a couple examples. Question, I'm not going to show any charts. I'll show some charts to get started that you may have missed. I'll show some more charts at the end to help you think through this. So what do we do about the other 75% of the time? I wish it were easy and straightforward. It's not. The markets are way too sophisticated. There are way too many pressures in the market on any given day. So I'm going to show you what I do. I'm not saying this is what you need to do. I'm not saying this is absolutely the best way to do it. I'm too smart to say that. I'm going to show you what works for me and works and creates a clear edge for me and has already helped my intraday trading significantly. So this is how I calculate the closing direction probabilities each day when those scenarios are not in play. In fact, I do it even when the scenarios are in play. I use a 10-year rolling window of historical data. I use the direction and the size of the gap like I just showed you. And I use the average of 5 different market models. They're really back testing. They're really systems, if you will. I call them models. This term Bayesian, real quick, Thomas Bayes, famous mathematician, he was basically laughed at when he first generated some of his thoughts on probabilities, but the concept is real simple and applies perfectly for what we're talking about here, and that is there are many folks out there that share historical data or historical odds on where the market's likely to be from the end of today's close to the end of tomorrow's close, right? We've all seen it. Odds favor closing higher tomorrow than today's close. Well, the problem with that in my mind is it doesn't take advantage of the opening gap. There's not a whole lot you can do. In fact, you can't do anything in some markets in between close and the next morning's open. So the better way to evaluate the odds of where it's likely to do is to use the most recent information. That was his concept. You can improve historical probabilities by layering in new information. Well, the new information is the direction, the size of the opening gap. Why not use that information? Because that's the first time you can actually do something about it. So it's a Bayesian concept for any math geeks out there. And then what I'm doing on these market models is loosely akin to, but it's the model in my head for what the weather forecasters do. I live in North Carolina. We have lots of hurricanes that hit us in the East Coast. And if you ever watch a track or a weather track or weather forecast of hurricanes, you'll see multiple models that show all these different lines. And what the National Weather Center does is basically assimilate all these tiny changes to inputs in core models to create all the potential scenarios on where the path the hurricane may go, ultimately averaging them all up to show the most likely cone or path where they may go. Well, I'm doing the exact same thing with the markets. Granted, I don't have a supercomputer doing all this, and I'm not doing thousands of models, but I've got 5 core models. Within each model, they have completely different inputs, look-back periods, and so on. So I don't want to get too deep in all this, but conceptually, I want to show you how to think about the markets, even if you're not a back tester or into that. You need to be thinking in the following terms when interpreting your charts, and you probably already do. That's the good news. For me, I want to consider trend, momentum, volatility, overbought, oversold, and seasonality. No more, no less. I don't want to get wrapped around the axle nomenclature. Yes, some of these are related, but I have 5 different models that evaluate market conditions every single day using these 5 core concepts. So trend, many different ways to define it. It really doesn't matter how you define or any of these different ones or even how I do it. What matters is that I don't use similar filters or techniques within each of them, because that would increase correlation or overlap, which makes it less valuable. It's like looking at the same watch from 2 different angles. It's going to tell you the same time. So this here, just a simple definition of a trend, right? It's just the direction of a market over a period of time. I like to use absolute trend, meaning looking at where price closed relative to a period of time, right? It can be any number of days that you want, but I like to look at a certain amount of time and where we are, and that's it. So if we're hanging out the highs and been consolidating for 2 weeks, the trend is still up, just about on any time frame. But the momentum may not be up, right? The momentum may have waned. So momentum takes trend to a different level, and it does have a trend component. So there's a little correlation here, but also considers the strength of that price movement, of that directional move. So here's one where if you were right here, so let's say that day right there, right in the middle of where I've circled, the trend is up, but it clearly has lost some momentum. So you can measure rate of change over different periods of time and identify when trend momentum is still strong and when it's not. Volatility, a lot of different ways to measure volatility as well. I like to use a pretty simple concept of just identifying is the market in a state of contraction or expansion relative to prior periods or prior period of time. And these are some great snapshots from the prior year. Actually, this may have been 2012. It doesn't matter. But you can see you have consolidation, more narrow range days, followed by expansion, followed by expansion, followed by expansion. Overbought, oversold. A lot of ways to measure this as well. Uh, Frankly, I'm not, when I've tried discretionary trading, chart-based trading, I've struggled with not identifying the state of the market, but taking the right action using Bollinger Bands, right? John Bollinger created an incredibly useful tool uh, that expands and contracts relative to the market's doing the same, and it can predict when in a statistical measure where the market has reached a point where it is stretched too far too fast is a simple way to think about it, where the markets may be over or undervalued. So I just circled some highlights, some really good ones here. And what's interesting, when you study the odds of a market closing in a certain direction, it can get real choppy when you're around. This is a 20 period moving average, or maybe it's a 21, I forget. It gets real choppy, and then it tends to show real clear odds away from that moving average for a certain amount of time. And then as you get further away, it tends to reverse. So really fascinating when you look at actually how the markets behave. But it does create a lot of value by paying attention to when you're overbought or oversold. And then my fifth system, pretty simple in concept as well. I'm not a big believer in anything too exotic. It's the layering or the use of multiple views, multiple models. That is my true edge. Looking at the day of week, is it a Monday or Friday, is really important in the futures markets because you have many systems and funds that have to be flat over the weekends. They're more active systems. So it adds volatility on Mondays and adds volatility on Fridays. And it can even, depending upon the market, like say an oil market where you have the oil inventories report at 10:30 Eastern time, can add a lot of volatility and impact the odds of which way the oil market is likely to close on a Wednesday. So let's look at a couple examples. Actually, let me pause and just catch up on questions again. Yes, those were Bollinger Bands. Generally, I think the second, the bands represent two standard deviations or 95% confidence levels where price is traded. You can use moving averages uh, to do this. I'm not sure the three different MAs, moving averages. Yes, I use on all my charts, I use 10, 50, and 200-day simple moving averages. I will tell you, if any of you are wrapped around the axle, and this may be a contentious point, about your moving average works better than my moving average, you're missing the boat. You could be technically correct by a percentage or two. There is way too much obsession by most traders with picking the perfect moving average. There is no such thing. I could find, you give me any market and I can find a time frame where there's a certain moving average that's worked best for that time frame. Anyone. That's a factual statement. It's a loose snapshot of a market using moving averages. Like every single filter, and I hate to bust anyone's bubble, you're wasting time and energy. The value is not in picking the indicator. The value is in combining the indicators, or in my case, systems, which are really just indicators quantified, uh, in evaluating a market. If you don't remember anything else, I just told you the most powerful message you could possibly hear, the most impactful one, if you were only been trading a year or two, or if you've been trading a while and are struggling. Stop chasing the holy grail with indicators and trying to pick the right one. They don't exist. Use simple, free stuff works great. All right, so this is October 9th, 2013. This is the state of the markets. This is a daily chart of the S&P futures. If you trade any of the indices, um, it doesn't, they're going to look very similar to this. The spider especially is going to look like this. And this is a table from my database. But here's what happened. So we closed down. Remember, think that if-then scenario going back. That's where we closed. What are you thinking? If you're short, if we get a gap up, what are you going to do? Well, one thing you would do, I would hope, after today's presentation, you would look at the two simple rules I told you to remember. What is the gap direction and size? And where's the 10-day moving average? 10-day moving average is up here. You closed way down here. So using the simple rule, if you had a large gap up, what did you learn? You should have learned you better be thinking long, certainly not short. Don't sell the dip. Next morning, gaps up right to the 50-day moving average and the 10-day moving average. I have a pretty good friend and trader who his system told him to get swing short. Concept is, trend had been down. He was selling the dips, and he's like, look, it just worked perfectly. And I told him the data did not favor it. He said, show it to me. So I showed it to him, showed him these price levels. Remember, these are just mathematical levels. They're 40% of the 5-day ATR added to the prior day's close. So any large gap greater than defined as 80% of the 5-day ATR opening roughly at 1664 or higher had a 74% chance of closing higher, profit factor 2 on 34 trades. That's a small sample size, but it was supported by the next larger area. Win rate not as strong for that mid-sized gap. Look at the profit factor. Profit factor 2 on 131 trades. So the gap was up more than 1%. It opened greater than 1660, or opened at 1667.50. This was in play. Closed up 1% above the open. It just powered through. Now, I thought the 10 and 50-day moving average, and there were a lot of talking heads that said this market's in trouble, and blah, blah, blah. It was October, right? Everybody expecting the big crash. Bottom line, gap direction, size, and market conditions are extremely important. Now, one note on these stats, because it doesn't say it here, this is showing you, and I failed to mention this, these stats right here aren't as simple as the ones I showed you with the 10-day moving average and the large gap size, or size of gap, that worked just as well at the beginning of this presentation in some scenarios. This is looking at those 5 systems. This is the average of my 5 systems I just mentioned. Trend, momentum, volatility, overbought, oversold, and seasonality. This was the average of 5 different systems, weighted average. It's my ensemble method. Let's look at one more example. I thought it would be helpful because honestly, anybody can pick out any day. I could cherry pick and show you nothing but great days in which my data worked beautifully. I'm telling you right now, it doesn't work beautifully every day. Okay, it is a large and significant edge. It is not perfect. I use it in conjunction with my other probability tools. You should do the same. And remember that for everything you ever learn about the markets, everything. Do not be conned. It's too easy. There are unfortunately some unscrupulous folks out there. So this is an example from, so with that said, I could have shown you some examples that didn't work, but what would you learn? I'm telling you right now, it doesn't work all the time. This was February 14th when I was finalizing this presentation. Valentine's Day, this is where the markets had closed. The next morning, it's a tiny little candle, small gap down after it hitting prior resistance. This is just a line I had on my chart. It was just a horizontal line based upon that had been held as support or resistance in prior days. You can't see it further to the left. So strong sell-off, strong rally. Here's the most compelling point. I read this information actually from some friends. Well, actually, this was a customer of mine who does his own quantitative information. He posted it in our trading room. He said 17 of the 22 most recent Fridays ahead of President's Day weekend have closed down. Think about that. 17 of 22, I mean 17 of the past 22 years, the Friday ahead of President's Day weekend have closed down. Sort of makes sense. Market's normally a little bit stretched to the upside by the first 6 weeks of the year. Coming into a long weekend, people want to remove risk, so the markets sell off. And you get a small gap down after hitting resistance. Busy eye chart, but this is what the closing odds data that you can get access to. If some of you may have already done it at closingodds.com. for free, always for free. I'll never charge you for this. It's just my own data I use. Um, it opened down below 1824 and a quarter. It's probably hard to see. I've highlighted it here. And above 1817 in the ES. It's the ES table. This is the spider table. This is the weighted average of my 5 systems, all averaged up. And you see the number of trades. We're not talking about 10 trades here. We're talking about 512 similar scenarios in the past 10 years. So that means each system had about 100 trades on average, is the way to think about it. It had a 61% chance of closing higher. That's 50% greater than closing down. I'm sorry, closing above the open, higher than the open. Big difference, not higher than the prior day's close. That'd be too easy to predict. Higher than the open itself, so you can make the right decision at the open. And it generated about 30% more in profits and losses. It was confirmed by the spider. You always want to see the exact same systems confirmed by other correlated instruments. So the spider and ES are highly correlated. I always look at both in tandem, have the same data on the NASDAQ, the Dow, Russell, and so on. 60 and 1.2. For all intents and purposes, on that many trades, it doesn't get much more consistent than that. So contrary to a very scary number where you'd only had 5 times you closed above the open out of the past 22 years, my data was saying there's a 50% greater chance of closing up. And it had no consideration of President's Day seasonality. And by the way, I'm a big believer in considering seasonality on unique days. Don't get me wrong there. That was a risk factor. But you have to look at the weight of the evidence here was clearly favoring the long side. With me? By the end of the day, that small, tiny gap down had powered up and finished up. Not a huge day, but up 2/3 of a percent, up 12 painful points if you were short, I assure you that. So again, it's easy to cherry pick charts at work and those that don't. This is all this data. Last thing I'll leave you with, because I know there's some cynics among you. In fact, all of you should be cynical always, right? Trust but verify everything you hear and see about the markets, everything you hear and read. Way too many people take things at face value, and quite frankly, I don't think most people, and there are a lot of educators out there that throw a lot of information around, and I hear people get frustrated and say, oh, you can't trust that guy, blah, 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 about different people. I think most of the time the information is just not easily conveyed and people misunderstand. So anything I've even said you want to try to trust but verify, because it's too easy to misunderstand some of these concepts. But one of the big mistakes and one of the problems with historical data, which is what my whole lifestyle is built on, is that it's very easy to curve fit, to create a system that perfectly mimics the past. By using a technique called optimizations. You can optimize targets and stops and moving averages and all kinds of factors, filters, to come up with almost a perfect mimic of the past so that your system catches every peak and valley just perfectly. Not everyone, but most of them, creating the world's most beautiful equity curve. And then someone will say, give me $5,000 and I'll let you trade it. Run away from systems like that, okay? You want to ask, is there any optimizations done in that system? And if they say yes, I'd be extremely cautious. All the data I'm showing you, these 5 systems, are not trading signal creation systems, okay? It's simply evaluating historical data based upon different market conditions, based upon these 5 filters I showed you. No optimizations in there whatsoever. So that's part of the robustness of my approach, and it's an important concept, and I may have lost some of you there, but I'm just trying to give a little confidence in the data when you see it. So you're probably asking, how do I do all this? That's cool, but I don't have time to do that. Well, actually, some of you could do this. If you have a mathematical inclination, you can do like I started out with when studying the gap 10 years ago. Download historical data from your broker, use a backtesting application, or an Excel spreadsheet even. That's what I did. And you can determine your historical probabilities and then update every day with the open, high, low, and close. Or you can go to closingeyes.com, got more information there. It's my own personal research delivered to your inbox nightly for the next day. It is free and will always be free. There is a component you can pay a little bit for that'll show you some more data. Honestly, you don't need to do it. I'm not a very good salesperson, I guess, but I would not start there. And it doesn't. It's like 20 or 30 bucks. You really don't need to. Most people don't. Just use the free version. You want to get acclimated to using the data and understanding it, incorporating it into your plan. How to, you want to learn how to use the data in context with your own chart skills or whatever other indicators you may use. Right now, it's limited to these markets. We'll be adding some other markets, so keep an eye on that. That way, I do all the tracking for you. But it's a little bit black box, right? You're dependent upon me and my system. But it is all automated. It shows up 6 o'clock every, I think by 6 o'clock every evening. It may be earlier than that actually now. Couple of questions I've got. Oh, let me finish this. This is the end of the formal presentation. We have about 12 minutes left. I'll take any and all questions. Do you have formal training, education, statistical analysis, or mathematics? Yes, I'm not a statistician per se. I have an engineering degree from West Point, an MBA, and stats was my favorite class. And the only class I got an A in grad school. But I don't claim to be a statistician. I have used the assistance of some Duke statisticians, however. If you're not optimizing, how do you determine which look-back period you're using for your trend definition? Great question, Ian. To me, it's not, again, if I optimize, then I'm curve fitting. So what I've done is I've intentionally used different look-back periods, meaning different time frames for all 5 systems. So in general, I know that what happened a year ago is not as important as what's happened, say, in the past 6 months. That's one way to think, man. What's happened in the past 6 months is not as important as the last 3 months. And so I have a little bit more of a, what I call a midterm focus in all my look-back periods, but I've intentionally used different look-back periods to minimize the correlations. Oh, you're welcome, Haley. It's not perfect. Nothing is. Questions welcome. I'll take a sip of Gatorade here. Another question. I'm sorry, I'm catching up. Please define the term discretionary trading. First and foremost, every decision one makes as a trader, whether you're a mechanical, systematic trader or a chart-based trader, is discretionary. So I hate to burst any bubbles, but if you use systems, use discretion, or somebody use discretion in creating this system. So you cannot get away from discretion. Discretion is simply making a judgment decision, if you will. That said, I consider myself a quantitative or probability-based trader. I have rules that evaluate historical data from at least 3 different systems on every setup I use. And if historically a setup has had a 60% or greater probability and has generated 30 of winning and has generated 30% or more in profits and losses, then my rules say I have to take the trade. I use a little bit of discretion to tweak targets and stops based on charts, key technical levels. I'll look at pivots, Fibonacci's, etc. But for example, if my system says I should use a 5 points, not should use, let me back up. That would be an optimized answer. I pretty much use 4 to 6 points on all my trades for all my stops and targets in the ES. Adjust a little bit based on volatility. And if it's based on the current volatility, my stop is showing, say, 4 points, and I see that by using a 5-point stop, I can get just beyond the daily pivot. I may adjust it. But I am primarily a quantified or quantitative trader, using probabilities with as little discretion in my decision, my go-no decision as possible. I find I am not good at looking at a lot of different time frames, a lot of different charts, and reading them. It's sort of like a Ouija board to me. You can sort of make them say what you want them to say. Question, so we would need to incorporate the opening gap into our plan for the day. Well, Jim, my nickname is the Gap Guy, so I'm highly biased. Yes, To me, it's sort of foolish not to, though, right? It's the first bit of information you have about a day. A lot of people don't trade it. I'm not saying you have to trade the gap, but to not pay attention to the size and the direction of the gap on a given day, and to help that start building if-then scenarios in your mind is just a lost opportunity. It's the best information, most powerful information you have, I think, in any course of any given day, because it's basically you get to see what big money thinks about what happened overnight. Can you use trade options using the system? Yes, some folks are using weekly options to take advantage of the data that we have at closingodds.com. Absolutely. The recording's being made. ValueCharts is recording it. I'm not sure where they're archiving it, though. You'll have to talk to them. John, how do we get the daily closing odds email if we just register? You know, I caught myself at the beginning of this presentation. I think the answer is wait. I really should know that. I don't. I think what happens, if you've signed up for the daily email, you will get, we've already sent it out for Monday, so I don't think it'll catch up. You'll have to wait till Monday evening, and you should have it by Tuesday. So I'm sorry if I confused anyone there. And at the very top of that email, not only have links to the free closing odds information, but it'll have a link to download the slides. Question, overnight action, anything to be taken from that? Yes, I don't pay a whole lot of attention to price patterns. Remember, the overnight action, the price action in the futures markets is extremely low volume relative to what occurs. In fact, let me see here. Actually, I'm not going to pull up my charts. I'm using a different charting platform than some of the folks that are hosting here. I've worked with Metastock for years, though, and I do have Metastock. But you can look at any charting application that shows the overnight action, and I don't pay much attention to anything other than the size and the direction of that overnight move. With yesterday's close, what would you think of Monday? That's actually probably a good question to end on. Hold on one second and see if I can pull this up. I might be able to show you Monday. I should have thought of that before. Hold on. And here you go. So they're already posted. So instead of me guessing and pontificating, well, actually, I will do this. I need to show you the chart first to put this in context. So, and I know people always love the live charts for some reason better. Just real quickly to put it in context. Here's a daily chart. So we closed down. We had a higher high but a lower close. In general, historically, that increases odds of gap fill a little bit, and has a little bit of a short bias in terms of volatility. We gap down, it could be a little bit volatile. Gap up would be a more reliable short if you're looking for an intraday trade. But we're above the 10-day moving average. And remember our rules that I share, the simple rule. If you're above the 10-day moving average and we have a large gap, at least 40% of the 5-day ATR, then odds are it's going to continue down further by the end of the day. A large gap up would be a neutral setup. And let me show you the data. And I'll leave you with this last thought. Actual data, use this information at your own risk, but I've already got the closing odds data. If I can figure out how to move it over here. Hold on. Hopefully you can see this. If you can't, let me know. But here's the data. It's a busy slide, but here's the number breaks out. So 40% of the 5-day ATR is going to be about 5 points. You see the delta between 1834 as it closed in the ES. So this shows that we have a small gap down. The average of my systems, 57% chance of closing higher, 1.1 profit factor, a little bit of an edge to the long side. If you have a small gap up, it's 50-50 on which way we're likely to gap, but the bigger move has been to the downside. Take a screenshot of that if you want. Doesn't look to be anything overly clear. A mid-sized gap down would be pretty dangerous. It's had a risk to the downside. On 24 hours like Forex, where would you use as the opening time frame? Oh, that's a tough one. I don't trade Forex. I think the weekend is about the only chance of really getting a opening gap. But what I would do, I'd look at the market and put a volume chart indicator on it, and call your regular session the session that has the highest volume. It normally equates to the country that's the lead element. So you're doing something dollar based, pay attention to the U.S. hours, and so on. Yeah, so if you've already signed up for the daily emails, you're right. You can access this chart right now. That's what you can sign up and get instant access to all the data for the different markets right now. Again, no charge. Well, one thought here, by the way, and then I'll wrap up. This truly isn't a bait and switch. I've been very blessed by these markets. Uh, what I do is fairly intense and rigorous when it comes to a mathematical approach to the markets, and it overwhelms a lot of people. So my whole idea behind closing odds was twofold. One, give back a little bit, but honestly, bluntly, for commercial purposes too, right? This is a great way to advertise and get people interested in what I do. And if you like closing odds, maybe you'll come check us out at Master the Gap. Regardless, feel free to use this information. I hope this has been helpful for you. Again, I thank ValueCharts and Metastock and Dave for this opportunity to speak with you. And y'all take care. Good trading.
There we go. All right. Well, welcome everybody, and thanks, Dave. I appreciate all the kind words there, and happy to be with you as well this morning. I wanted to share with you here today some of the top trading strategies I've learned over now in my third decade of trading here, the 25th year of trading since I got started back in 1990. And, good morning, everybody. Glad to see you. And so we're going to jump into it. I've got a lot to share with you. And walk you through some key principles, especially as it relates to not just picking the right stocks, but also some key option strategies, because my experience is that, talking to a lot of people that get into options, there's a lot of mistakes that people make, unfortunately, that they could avoid if they just, primed their brain the right way. So a lot of this is just how you think about setting your trades up to give yourself a better chance for success. It doesn't mean that it guarantees anything. Obviously, there's risk in any trade, and you need to know how to manage that risk. So we're going to talk about trade management today and really focus on the first E here of getting you properly educated in the right framework. And then you can put that to work through various platforms like Metastock. We'll show you Metastock here in a little bit, how you can, explore for new opportunities. But, it's really about pointing in the right direction, getting focus on this. Remember that everything we talk about is geared for your information and education only, and nothing said here should be construed as a specific buy or sell recommendation. But, when you're looking to hit the target, you've got to get yourself pointed in the right direction. So if you're shooting your arrows in the wrong direction, you're not going to come close to hitting your target. But it's the education piece here gets you pointed in the right direction here, and then you can start narrowing your focus down to then exploring for opportunities. And ultimately, of course, it's about execution. If you learn a lot of things but you don't apply it, then you're not going to be able to pull the trigger. You're not going to get a chance to hit that bullseye. So we want to make sure we show you how you can convert that knowledge into action. And to me, it all starts with, okay, having a plan of action. What's your game plan for how you expect to take money out of the markets over time? It's sort of like if you were creating your own business. I know a lot of you may even own your own business. The bottom line is that you've got to have a light bulb. You've got to have an opportunity. Even if you work for somebody else, you're probably helping them execute, some kind of an edge, some type of a competitive advantage that allows you to get an edge on the competitor across the street. Obviously, in the markets, the reality is that there's competitors right next to us online. Basically, everybody is reacting to a constant stream of information. Obviously, if that works, that's going to be able to cash flow. And if it doesn't work, you're back to the drawing board looking for something else. For me, and I've talked to a lot of traders, who basically need that extra edge, that extra little emphasis on something that they can get some type of a clear and viable advantage in the markets. And for me, it really starts with a focus on the price action, the technical analysis side of things. And I see, with all the speakers you have here today, great ones, you're really getting that same kind of focus throughout, because we need objective data. My issue with fundamental analysis is that while it works in the long haul, a lot of people don't have the staying power that say Warren Buffett does to look out 50 plus years. A lot of us are looking for more quicker gratification on our work that we're doing in the market. So for me, the technical analysis gives you the opportunity, and for me, the shorter term you get, the more important price action becomes in my experience. Obviously, long-term fundamentals still matter, but short-term technicals start to really drive the bus. And so, of course, technicals have been used for literally centuries, going back to the Far East, tracking with candles and things. But in my experience, over the last 25 years, the PC boom of computers has allowed you to have the same kind of knowledge at your fingertips that a lot of institutions wish they had had a couple of decades ago. I mean, the technology is a great opportunity. At the same time, you need to know how to manage that technology effectively, because I would contend that the news is actually creating a lot of noise for a lot of you as traders. You're overreacting to the constant flow of information that you have coming at you. I mean, that can be very overwhelming, can it? You say, well, what do I do with all this? There's more than 3,500 optionable stocks and ETFs out there now. So you're saying that's a ton of data to try to sort through. The computer, the power of that, and the scanning ability you can get through tools like the Big Trends Toolkit and Metastock is a great way you can narrow that down. But I'm going to look more at the reaction to the news. That is how the market and the stock behaves once, say, earnings come out. How many times have you seen it where earnings are good, quote unquote good, and yet the stock drops on the news? I would consider that a disappointing reaction. And a lot of times that's because a lot of people were loading up on that stock right in front of that news, betting that the news was going to be good. That's where you hear terms like whisper number thrown around, like, well, it beat the analyst estimate, but it didn't meet the quote-unquote whisper number. I contend that the markets are purely supply and demand driven. By the time that everybody has bought, you now have a lot of potential sellers out there, because there's a lot of supply of people that, in essence, if they start losing, they're going to be looking to bail. And at the same time, obviously, if the market's going up and you have a lot of fear out there, which lately you've had this talk of how this market recently has mirrored the market from the late 20s and how we're in the beginnings of a pre-crash setup. I personally love seeing that kind of fear out there, because that tells you that that's going to keep a lot of people nervous. And the long-term charts for the markets have been very bullish in my work since back in about the beginning of 2011. So, on the long-term chart, obviously some of the shorter-term charts are picking up well in front of that. But, the three big assumptions, and we'll show you some chart examples, the three big assumptions here of technical analysis are that the markets are going to discount that news. That's why you start to see that you get, a stock going down after the good news comes out. So the thought is that you've got to know that stock price is basically reflecting all known fundamentals. And you can say, well, what about insiders? Well, of course, insiders, it's the same concept, that if you start to get some buzz going about that insiders are buying a stock, that's going to eventually spread throughout Wall Street. It's not going to spread right away, but it starts to basically impact a positive trend continuing along the way, and vice versa for selling that may be happening behind the scenes. So that gets price into the stock. So that's why we're focusing on this price action. And that's why these trends occur, because that kind of information doesn't come out instantaneously. It kind of tends to get gradually disseminated. And so you get this sort of self-fulfilling prophecy of an uptrend begetting more potential buyers. Think about it. If you're in a good winning trade and a trade that's losing, which one is taking more of your mental energy? Do you worry much about if especially on a long-term stock or a long-term option, if it's going up versus one that's going down, which one's going to start to really get into your head? It's not typically the winner that bothers you so much. It's the loser that starts bothering you. It's the what I would call like the Verizon commercial, the "Can you hear me now" syndrome. If a trade is not working and you're down on an option 10%, you're saying, okay, that's not working. I don't like to see that, but it's not really that screaming at me. Then it's down 20%. Then it's starting to go, can you hear me now? Then you don't act on it. Then it's down more. And now it's yelling at you, can you hear me now? So the bottom line is that we've got to obviously cut those losing trades quickly and then let those winners run. And the past patterns of the market tend to be repeated in the future. Maybe not perfectly, as a classic market quote says that the the uh, the future may not be repeated from the past, but it certainly may rhyme relative to the past. So you see these patterns that somewhat rhyme, they're somewhat similar. And so we're looking for those patterns that tend to repeat themselves or be similar over time. So, like for example, with stocks like Tesla, it started to be on everybody's watch list. We've been in and out of Tesla a number of times in the uptrend that it's had. Uh, over the last year, because it's been one that a lot of people have been kind of skeptical about. We'd like to see that skepticism while the stock is leading. That pattern is a very good positive combination. And a lot of investors will tend to, act in a similar kind of a way towards markets. They'll tend to get out of markets after you get those crash-like scenarios, the latest example in the long-term sense being 2008. And I've got some examples from that crash to show you. And then people getting in too late to the uptrend because they were still remembering that past crash-like mentality. We saw the same pattern throughout the 90s. That psychology was of a fear of a crash because people still had the crash of 87 fresh in their minds. So we want to be able to manage that and go from there. Now, like I said, I'm not really keen on fundamentals for active trading, especially for option trading, because if you buy a cheap stock with options and you buy a call on a cheap stock, betting that that stock's going to go up, that call should go up in value. If that stock takes too long to get going, even if it doesn't go down, if it stays flat, that's bad news if you're an option buyer. You need more speed of movement. How many of you have ever had the experience as an option trader where you were right on the stock and you bought a call and you still lost money on that option, that call option, because that stock didn't move quickly enough? Anybody ever had that experience? Yeah, I mean, we've all been there at some point, right? And so that's why speed of movement is so important to me, and I'll share with you one way that I deal with that to find the acceleration factor within a trend to where it's starting to actually not just go up at a linear rate, but it's starting to actually speed up. That will help you to see when the buying is starting to heat up in a security, and then you're looking for those patterns to repeat. I founded Big Trends back in '99 and going into 2000 as that tech bubble burst, and I was sharing with people the success I'd had in the tech stocks that helped me launch Big Trends, and some of the other brokerage stocks and others that were just going vertical on those accelerations in the late 90s. And people said, "Oh, that was great, but we'll never see that again." And you'll see from some of the examples I'll show you today that these patterns are happening again and again. Tesla may just be the newest example of how human behavior doesn't change. Fear and greed don't change. People go from one extreme to the other. So what I look for in trends is, how do I increase my opportunity and odds of a more consistent trend? And what I've found is that I want to try to minimize as much of the whipsaws and the fake outs of a breakout and get the true breakout and avoid those fake outs. And so what we're looking for here is a method that can filter out a lot of your bad trades, a lot of your, not just trades that go against you, but even trades that just don't move, that are just kind of dead money. And so from that perspective, we say, okay, we don't just want to buy when we see an initial turn in the indicator. That would be what I would call the setup, that key point where it looks like it's starting to go. How many times have you seen it where you think you're seeing a turn in the markets, and just as you see that turn, you're thinking, well, I want to be ahead of the crowd, so I want to be getting in right as that thing starts to turn. And then it seems like as soon as you buy it, it shakes out the other way. It's like it faked you into the trade, and then you get faked out. That's kind of frustrating, right? Everybody's probably seen that experience too. I certainly have. And the reality is that how did I deal with it? What I call a trend confirmation is a way in which I'm saying, okay, in essence, I tell the stock or the market, prove it to me. Once I see that you're starting to turn, I need to see just a little bit of additional confirmation that tells me that indeed that stock or market wants to keep going in that new direction. And that confirmation point has helped so much in reducing the whipsaws. They're still going to happen from time to time, but the idea is that you need to be able to trade with confidence. And that confidence, when you have a system that's giving you more consistent trades, more consistent types of winners, and allowing you to manage your losers without having that sort of gut-wrenching feeling that we've all had off of trades that went against us more than we would like at times, is saying, okay, we want to avoid that kind of gut churn, So the bottom line is that what I look for is that temptation to rush into a trade. We all want to be in the game, right? That's why we're traders. That's why we're active investors. Whatever your particular time frame is, you're looking to capitalize on an opportunity, right? But that temptation to rush into the trade gets a lot of people in too quickly and gets them faked out of a lot of moves that frankly haven't confirmed that they're really ready to go. So these similar patterns and characteristics is what we're after to look for that to repeat again and again and again. And so the confirmation tells me that, okay, my trend is getting an extra shot in the arm of confidence, and that's going to likely lead to even more buyers on a bullish breakout or more sellers that are just getting disgusted with a stock that's breaking down and want to be out of it. So, over the last 25 years, in particular since I launched Big Trends in 99, I've added a lot of approaches on top of common ones you probably heard here. For example, you're familiar at this point, I'm sure, with moving averages. You've probably heard about Bollinger Bands. Okay, so those are a couple of common ones out there. But then you start to see some tweaks that I've made in some of these indicators, like my acceleration bands. I'm going to show you some examples of that here today. And then, using other tools like, of course, Wells Wilder's DMI and ADX, looking at the efficiency ratio. How efficient is a trend move happening? Looking at actually not just MACD, but confirmed or non-confirmed MACD signals. So we call that MACD momentum divergence. So we look for good patterns versus fake out patterns where MACD can get you faked out at times. The CCIs become another useful tool. Now, we're not going to go through all this today. In fact, I really want to focus here on just a couple of these that were kind of the core drivers of how I launch Big Trends. We'll focus today on acceleration bands. We'll take a little look at the efficiency ratio here. And of course, a lot of people know that I have some modifications that I've made to Larry Williams' %R, the percent range indicator. And then all this goes into then making sure that you get your market timing right, because if you buy the best stock in a down market, that's probably not going to help you very much. Even a Tesla is going to get whacked if the market tanks back down. So you've got to be aware of the market environment too. We're always looking at that. So since I know Metastock was with us, I was trying to pull up my Metastock, and frankly, on this computer was having some issues getting it open this morning. So I said, I've got to go back to some past examples here on Metastock, because Metastock is actually the first company that I actually did my Big Trends toolkit with, and it's been one in which there's more than a dozen indicators and systems in there that you can actually find these kind of acceleration breakouts. So what do we have on this chart? Here's a past chart of Apple. And what you notice on this chart is that, with Apple, so for example, the stock was in a long-term uptrend, so I would tend to put my bias on the short-term buy signals within a long-term uptrend. I wouldn't get so worked up about sell signals if we're in a long-term uptrend on the short term. And that's where you get yourself in trouble, where you're looking for a top in a market that's in a long-term uptrend, and people that have been basically looking to buy puts over the last several years have been getting their heads handed to them. Sure, we had a couple of little windows. I'll show you one on the S&P of the type of pattern I would look for it to break down. But you see, here's where Apple started to break out in this chart back in a prior July. You see there's the first bar outside and then the second bar outside the acceleration band in blue. Now this acceleration band is plotted on just against a classic 20-day moving average, but it's different than a Bollinger Band. A Bollinger Band is going to tend to race to catch up when you see something break outside of these bands. So this is the classic 20-period band. And Brad asked, what's the difference between a 20 and an 80-period acceleration band? It's a good question, Brad. 80 periods is geared to kind of show you the longer-term trend. So I would tend to use both the 20 and the 80 together when I'm looking to kind of confirm that I've got not just the short-term trend right, but also the long-term trend right. Your best trades, in my experience, folks, and again, you may have your own way of doing things, but in my experience, my best trades tend to be bull trades in a long-term uptrend, and they tend to be bear trades in a long-term downtrend, like when we had that late 07 to most of 2008 decline. That was one of my best years in trading ever because the markets were dropping even faster, and we'll show you some examples of put options we had on those 2008 ones. So the second trade in a row is where we get our confirmed buy signal on that second bar's close. One trade outside of a band, like say back here, you can see on the downside, for example, one, and then the second one, it closes back inside that band. So, as it's trying to get down into that lower band, for example, it's trying to set up for a bear trade. It's just not happening. And so you can see it gave one possible bear trade on Apple, but like I said, that was, and let's just say even you took that trade, if it got one and then two outside there, you can see that then when it closed back above this trailing purple exponential moving average, that would stop you out just a few days later. The goal of any good trend following system is when you're right, you need to be riding that trend and getting the most out of at least part of your position. We'll certainly recommend scaling out, but over time we'll see that, okay, when you see that this thing keeps running, even if you scaled out a part of the trade to take half of your profits down, especially on an option trade, one of my rules of thumb is if you can get a double on an option trade, take half of it off no matter what. So even if you sold half of it, you see that the rest of it runs here dramatically. And then you're using this trailing purple exponential average here to say, okay, this one, you can see it was holding, hanging in there. I used to, when I first launched from the 90s, I was just trading outside the bands, and anytime we go back inside the bands, I would get out. But what I found in the 2000s was that that was becoming too noisy. You can see in this case, sure, you're going to get knocked a little bit harder by the time it closes underneath that 10-bar exponential back here in early August, but it's still preserving your capital. You can see, compared to, say, here's a bad signal, 1 and then 2 bars up, you see that it's buying right off of this close on that one at about 415, and then about 1, 2, 3, 4 days later, getting stopped out back down here in the low 400s. So, that's going to happen from time to time where you have to give yourself enough wiggle room to manage that. In fact, that's where then I added in my percent R rules, because I was looking for spots to get back on a proven uptrend at an even better risk reward area than what the acceleration bands were giving me. So the acceleration bands are like my first kind of a thrust indicator. If you think of a rocket launching, we want to see it, launch off that launching pad with enough power to really start taking off. Now we need to then further refine where do we get into that strong trend? How can we hop on board at a relatively managed risk area? So basically, from this perspective, we're looking at a situation here in which, we want to find, okay, a good oscillator that can tell us, okay, when do you buy a little dip in that uptrend? But this is a big difference in quote unquote overbought thinking versus oversold thinking. When I say the word overbought, what are you usually thinking about a stock if I tell you it's overbought? Are you thinking to buy it, or are you thinking to sell it? Well, of course, the training that most of you have had, and yes, you're going to say the sell, right? That's where the training and the thinking is overbought by definition. Why would you want to buy an overbought market? The irony of this is that I run a lot of testing through tools like Metastock to find where we have, an edge. And what I found, surprisingly, was that the strongest stocks, which of course are going to go overbought, will stay overbought for much longer than you or I would have possibly expected. Tesla, as an example, more recently. But the bottom line is that overbought can actually be very good. And in the same way, like the 2008 market, you're going to see examples here where oversold can tell you that the institutions are just dumping and starting to dump a stock, and that you don't want to be trying to buy an oversold market if it's really dramatically oversold. So you've got to know when the environment is configured properly. You know that a strong trend is going to be for a stock that's at or near recent highs. For example, those of you who read Investors Business Daily, I read it, and I'm a fan of that methodology, same concept. I just needed to quantify it a little bit more, of saying, hey, a stock that's good shouldn't have more than probably a 15% correction off of its highs. It should go through natural reactions, pullbacks within the uptrend, but those should be brief. They should be short-lived. They can seem a little bit violent on a day-to-day basis, but as long as they're then rebounding and holding in that general overbought area, that's a good thing in my experience. On the opposite side, like I said, the weak trends are the ones that are trading into recent lows and continuing to make new lows. A lot of people get enticed to say, "Ooh, a stock's at a new low. Maybe it's a great quote-unquote value." Like I said, that's potentially a death thought for traders. You can get yourself caught in some trouble there. Now, Larry Williams is an example, and Brad, you're right. A ball in motion tends to stay in motion. That's exactly what we're talking about, is that kind of self-fulfilling prophecy of positive or negative momentum, as long as it's got enough oomph to it. As long as it's got meaningful momentum. So, Larry Williams initially created the percent range indicator, kind of looking at the trading range. If you've got a stock that's trading between 100 and 110, well, then if I tell you the stock's at 105 within that range, smack dab in the middle, that's essentially the 50th percentile on my scale from 0 to plus 100. Williams' reading would be minus 50. He used a negative scale. But, the bottom line is that what I found is that, that's not as intuitively obvious for me. Also, you see that the traditional setting, some people use a 10-bar setting or 14-bar setting. I don't do that. I use a 30-bar setting. So I found that the 30-bar setting, and I share this with you, is this, have you go back and look at, most platforms have it, go back and see what you've been missing. And then you can learn how you can start scanning for these new opportunities and find yourself pointed in the right direction to start finding the biggest and best trends. Most people that use an overbought, oversold mentality are thinking, if you're looking at RSI or stochastics or, the conventional way of looking at percent R, most people think, well, by the time it gets oversold, I want to buy it and bet on a reversal. I actually see that these extremes, once they show that confirmation, that you can actually signal a significant trend in a security. So for me, the 80 and 20 levels above that 80 percentile on overbought stock can be very bullish if it continues to stay in that zone. And like I said, gold's been breaking out here recently. This is a past chart of gold. But, you can see both good and bad trade examples here. And what you'll notice, let's look at, okay, there's a couple of good ones here, and then we'll show you a bad one as well. So you see when it starts breaking out on the GLD, when we, at the very left side of this chart, we go over a bot here, you want to see it go and close over that first overbought bars high. That's what we call the confirmation point. So that's the first breakout right there. You can also see another one in the middle of the chart that we'll see even more clearly here. So look, it's going over bot right there into the top 20% of readings. It's going almost to the 100th percentile. What does that mean? It means that this bar's high right here is essentially the highest close that it's had looking back over the last 30 bars of action. Now, you would think that sounds like it's up at the top of that trading range, right? But look at what it does. It not only breaks out above that high, but it also does the breakout outside that acceleration band on the GLD. So that's the confirmed buy signal there, second week of July on that particular move. And you see how it just stayed overbought. It stayed above these acceleration bands so nicely here. And it was only when the CME, this was a move that happened from about the mid 150s up to the mid 180s. The peak, it went from 155 to 185, and then the CME came in and started tightening their margin requirements in this one. So what's the exit rule for percent R? If you're new to this, you see that this point here about the 23rd of August here is where it came back and tested under that 80% line. And so as it does that, that's happening, as we look, it's happening right off of this low here. What I say is that that low has to hold if we're going to stay with that uptrend. That's called a percent R retest. You see another one that happened back on the left side of the chart. When it came back down underneath that 80 percentile level, that retest was a key low. And in that case, on the left side of the chart, it was a great spot to actually hold your trade and let it keep running to an even bigger gain over the next couple of weeks. By the way, if you've missed an uptrend, retests can be good spots if you see them holding to get back on board a proven trend. Because these are the two good signals on this chart on the upside. You can see also that it didn't hold on that right big signal, and so our exit's happening at the close of that bar. Now you see in the short term, it's going back into what I would call the trading range mentality. It tries to get back over the 80 percentile level here, in particular, right up into this high right here. But this is where we're talking about confirmation. See that next candle there in early September, how it tries to get through that resistance, but it can't close above that prior day's high. That's called a failed attempt at confirmation. That's a non-confirmation. That's just the top of the trading range for now. Now, why don't I go ahead and bet on the downside there? You can see in retrospect, it looks like that would have been a good spot. But I just say, look, you want to say that's the top of the trading range. You could be selling, doing option selling strategies above the market there with, for example, call credit spreads and other tools like that. But the bottom line is that when we're looking at these opportunities, we want to know, how to really make sure of, how we can really focus on the best trends and not get stuck trying to trade the slow boats. We want to be on the faster boats. You can see, of course, then it breaks down the other way. So a bear signal here is where it's breaking down and then falling through underneath that low. In this case, you can see by the time that happened, we'd be looking for a retest as a better low risk entry. We actually took a trade here off a retest right on that point of resistance right there. It started to work for us and then it stopped us out. So, we had a small loss on that trade. But that's the goal, is how can you limit your risk and end up, finding the biggest and best moves. Notice here's a one that didn't work so well in the percent R, and notice what it didn't have working for it. It was not moving outside of these acceleration bands. So when we start to pair these indicators and these concepts together to find the more powerful moves, you'll see that your biggest trends will not only have percent R confirmations, they'll tend to also get the acceleration bands. And again, this flies in the face of what most of us would expect as to what's your logical opportunity. You would think you would want to buy an oversold stock. You certainly wouldn't have wanted to buy an oversold stock in the form of Bear Stearns. In particular, you see the first signal back in late '07 was a good one on the percent R, and then the acceleration bands kicked in a little bit behind that into early 2008. See this next one, it didn't get underneath the acceleration bands at all there, so that ended up being a bad signal for just percent R, but the acceleration bands told you to stay clear. And here's one where you can see when it broke down here on Bear Stearns in the beginning of March of '08, for example, then we're saying, okay, look, percent R starts to break down here, so that's the first point there. And we got onto this one just under $70 right here, right about a day after that, as the acceleration bands were starting to go as well. And this is an example where I made a mistake on this trade. I sold all of my position at a double. Usually I would only sell half of my trade at a double, but it went quickly from about 70 down to 60. We were able to get a double on it that fast in a day or day and a half almost. And basically we thought, okay, well, let's book it and then try to get it back on the next test. And it came very close to a retest that same day, but it basically then flipped back down by the end of the day. So unfortunately, my double could have been in the thousands of percent on my put option, because you can see that one went on down to open a week later at $3 a share when that pathetic J.P. Morgan buyout attempt came in at like $2 a share. It's just insane, right? So it ended up, they had to up it, and it ended up going back up to about $10. We wouldn't have wanted to buy that, of course, because that's a massively broken stock, and that's where the bottom falls out of these stocks. That's where you want to take these trades. So Lori says, do we not want to take the trade unless it moves outside of the bands? That's my preference, Lori. That's where you're going to find your biggest and best moves outside of there. This is certainly momentum-driven trading, but that's where you find these bigger trend moves, the ones that surprise people with their severity of up or down movement. So the rumors were starting to swirl about Bear Stearns being in trouble, and that's where basically then as nobody stepped up to buy it until it was down to next to nothing, that's where the bottom fell out over the first couple of weeks of March. So we want to find these opportunities, and then we want to leverage them intelligently. Um, and so basically, from this perspective, what I look for is, okay, which type of trader do you want to be? If I'm looking to trade a little more conservatively, I tend to recommend high delta in the money options in which they have a fairly quick bang for your buck. That if you say you've got an option with a 70 delta, it means that the stock goes up $1, your option should go up 70 cents or $70 a contract on that $1 move on 100 shares. So, in the stock, that's also going to help you to manage what we call the theta risk, which is the time decay risk, because an option that has intrinsic value, they can't mess with the time erosion on the intrinsic portion of that trade. We'll show you an example of that here in a minute. So, I don't put a lot of energy into Vega, although I do say beware of buying high volatility, say right in front of an event like earnings, because those are the implied volatility surges that you can then see them collapse right after that earnings. I tend to say stay away from that. If you're a little more aggressive, you can trade higher gamma options, which are going to be picking up delta faster, but these tend to be options that are closer to the strike price at the money being tied to the current stock price. So for example, on a gamma graphic and visual for you. If you were right near an expiration on a $50 stock and you bought a $50 call option, well, you can see there's a huge gamma in the red last day of that option's life right at the money, right? You can see that the gamma is about 43 here on the, if you're on Friday morning right before the Friday close expiration, you hold it for a day. It's saying your gamma is huge there because if that stock moves up a point, you're going to see your at the money option that probably has a delta of around 50% go up to a delta of about 93% in this case at 51, meaning that it's saying what's the next point delta going to be from 51 to 52. So if you start to understand this concept, it's saying, holy cow, I could pick up a ton of deltas if I call this right from 50 to 51. The problem, of course, is if you call it wrong and it goes from 50 to 49 here, you're going to see it's going to lose down to what, from 43 down to about 20 delta. So you're going to say, okay, then your option's going to go from a 50 delta down to about a in the teens delta. Okay, so you're going to be in big trouble if you call it wrong. So that's why trend is so important to me to catch that correctly. Now, interestingly enough, gamma, just as a little side note here, when you go out 60 days in purple here on this chart, gamma actually shifts to be peaking slightly out of the money. So around the $49 level, if you were buying a 50 call, you're going to have peak gamma when the stock's about 49. So as the option moves from slightly out of the money to in the money, if you're a more aggressive trader, then that can work for you as well. We tend to not trade these in the final days of an expiration, but we tend to trade gamma in my option shark program for aggressive traders who want to buy cheaper options and look for maybe a little more bang for their buck. But I tend to recommend if you're starting out, start with the in the money options as a more conservative, more giving you more ability to manage your risk and create more of a stock substitute position. And I've got a lot more to share with you. I'm not done yet, don't worry. But basically, before I go, I want to remind you, you can go to the special page I set up for you. If I know I jam a lot in an hour to try to help both new and existing traders have something you can take away from today's session, whether you're just getting started with options or whether you've been trading for a while. When you go to this page, bigtrends.com/trade secrets, you're going to see that I've set up kind of a ridiculously, almost irresistible offer in my view of you get 3 DVDs, which go through in the neighborhood of about 5 hours of content, and you start really learning all the underpinnings of tools like acceleration bands and percent R. And so these top trading systems are defined. You can start to understand them so you know exactly when to get in and, more importantly, when to get out. And so I give you these details in full. And so you'll see when you go to that page, and again, I'll go through this a little bit later at the end, but just quickly, you're going to get all 3 of those courses here, 5 hours, just $49. We also do free shipping in the U.S. If you're overseas, there's a nominal shipping charge, or outside of the U.S. So the bottom line is that 3 of these courses, list price would usually be over $200. I'm offering it to you today for just $49 as part of this educational bonanza that you're getting today. And you're going to have a lot of information to digest by the time you're done with all the sessions. So you need to really ask yourself, if you're interested in learning more about options, this is where we would focus you. These same principles would apply if you trade stocks, Forex, futures. So you could pull that out of here as well. I just do this a lot for people who want to take their trading to the next level with options, because I find that, and you'll see at the bottom of that page, there's a little add to cart button, and you can pop that in there and lock it down for $49 with the free shipping in the U.S. But, I find a lot of people are making too many mistakes with options, and so I really am kind of focused on educating people about the right ways to trade. Now let's get back to the education here. I want to focus for a second on if you're looking for a way to get good leverage but still manage that time risk of a trade, this is where you focus on the in-the-money strategy, what I call the stock substitute strategy. The first rule of thumb is when you buy an option for the stock substitute, why buy the stock when you can lease it with an option, right? But we need to get the right type of option. Buy an option with at least 2/3 of that total premium being what we call intrinsic value. And remember, the intrinsic value is just measured as, okay, how much, if I was just to essentially exercise the option right now, is there any value to that? So I wouldn't recommend you exercise it, but I'm saying if you bought the VZ Jan 30 calls when the stock is trading at 34.10, well, you know that that's worth $4.10 intrinsically. If you have to pay 5 for it, then the remaining 90 cents is time value. So you can quickly do your calculations. 410 divided by the total premium of 5 gives you 82% intrinsic value. That would be a really nice high intrinsic value choice. You might say, well, gee, I'm having to pay more for that option. I'm having to pay $5 or $500 a contract. I could buy a dollar option and get 5 contracts. I think that's a big mistake in thinking. A lot of people get seduced by thinking, I'd like to have a bunch of contracts. I want to be a big roller. Well, that's how big rollers basically go bust, whether in Vegas or in the markets. And you've seen a lot of smart people that have gone belly up by doing overly aggressive things. So what we recommend is I'd rather see you have one contract at 5 to buy the right type of option, because if Verizon doesn't move at 34.10, what's my risk? My risk is my time premium portion, which is 18%. If I'm feeling aggressive and I buy the 35 strike calls, my risk is 100%, if that thing doesn't move. In fact, even if it moves a little bit, that's how a lot of you have lost, by buying the wrong type of option and then not getting enough movement relative to the time that you had to pay for. So, from this perspective, we're looking at, okay, how do we manage, these trades? This is the first key rule of thumb. So I mentioned the S&P. The S&P is bullish right now. This is, like I said, my computer's not pulling up my MetaStock properly right now, so I just wanted to show you some past examples. Here's where the bottom falls out of the S&P back in 2011. This hasn't happened very much over the last several years. But you can see when we were getting the breakdown, in not just percent R at the start of August of 11, but you see it also really breaking underneath that low. The acceleration bands actually led us here. The acceleration bands were kicking in a day ahead, and then the percent R came in right behind it. And then you saw 2 more days of free fall. Even over that couple of days of free fall, it gave you a great opportunity to catch this thing for a quick pop on the downside. Now, if you miss that kind of a move, you're waiting for retest points and looking to hop on that. We'll talk about efficiency as well here in a minute. But bottom line is that, when S&P doesn't have many of those kind of moves usually. You can see it'll be in and it'll be back out fairly quickly. But when it breaks those bands, that's where you need to be very careful. Now, in comparison, when it's trading down to the lower band for one day and then flipping back above, then it traded up to the upper band, these bands acted as generally support and resistance for the S&P pretty well. So I don't tend to trade the daily that often, but if you're in a time where the market's starting to plunge, you need to know how to use put options to protect yourself in that type of an environment. Now, speaking of, if you bought the stock or compared it to a protective put, it's the same kind of a concept. If you're buying a stock or buying a deep in the money call, it gives you the same profile as a protective put, because if you bought a put and nothing happens, that thing doesn't plunge, then you're just going to be out what you put into that option, whether you buy the put or you buy the in the money call. This is like a stock substitute example. You can see in this case, the stock is going to be at $36 at the expiration. We're going to see it basically be a break even. But the leverage, if you paid $400 for it, you can see if it goes from the mid 30s up to, even if it say goes up to the mid 40s, you'd be looking at about a tripler, about 200% profit. If it goes up to about 30%, you'd be looking at about a 300% profit against your 400. So, that's the kind of thing where, the upside potential is much more dramatic versus the capped risk when you just buy an option, whether it's a in the money call or a protective put. So you're opening up a lot of bigger reward potential relative to a lot of smaller risk. And that's important in my experience. You want to make sure that you manage that risk accordingly. A lot of people get seduced into wanting to sell naked options. I think that's a mistake. I don't sell any uncovered or naked option positions, because that's how you can flip this chart upside down and have a limited return and a potentially theoretical unlimited risk. That's very dangerous. So, and you see the break even is essentially just going to be, what you pay for the option and how much time premium you have to make up. So when you're buying an in the money option, you don't have to make up so much time. Also, another unique principle that I like to teach and I like to trade is the closing stop principle, which means that, okay, if you're looking at, how many times you get whipsawed based on intraday noise, and I'm curious, how many of you are trading say a daily chart versus an hourly chart versus even a shorter term chart on an intraday basis. Because what you're going to find is that, if you're trading really short term minute by minute charts, the noise level is extreme. If you're trading, hourlies or dailies, you're going to find that it will minimize some of that noise, but that's where you have to then wait for the close of that bar. Okay, so Brian doing dailies, William does intraday hourlies and 5 minute for entries. And so from this perspective, you're saying, okay, how do we make sure that we make focus on, okay, the really biggest trends without getting noised out. So Evan's using a 5 minute in addition to those longer time frames, which is just make sure that your 5 minute is not too noisy, okay? Because I found that even 5 minutes for me can be a little noisy. And I like, sure, you'll find some good trades, but you have to endure too many of these whipsaws. Whipsaws erode your trading confidence. So on a daily chart, what I would say is at the end of day, if it closes under your key low, you got to get out. So I tell people, even if you can't look at it at the very end of the day, even within the last 15 minutes, if it's below there, go ahead. If it's telling you that it's not holding that key low, by the end of that bar, if you use an hourly chart, wait to the end of each hour, then we would place a market order to exit. Okay, so then we'd blow it out if it violates at the end of the bar. This takes a little bit more effort to implement because you've got to be paying attention. You don't actually put a hard stop in initially, but you know what your number is to the penny. So for example, back in the silver bull run, which it's starting to move up again here recently as well, you see we use not just percent R, but we use tools like the efficiency ratio as well. So percent R resistance was there for a few bars, just starting to break that acceleration band, and then it had that big surge outside there. So there's the confirmed buy at the close back there in mid-February. Now, this is a prior year, of course, but you can see this concept of efficiency, which is also available in the Metastock toolkit. When it goes outside of this upper efficiency boundary as well, that's confirming that you've got a very efficient trend. What does efficiency mean to me? It means that it's making a fairly big move in a fairly compressed period of time. It's not giving back much ground when it gives back. It goes sideways more than down when it pulls back. You can see, sure, this one little move here, it had a brief little pullback, but actually that pullback just set up what we call our next retest. So for the closing stop idea, we're saying, look, if it trades underneath this this key retest low point here, you don't want to panic on that. You want to wait for it to violate on a closing basis. So for example, this at the end of this trend here, there was another retest coming in off of that low, and you wait for that thing to violate, and you see it's actually, even though there's another retest coming in here, my rules, when you learn the percent R rules, say that break to a lower low on a closing basis is telling you got to hop out there or the next bar is open. So of course that's where the CME started tightening their margin requirements, and that's where you got into a situation in which the silver market and the gold market both tanked. So from this perspective, it'll show you when to be in for the bull run, and then it'll show you when you want to hop out. So you're trying to find the sweet spot of that trend. You're not trying to pick exact tops and bottoms. There's a lot of smart traders that have gone to their graves getting blasted trying to pick, where to call a top in an uptrending market. I don't try to do that. I think that's a fool's game. You'd be better off to find a good low-risk entry point within that proven trend. Sure, sometimes that trend's going to break, and you get right back out quickly when that happens. Casey asked about tick charts. That's not what I'm about. Certainly, if you're using tick charts, you're probably going to be looking for ways to fade that noise. I'm not a fader of trends. I'm much more of a trend follower. You can see it took a long time for silver to kick back in here and confirm another buy signal. So it basically kept you out of a dead zone in the stock. And you see when it's trading in between these bands here, you do not want to trade that period as an option buyer. If anything, that's an option seller's potential territory. But again, I'm concerned as an option seller if it's choppy, and then what happens if it breaks out? You can really be exposed even if you're doing a hedge strategy like a credit spread, and you've got to know how to manage that. So from this perspective, obviously we're keying on the key elements that I put into this trade secrets package for you today. It does start with, you've got to get the market timing right, not just on the overall S&P, but we've talked about gold and silver. They're starting to move again. So from that perspective, you need to know how to trade those again. They were dead most of last year, somewhat surprisingly. we traded them pretty much to the downside, even though I was kind of wondering why gold kept dropping. But it's starting to pick up again, and you want to be paying attention to that. The bond market, of course, has been volatile. The TLT is a great vehicle to trade on bonds. Of course, oil and the dollar, other ones you want to keep an eye on. My favorite ETF system, you'll learn how to trade these kind of ETFs with the Trade Secrets package. Top technical indicators, we share with you a couple of my favorites, but we have more in that Trade Secrets package where you can start to learn about these concepts like efficiency and learn then how to apply the best option strategies for any market. Sometimes it's an ideal time to buy an option. Other times you would not want to be buying options if it's stuck in the mud in between those bands. You also get the ability as a buyer of the Trade Secrets package to ask if you're understanding it right. We can't give specific personalized trade advice to any one trader, but we can tell you if you're following the rules correctly based on the % system and the acceleration bands. And so you get a dedicated email that way. So what we found in traders really improving their skills and moving towards mastery is you have to know a lot of pieces of the puzzle to ultimately be a successful trader. That's why so many people have a hard time with it, because they think if I just master my entries and exits, then I'll be set. And that's part of it. That's where the technical indicators come in, right? So you've got to know those, but you also have to know tools like how much capital do you allocate? Because if you over allocate your capital, I don't care how good your system is, you're eventually going to feel some psychological pain. That's going to affect, in addition to financials, and that's going to affect your trading psychology, your ability to stick it out and stay with your system. As you know, the timing is everything, and then ultimately knowing the right option strategy for the different types of option markets kind of goes back to ultimately then knowing yourself. You've got to know what your goals are. We work with a lot of traders here at Big Trends on helping coach them to greater levels of success. So, the bottom line is that, like I said, final points of what we share with you today: don't tie up a lot of capital in stocks when you could be buying in-the-money options as a substitute instead. They are going to cost you a little more than the at or out of the money options, but relative to the stock, they're a lot cheaper. And the key is that they have that good quality intrinsic value. At least 2/3 intrinsic is our core rule. And with options, you'll tend to get what you pay for. If you're going to buy lottery tickets with out-of-the-money options, then you're not going to cash many of those, and you're probably not going to stay with that strategy. So by staying with the intrinsic value strategy, at least 2/3 of the option having intrinsic value will allow you to really follow a lot more like a stock. And you can even use leaps options as well for those longer term trends. So that link that we talked about today is bigtrends.com/trade secrets. As I said, when you go to that page, and then I'll answer a few questions here before we're done. Go to that page, bigtrends.com/trade secrets here, and you'll see that it'll take you ultimately to a secure checkout box. Let me post that one more time for folks. That it gives you 3 different courses on options. One is geared on the systematic trading of options. So how do you automate your option trading? How do you make it to where you can run these scans and ultimately find the right securities to trade your options on? This is really having a more systematic approach to options. High impact option trading is where I introduced acceleration bands. So when you see the speed of movement, you've got to have that speed if you're going to get on the moves that can really dramatically accelerate, not just for the stock, but also for the option value. And then the 7 golden rules of option success. This is more of the psychology of trading, including the top 10 problems that all traders face, whether you trade stocks, options, Forex, futures, and showing you how you can start to understand that. You also start to learn about a tool that I use called option charts that shows me, again, how much my option is starting to move and whether I want to trade that option or not. So, like I said, if you added up all 3 of these courses, more than $200 that you'd pay through the traditional channels. I'm packaging them together because I've got a limited supply of them here left that I can offer as a package for just $49 with just free shipping here in the U.S. Down at the bottom, you'll see actually the tabs. You actually get a little course outline of what's in each of those courses. So you see all the things you're going to learn. 5 hours of content, just $49. Just hit the add to cart button in yellow there. It'll pop up your cart. It'll show you, just if you're in the U.S., just click on that, and it'll keep it there at the $49. There's a nominal shipping charge, $14.95 if you're outside the U.S. And then bottom line is just fill out your information down below, the bolded fields, and hit, once you click on all that, submit the order, you're good to go. So let me go ahead and come back and answer a couple questions and we'll go ahead and wrap it up and hand it back over to Dave so you can intro the next speaker here in a few minutes. But let's just see what questions we've had here. Now Rita says, okay, how old are these and do they discuss weeklies? Actually, we do talk about, the short-term strategy of weekly options. And in fact, Rita, the in-the-money stock substitute strategy is a strategy that to this day I'm still using for all my weekly options trades. Because if you're trading an option on a weekly that's got 7 days of life or less left, then bottom line is you're going to see a situation in which you actually have to be very careful about time decay. Time erosion is really dramatic in the final days before expiration. If you buy a nice in-the-money high delta option, you're going to really reduce the impact of time decay and ultimately go from there. Confi asks, how does the DVDs cover how to find these stocks? Absolutely. The automate your option strategy in particular goes through the scanning that I do in tools like Metastock and others to allow you to find new opportunities. We call that our toolkit, Big Trends toolkit for Metastock or for some of these other key platforms. We're talking more about the options buying there, Rita. We're not focusing so much on all the different spread strategies. You can get that through other Big Trends training on more advanced Big Trends option strategies. But here, this is more of an introduction to simple but effective ways. This is the KISS principle stuff, folks. Keep it simple. You don't want to try to be too high tech and end up messing yourself up on otherwise good trends. Couple other questions here. E says, no idea about option trading. Will this help you to start option trading? Absolutely. So we lay down a lot of the core fundamentals, so you start to learn about what options are about, what are some of the key factors in your success on options. And so from that perspective, and if you have any questions, Trevor said he was having trouble getting his order through, but basically it's just bigtrends.com/trade secrets with an S. So make sure that you go there. Now, do you have to use Metastock, Haley says, to allow the trade secrets to work for you? Of course not. Metastock has been a loyal partner here with Big Trends, so we like to remind people that, hey, they're one of my favorite places to go to run these scans, to find these new opportunities. But you can certainly do this yourself on other platforms. It's just kind of how much time do you want to invest kind of digging out those needles in the haystack versus having a good sorting and filtering tool and software to do that. So, from this perspective, you'll find some tools, of course, %Rs on most of the platforms. Larry Williams developed that. Just make sure you make my tweaks to it that I shared with you earlier so that you're really focusing yourself on how to find these meaningful moves. Because if you'd still leave it on too short term of a setting, it'll be too noisy and it'll start whipsawing. You'll go, what was Headley talking about? This thing's too noisy. You've got to stretch that time frame out like we talked about earlier. The acceleration bands, like I said, that's a takeoff point. Like we showed you that space shuttle taking off. If that thing doesn't have enough fuel behind it, that's not going to get into orbit and start coasting. It's going to come back to Earth. You want stocks that are coasting on their own momentum. You don't want to have them be too slow. A couple of other questions. The toolkit is a separate purchase Confi, so we're just focusing today on the trade secrets education. So here it's just for 49 bucks. It's just saying, hey, get yourself pointed in the right direction. If you're not, you're going to basically be lost in the wilderness still. It took me probably a good several years, and when I started trading, even though part of my problem was I went to Duke University and basically thought I knew it all coming out of that and figured I'd done all the great research. And I had a problem with perfectionism. Let me be frank about it. I was having a problem taking my losses. One of the big lessons that we teach you throughout these programs is that when you take your losses properly, the winners over time will help you more than offset that. And again, you can't guarantee any one trade or even any sequence of trades, but you can say that if you follow it over time and don't over allocate your capital, if you stay small in any of the trades you do, hey, even start in paper trade first to build some confidence that you're on the right track, get the proper education here, and that'll really point you in the right direction and point you down an effective path to help you not only build your portfolio, but also to help you start learning how to manage your risk better, how to know when your portfolio is at risk, how to know when you want to hedge. And, for 5 hours for $49, I can't make it any more attractive than that. So like we said, you're going to learn all these things and scroll down to the bottom of the page there at bigtrends.com/trade secrets. And we're here to help. Now, my hour is up. If you have other questions, you can certainly call us at 800 Big Trends or drop us an email through clientcare@bigtrends.com. We're here to help you on your path to building your trading knowledge and ultimately helping you learn while you earn. Lori said, what order should you watch the DVDs? Well, remember, it depends kind of what you're interested in focusing on. I mean, they're each standalone courses, but they kind of go nicely together because you've got the trading system, the indicators, and the psychology, and 1, 2, and 3 there. So whichever, we've got them pretty much in order of how I would do them, from the automate to the high impact to the 7 golden rules and the psychology, but whatever suits you and what you need to work on there. Now, my hour is up, so I need to hand it back over to Dave. I want to thank you for being with us. Just make sure you go to bigtrends.com/trade secrets. Check it out. You're not going to see these out there too long, but when they sell out, they'll be gone. We're not going to have any more of them. So do make sure to take advantage of it, or call us at 800 Big Trends if you have any questions along the way. And thanks for being with us. A great feedback and a lot of great questions. I enjoy the rest of the day with a lot of great presenters. Let me hand it back over to Dave so you can intro our next presenter.
Right. So let's have let's play a little theme song. Right? Gotta have a little theme song. All right, so now that I've woken you up a little bit, I am supposed to be talking about how to risk 156 to potentially make $1,000. I always have to say potentially because I'm registered by the CFTC and the NFA, and if I don't say potentially, they could potentially fine me, and that would be painful, or they could potentially put me in prison with Bubba, and I don't think I would do well in prison with Bubba. So I always say potentially on everything. I can do a couple of different things here. I've got about an hour to talk to you. I can either teach you how to risk 156 to potentially make 1,000, or I can show you, and I do this topic a lot, right? So I will take your vote from the audience because I know that's what I'm supposed to be here to talk about. But there's also a really good setup in gold right now too. I can either do one in really, really detail, or I can try to teach you two really quickly, and I'm not sure how that'll work. So what would you guys like to do? It's kind of weird, right? Like 156 to 1,000? 156 to 1,000 going once, going twice. Two really quickly, both? All right, so let's do this. So I will try to do both of them fairly quickly in detail. All that was going to be required is I just have to skip all my crazy past and history of being dirt poor and coming up and making $1 million and then losing it and then making it again back and all that stuff. And I don't get to show you. Well, first let's do the disclaimer. Let me do the disclaimer and then we'll have some fun. Warning, you're probably going to lose all your money trying to figure out how to trade. Does everybody understand? You should never trade with more money than you can afford to lose because it's dangerous endeavor in what we do. Only trade with risk capital. You should never pay attention to me. I don't know what I'm doing. I don't even know what I'm talking about. Does everybody understand? Give me a visual yes, and I've got the disclaimer covered. It's your trading career in life is probably going to be destroyed because you want to trade. It's going to end like a bad country song. In reverse, your wife's going to leave you. Your kids are going to hate you. They're going to take your dog and your truck. All right, so I'm going to skip all of my name, no BS approach to trading and investing. My name's Hubert Sinners. I'm going to skip showing you pictures of me with super famous and wealthy people because we don't have enough time to go over me with super famous and wealthy people. So we're going to skip that. We're going to skip the one-eyed dog. All right. And what we're going to do is we're going to get right into the setup. All right. Right into the meat. So before we do that, I do have to tell you that this trade setup is terrible. And by terrible, I mean it does not work very often. It only works 3 times out of 10 or 4 times out of 10, which in your mind, you're probably going, man, it's terrible. Why would I want to do a trade that works only 3 or 4 times out of 10? That makes no sense. I mean, I thought you were going to teach me something useful. Well, let's do the math really quickly. And if we do the math and we go, if we have, and we're going to do, this is an example of a series of something that where we're going to do a series of 10 trades, okay? So if we're doing 10 trades, we're going to say that 6 of them lost us money for $156, so we lost $963. Then we're going to say that we come along here And then the trade then has 4 winning trades that make us $1,000. That's 4,000. And the math breaks down to you made 3,064 bucks. Okay? Does that make sense? So even though it only worked 4 times out of 10, the risk to reward ratio is insanely in your favor. Okay? So let's say it's worse. Let's say, okay, well, that's not too bad. Let's say it's worse. Let's say this thing only works 3 times out of 10. You're going to have 7 losing trades. So you're going to lose $156 and you're going to come up negative $1,092. But you've got these 3 winners over here on your side where you made 3,000. So you're going to come out on the top side of 1908. So that's not too bad. So even though the trade is terrible as far as like percentage of wins over losses, the risk to reward is definitely in your favor, so you should be okay. Does everybody understand that? Of why we're risking 156 to make 1,000. So we're going to be able to donate to the market little loss, little loss, little loss, little loss, little loss, big old win. Okay? The trade is designed on purpose to try to get you from these stages, from losing massive amounts of money to then learning how to lose small amounts of money, then to a lot of people get stuck right here, oddly enough, in the tread water stage where you learn how to make a little money, lose a little money, or you make a lot of money and lose a little bit of money. And this trade is designed to hopefully help you get to stage 4 where you consistently start making some cash flow. Now, making a killing, it's asterisks because I don't want to go to prison. Potentially make a killing, depends on who you are and what you're doing. And like I said, this trade is designed not to do this. We're not gonna do this and take a big old massive loss and then have a little winner. This is a crazy way to trade. Little winner, little winner, little winner, huge loss. We're not going to do that. What we're going to do is we're going to have a bunch of little losses, okay, and then we're going to have one big winner, and then we're going to have a series of little losses, and then boom, we're going to have a big winner again. So that's what this is designed to do, okay? So there is a story that I like to tell about Aesop's fable. I'm going to skip the story for your benefit so that I can teach you more trading stuff. All right, so I'm going to skip why bonds are good to trade and how E-minis are terrible and all that good stuff, because you're usually going to get chopped up in the E-minis because let's just do this. I'll do a short variation of this. A lot of people trade the E-minis because they do this right here. They ask people like, okay, what market should I trade? And everybody trades the E-minis and they trade them. And then they trade them for a little bit. They get chopped up. And then they figure out, oh, my God, this is a terrible market to trade. The E-minis act like this. They go run, stop, reverse, run, stop, reverse, run, stop, reverse. Breakaway. Oh, psych, got you. Run, stop, reverse, run, stop, reverse, run, stop, reverse. Anybody experience this? Only everybody that trades E-minis experiences. They only trend about 20% of the time. 80% of the time, they do this garbage. Now, the bond market does this. The bond market goes up, retrace, up, retrace, up, retrace, up, and then it retraces hard. And then the gold market acts like this. Gold market goes up, consolidation, up, consolidation, up, consolidation. Okay, now I'm going to come get you. So these markets over here are a little bit easier to trade. So I'm going to skip all the story of why I think you should trade bonds and why you should trade something that fits your personality and style, because I'm going to try to teach you 2 trade setups that are going to make you money. So what we're going to do is we're going to get right into the bond trading basics, the boot camp of bonds, okay? So bonds trade, I am going to go over a little bit of the months because it's important for you to know the basics of bonds if you've never traded bonds. Bonds trade in March, June, Sep, Dec, just like the index futures. And here's how this trade works out. And if you want to know more about this trade setup, I'll teach you in detail. At 6 p.m., the bond market opens up. At 5 p.m., it closes. So it's opened up for 23 hours. The open outcry opens at 8:30 and then closes at 3 o'clock. This is what you need to know about the bond markets. I'm skipping right to the meat. I've never done this before, so this is going to work out really good for you because you're going to get 2 trades for the price of 1. Can everybody see this snapshot that you're looking at? It looks like a matrix or a depth of market or a dome. Everybody looking at it? Pay attention because I'm skipping all the fluff today. We're going right to the meat. This is how bonds work. They trade at 135 and 0.30 seconds, which would be 135. If it goes from 135 and 1/32, then that means that you're going to make $31.25. If it goes to 135 and 2/30 seconds, then that means you're going to make 62.50. You see that? So if you were long the bonds right here, LONG, and you went long and it went from 135 to 135 and 130 seconds, you would make $31.25. If you go from 135 all the way up here to 136, that's called 1 full point, and that would be considered 32.30 seconds. Now, I sucked in math in high school and in college. I was terrible at it. I mean, C's and D's. This is a little bit of fractions. It's not that hard. If you can add and subtract, you can do this. So 135 to 136 would be 32.30 seconds. How much money would you make if you were long from 135 all the way up to 136? How much money would you make if you were right on the trade? What's the minimum size I can trade? The minimum size you can trade would be one lot, would be one contract. It's kind of like trading one share of stock. So yeah, it'd be $1,000 because you'd be $31.25 times 32. Who's going to give you $1,000? Yeah, all right, exactly. Come on, it says 1,000 points, right? Pay attention. All right, so this is the way it looks at on different platforms, and what I'm talking about is the 30-year bond. Okay, the 30-year bond. There's also a thing called the 10-year note. There's a 5-year note, and there's a 2-year note. I'm talking about the 30-year bond. Okay. On your platform, it'll look like this: 131 and 31.30 seconds, and you go from 131 to 132. That's how this platform shows you it where you can trade. Now this platform over here goes 133.12, and what it means is 0.12 is 12.30 seconds. 0.13 means 13.30 seconds. 0.14 means 14.30 seconds. Okay, so let's get into the meat of why you want to do this trade. Number one, the reason we're going to do this 8-tick reversal trade, and this is called an 8-tick, a 12-tick, or a 16-tick reversal trade. Now, there are some advantages and disadvantages of trading bonds at night, but since I'm going to show you not only the bond trade, but a gold trade, I'm going to skip some of that, okay? And it's not that it's not important, it's just that I can cover it at a different time. So the personality of the bond market moves like this: 8-tick reversal and 16-tick reversal. I trade this one and I trade this one. Here's the notes. How much do I need to trade one lot? If you're trading it overnight, you need about $3 grand. If you're trading intraday, you need about $500. So the way the bond market works is if the bond market's range in a day is usually the average true range for the bond market is about 1.15. So for the 30-year bond, if we move 15 ticks or less in a day, then I'm going to do an 8-tick reversal. If we move greater than 32 ticks, I'm going to use a 16-tick reversal. Here's what I mean by that. Let's say the bonds like to go up, and then they like to retrace. They usually retrace 8 ticks, and then they continue on their merry way. And then they retrace 8 ticks, and then they continue on their merry way. Now, I wish it was that easy every day. It's just not, okay? It's just not that easy, but it does happen a lot. Now, if they there's 3 different depths that they like to kind of probe. It's an 8-tick, or a 12-tick, or it's a 16-tick. So those are the 3 type of days that you're going to have on a bond market, okay, on a 30-year bond. I prefer the 8, and I prefer the 16. I don't usually mess with the 12 because it's so daggone hard to trade. So if the bond market has moved 15 ticks or less, then I'm going to try to buy it every time it pulls back 8 ticks. And I'm going to use a 5-tick stop loss, and I'm going to use a 32-tick target. Now, if the bond market has moved more than 1 full point, which is 32 ticks, then I'm going to let it go up a full point, then I'm going to let it retrace 16 ticks, and I'm going to buy it and let it continue on its merry way. Does that make sense? Now, the way that the bonds work, how they work is you have the bond market. It will normally move in waves, and it's really, really fairly easy to trade, in my opinion, compared to the E-minis. And like I said, it'll go like this: up, pull back, up, pull back, up, pull back, up, and then it retraces. Is this being recorded so I can rewatch it? Yes. The coffee isn't kicked in. Yes, we are recording this, so you should be solid. All right, so now let's get into the meat of the presentation. What we're going to do is we are going to first figure out what the daily trend of the bond market is. So here's where you need to take notes. Rule number one, the daily trend of the bonds. If you are in a daily uptrend, you're going to focus on the long side. If you're in a daily downtrend, you're going to focus on the short side. And then what you're going to do is if you're in a daily uptrend, you're going to let it pull back to you on either an 8 tick, a 12 tick, or a 16 tick. And I already gave you the rules for the filter for that. What is the bond's ATR? The bond's ATR is 1.15. And then what you're going to do is you're going to place a trade with a 5 tick stop loss. I write like a doctor. And then your target T-A-R-G-E-T, is going to be 32 ticks. So let's go through an example. So I'm going to skip the math again because you guys already know the math. Before we get started, it's very important for you to know that not all of these trades are going to work out the exact same way every time. So what does this mean if I short it here and I cover it here? Does anybody know what that's called in trading? What's that called? If you short something low and you cover it high, what happens to your P&L? No. If I short something low, there you go, loss. There you go. It's called a loss. So in this trade, I lost $156 on this first one. What happens here when I short it here and then cover it here? Well, that's another loss of 156. So that's awesome. So then I've got the daily downtrend pegged as like, all right, this is a downtrend. I want to short this. Nope. Short this. Nope. And then here at 6 o'clock, I put the trade on again. I go, okay, I'm going to let the market sell off. I'm going to short it when it bounces up 8 ticks for me right here. And then I'm going to short it here. And then when I cover it lower than I shorted it, then what's that called? So if I short it here and cover it here, there you go, winner, winner, chicken dinner. And that's $1,000 profit. So if you whip out your calendar, or not your calendar, I guess you could whip out your calendar. You whip out your calculator, and you could say, okay, what's that math come to? 156, we'll just say 300, we'll just round, minus 7, minus the 1,000, so we're going to make close to $700, right? It's a gain over 3 trades. So let me show you the rules for this trade setup. Then we'll go into the gold market. All right. So the first rule is you got to figure out overall what is the daily trend in the 30-year bond. In the 30-year bond, we were in a massive uptrend. Do you see this trend line? And when we broke this right here, we're going to pretend that we are now in a daily downtrend. So we're going to want to short that thing, okay? So does everybody agree that we're in a daily downtrend in this example on PowerPoint? Because I'm using PowerPoint, I'll show you exactly what the trend is here in live charts in just a second. So we're going to say that we're in a daily downtrend because we broke this uptrend line and it's massive short to the downside. Then what we're going to do is, since we now know that the daily is in a daily downtrend, we want to short bounces of 8 ticks. So this trade I actually do at night. I wait until the bond market opens up at 6 p.m. East Coast time zone. The reason I do that is because I can stay in this trade for almost 23 hours and it still be considered an intraday trade if I initiate the trade after 6 o'clock. Okay, so here at 6 o'clock, I let the market open up. I still believe it's in a daily downtrend because my analysis tells me I'm on a daily downtrend. I let the market sell off. It bounces off of this low up 8 ticks, and then I short that with a 5 tick stop loss and a 32 tick target. Okay, now if I would have missed this one, I've got this one to play with. If I would have missed that one, I've got this one to play with. This one wouldn't have worked because it wouldn't have been 8 ticks. I could have played with this one, but I would have got stopped out on it because it retraced more than 8 ticks on me there. So let's go in a little bit more detail. So number one, daily downtrend. When you say daily downtrend, do you mean long-term or short-term trend? It depends on what trend you're in right now. Right now, on this example, we're going to say we're in a trend on the daily is lower on our example. But I'll show you a live example on charts here in just a second. Does everyone see the open here at 6 p.m.? Okay, we're going to open up. We've got the bonds pegged as going lower because our daily trend is down. We've broken, so we're going to let it open up. And you can see it initially breaks to the high side. Do we want to trade the long side when we're in a daily downtrend? Yes or no? No, right? Right. You always use a 5 minute. It doesn't matter what time frame you use. It doesn't have anything to do with the time frame at all. So then we're going to sell off. It puts in that low. Now, how do I know that's the low on that day or in that after hours trade? I don't. If it would have went lower, I would have drawn a line lower. Okay. And I said, okay, there's a low. It's bouncing. All right. So that low right now is 146 and 4/30 seconds. So 4 plus 8 is what? This is where your math skills come in. 4 plus 8 is 12, which is right here. So I'm going to have a sell stop placed. So if it bounces up to 146 and 12/30 seconds, it's automatically going to short that for me, and it's going to place me a stop loss of 5 ticks at 146 and 17/30 seconds. My entry is right here, and then it also placed at the same time that it placed my stop, it placed my target right here at 145 and 12/30 seconds, right? Because I entered it at 146 and 12/30 seconds. My target is 145 and 12/30 seconds. What time frame do you find the low? I usually use a 1 minute chart for it, but a 5 minute shows up really good in PowerPoint, so it makes it pretty. Now, like I said, if I would have missed that first one, I know what you're saying is like, well, that's probably just only happens once. Well, look, there's an 8 tick bounce. Here's an 8 tick bounce. Here's an 8 tick bounce. This one right here didn't qualify because it didn't mount its 8 ticks. Here's an 8 tick bounce, but this one wouldn't work. I mean, it would work. We would get a fill on it, but we would get stopped out on it overnight too, right? Now, notice that I entered this trade right here at this time, and then I didn't liquidate it until the next morning. The reason this trade works really good is because I'm in bed and I can't mess with it. Okay? I can't mess with it at all because I'm sleeping while this is taking place. So I can't be in the trade and go, oh, great, I'm up $500. Take it off. No. Oh, I'm up $700. No. Oh, okay. Oh, now I'm only up $300. Daggone it, I should jump out of it because it's turning around on me. Oh, now I'm only up $700. I should get out of it. So the reason this trade works so well is because it takes me, my mental psychology, my trading psychology, it takes me out of the game to where I can't jump out prematurely. Does anybody in here suffer from premature profit taking? It's a dreaded disease. I wish there was a pill for it. Premature profit taking. It's deadly on your account. You're like premature profit taking. It's almost like you could almost do a commercial for like Cialis or what's the other pill that they do? Viagra. Does anybody suffer from premature? It's a prevalent disease amongst traders. I wish there was a fix for it. The best experience and fix for it that I know is plan your trade, and then trade your plan. Okay. In other words, once you figured out what your trade plan is, stick to it no matter what. Don't modify it much. Do you offer software? Do you offer software to manage the trade? I build indicators that'll identify this trade for you. Yeah, it is a terminal disease. Yes, it is. So, and as you can see, the very next morning when I wake up, that the trade's going in my favor, I wake up, and then what I do is I trailed the stop down because I was risking 156, and I could see, okay, I'm up pretty good. I'm going to trail the stop down to lock in $375, and then in the next 2 seconds after I took this screenshot, I made $1,000 on the trade setup. So how many minutes do you wait for the low? I'll start looking at the trade at about 7 p.m. at night and see if I can do it. Is there a time for entry trade on the bonds like there is gold? No, just any time after 6. I would say I start looking at it about 7 p.m. Any questions on the overnight bond trade, the 8 tick reversal? Any questions? It's a pretty simple trade setup. It's not hard to do. You just kind of got to know the rules. How do you use a trailing stop at night? I don't, because I'm in bed. I just leave a 5 tick stop loss. The 5 ticks, which is going to risk $156.25. That's the risk when I'm in bed asleep. When I wake up in the morning, I'll manually move it. How did you come up with the 8, 12, and 16 ticks? I just basically made them up. No, I just looked at the bond market and just I would notice that they kind of move in those impulse waves. East time zone, right? Yes, East time zones. Yeah, the bond market opens up at 6 p.m. at night, and it'll trade all the way until the next day until what is it, 5:15 or something like that. So yeah. When to use a 16 tick reversal? I would use a 16 tick reversal. So in other words, you see how the bonds have moved here from like 146 all the way down to 145, 145 and 20. Like that's a full point move right there from this to this. So after they would moved here, then instead of doing an 8 tick reversal to the high side, I would then wait for it to bounce 16 ticks and then I would reshort it. You're using a 24-hour time frame. Yes. Does MT4 platform use ticks? MT4 is for Forex traders, not usually for futures traders, but they should use it, yeah. So the frequency of the trade is daily. So let's go through an example here with some live charts. You guys want to do that? I'll get out of PowerPoint here. Let's go discard. Let me show you what this looks like on a bond chart. So first, let's go over here and figure out what bond we're going to trade, because that's kind of important. So you can see here you've got a wide selection of bonds. So you got U.S. We want to trade the U.S. H14, right? You can see it opens up at 6, closes at 5. It's $1,000 a point. Each tick is going to be 1/32. You see how this works? 133, 330 seconds, 133, 430 seconds. And now I've got a 1 minute chart here, okay? So on a 1 minute chart, so the first thing you do on this rule is you got to figure out where the bonds are at US. On the bonds right now, the bonds are actually in a decent little uptrend because they're above the cloud, and they've broken above this upward trend line here at 130, 132 and 31/32 seconds. So we're going to pretend that bonds are in an uptrend, okay? They're consolidating sideways for the past 1, 2, 3, 4 days, but they're in a solid uptrend right now. So what we're going to do is we're going to go over here to the Trade It tab, and we're going to say, okay, bonds, I believe you to be in an uptrend. And as you can see on Friday, they were. Now this is a 1 minute chart. You see how methodical bonds trade? It looks like they're real thin, right? They're not thin. They're one of the thickest markets out there in the world to trade. What's that right there? Do you see that trade right there? Let me show you what I'll do. I'll make my life easier, and I will use an indicator that we have built. And if this was that most recent high at 132 and 29/30 seconds, watch how you do this. So if you stink at math, just cheat. Use a calculator. 29 minus 8 equals what? It'd be 21. Is that correct? So you can do this trade intraday or overnight. So that we're going to say it's 21. So what we would do is, based upon that, is we would have a buy down here at 21. Okay. Now, if that's our high right here, that's our high, then we would have a buy stop here at 132 and 21. Did we get filled on the trade? Nope, we didn't. So there would be no fill on that trade. That's how that would work, though. Okay, if you had an 8 tick reversal off of this most recent high, that's how you calculate it. You do it the same way. Let's say this was your high that you were looking at. All right, that's 3/30 seconds. Then you'd have to do it 8 ticks lower in order to get your fill. Okay. Now, if you don't want to do that, there's a couple other ways you can do it. If you don't like doing math on the fly, let's say that you know that the high for the bond market here is 133 and 6/30 seconds, and just go 1, 2, 3, 4, 5, 6, 7, 8, and you could buy it at 30 seconds. So in this example, what we're doing is we're looking at this most recent high on the bonds, which was right here. Okay. And that would be right there. You see where it's at 6:30 seconds. That's the high. You'd say, okay, that's the high. I need it to pull back 8 ticks so I can get long it. So you'd go 6, 1, 2, 3, 4, 5, 6. So 33. So you could just do like that. You're going to go 6, 1, 2, 3, 4, 5, 6, 7, 8. 8 ticks. So it'd be 132 and 30 seconds. Does that make sense? Now, I like making indicators because it makes my life easier. So I have my team build stuff for me like this. So what I'll do is I'll go right click, I'll go insert analysis technique, and then I'll find my retracement line indicator, and I'll put it on there, and I'll say, okay, on the bond market, I've got the bond market overall direction. I want it to be +1. Okay, I want it to be 1. So, okay, so now all I have to do is now my life is a lot easier. I no longer have to add, subtract, or do anything. I can just put the indicator on the chart and click where I think the high and the low is. And what I'll do is I'll click right here and go Control, click. See how that works? So I can go, boom, there's my entry, there's my target. So this is an 8 tick, this is a 12 tick, and then this is a 16 tick. You see how cool that is? So I'll do stuff like that just because it'll make my life easier. So that would be the most recent high, and I know it needs to pull back to 132 and 30 seconds. I would enter it here. Here's my stop loss, and then there's my target. Now that trade has not came. That trade is not real yet, right? Because it hasn't pulled all the way back there. So if I want to delete it, I just come in here and go right click, delete, and I just delete that off. And I can delete it off at any time. I can add more of them to it, or I can delete them off. So that's how it works. So that is the overnight bond. You can also use it for intraday. And if you don't want to use a 1 minute time frame because you think it looks a little freaky, you can always just use a 5 minute. I'm fine with that too. It doesn't really matter what you use time frame wise. What you're looking for is to establish an uptrend or a downtrend in the bond market. Once you have that established, then you would then look for those high water marks. And let's do this again. I'll do retracement lines. I'll add it on here. So let's see if we can find one that would have worked Friday intraday session. Dink. So on that one, you had a pullback here. Now that's a short setup, so we need to modify the indicator. So what you would do is you go like this. Once we apply the indicator, insert analysis technique. Can use tape reading for bonds. You most definitely can use tape reading for bonds. You can use tape reading on everything. I think the direction is up 1. In other words, I think the bond market is up, so I go +1 so that the indicator will work for the right proportions, and then I go ding right there. So in that situation, on this one, that was an uptrend. My entry was right here, and my stop loss was right there. So intraday, if I did that physical trade right there, I would have lost $156. Second one I would be looking for is this one, and now this one. So now the overnight session, when I'm looking at it, when it opens up at 6 o'clock again, so here's where it opens up at 6 o'clock. Okay, so you take a 6 o'clock open, and then you pull it back 8 ticks, and then it pops higher. What if it's in a downtrend? How do you do it then? You just reverse everything. So if you think it's in a downtrend, all you would do is you just go like this. You'd go, okay, if I think it's in a downtrend, you'd go right click, insert analysis technique. I would go retracement lines, and then I would say it's a short, and I would go, okay, I think it's a short. So what I would do is I would go, okay, I would just click down here, and then my entries and my targets and stops are just reverse. It's the exact same way long and short. Do you need special permission from your broker to trade bonds like you do options? You just need permission to trade futures. If you can trade futures, you can trade bonds. It usually doesn't require any special permission. If you can trade futures, it's all just one big happy futures family. It's usually how most people work it. All right. Any questions on the overnight bond trade for the 8-tick reversal? So it's a +8. So it's a +8 on a downtrend. So yeah. So if you're in a downtrend, the bonds will bounce up 8 ticks. Exactly. Why did you choose bonds over options or futures? Okay, so bonds are a future. I trade everything. I trade if Tic Tacs and toothpicks. If there was a market on it and I thought I could make money on it, I would trade it. So I trade stocks, options, futures, forex, currencies, bonds, gold. I trade everything. I'm just trying to show you a good trade that you can do in bonds. I think a lot of people should trade more bonds because it's a very easy market, in my opinion, to trade. Now, I don't mean to blow smoke up your ear and say you're going to make $1 million out of 5,000. You could. It's almost impossible, but it's a really good market to cut your teeth on because it moves so slow and methodical, and you could risk a very small amount of money to make a larger amount of money. How do you find Forex compared to bonds? I think bonds are easier to trade than Forex. So second trade setup, let's take a look at gold. I'm going to teach you a gold trade setup really quick. I got about 20 minutes to teach you that. Let's take a look at the gold market. So any questions on the bond trade that I just showed you? Like I said, I'm trying to teach you 2 in the span of an hour. I usually only teach 1 in an hour. So right now the current contract on gold is GCJ14. Okay? So GCJ14, let's talk about how gold trades. It opens up at 6, closes at 5:15. It's $100 a point. It moves in 10-cent increments. Those 10-cent increments are going to be worth $10. Does everybody understand? This is just another market, okay? The bond market traded like this that you just looked at. The bond market traded like this. USH14 opens at 6, closes at 5. It's $1,000 a point. It moves in 30 seconds. That's going to make or lose you $31.25. We come down here to gold. We say, okay, what's the current contract in gold? It's GCJ14. It's the April contract. It opens up at 6, closes at 5:15. It's $100 a point, moves in 10-cent increments, and it's $10. So here's what this looks like. So this is a trade that I'm in gold right now. So I entered this trade in gold at 1302.80, and you can see where it went up to 1302.90. I made $10 because I was long. When it went up to 1303 even, I made 3 ticks, so I made $30. When it went up to 1303.3020, I made 4 ticks, 40 cents. So what I'm doing there now is I made $40. Does that make sense? I can't find USH14 on TOS. Just do /ZB, John B, /ZB. TOS calls it ZB instead of US. Okay. Now, I've locked in profit here on my trailing stop. I originally on this trade risked only $100 on this trade. That was my initial stop loss. I have then since moved my stop loss up to 1307. So I've locked in 420. And now this trade is in my favor. How many points up as of right now am I up on this trade by looking at the P&L? How many points? If you know how the gold market works, how many points am I up on this trade right now? Yeah, I'm up 23 points and 2 ticks. Right. Now, I'm going to make $6,000 on this trade is what I'm going for. Here's what's going to actually happen. I am either going to make $6,000 or I'm going to make 420. And obviously, as it goes higher, I'll be trailing the stop a little bit higher. But I'm using a very loose trailing stop because I want gold to have the opportunity to bounce around 18 points a day. And gold's average true range is about 18 points. What is the overnight requirement to hold a position in gold? It's different for every broker. You need to call your broker. So let's go through the good night gold trade. The good night gold trade, here are the rules. Number 1, you have to figure out at GC what type of trend that gold is in. So since gold is 1, 2, 3 bars above the cloud here, and the lagging line is also above the cloud, we are going to say that gold is in a long position. It's very bullish in nature right now. Okay? It's in an uptrend. It's above the Ichimoku cloud. The lagging line is also above the cloud. We have a confirmation that gold is in an uptrend, and it could potentially go to $1,500. So I want to be long gold. Now, here's where it gets complicated, so pay attention. This is very, very important. On gold, I'm going to write on the chart so this makes sense. There's 2 different times that you have to pay attention to gold. The first time is 130. Well, the first rule, daily uptrend. We've got that covered with here and here. Number 2, you're going to look at the price at 1:30 p.m. East Coast time. And number 3, you're going to look at the price action at 11:30 p.m. East Coast time. That is terrible. I'm going to start that over. That looks like a child writing with a crayon. Let's do that one more time. Rule number 1, class. You're looking at a daily trend. Trend. That's a little better. Number 2, you're going to look at after you figure out the daily trend, whether it's up or down, then what you're going to do is you're going to look at the gold settlement that happens at 1:30 p.m. East Coast time zone. And then point 3, you're going to look at where the gold is trading at 11:30 p.m. East Coast time on the same day. And point 4, if we're going to pretend that it's in an uptrend because it is. If at 11:30, if you are up more than +3 from the 1:30 p.m. EST settlement price, then you will get long gold. Now, I use anywhere from a 1-point stop to a 10-point stop. I would say my average stop loss on gold is 6 points. So I usually risk about $600 to try to make 6,000. So that's a good risk to reward trade setup. In this example, I've only risked 100 though. Color lines, blue, orange, doesn't matter when they cross. I've got a whole class on Ichimoku. I just don't have enough time to teach Ichimoku today. What's the difference between trading GC versus GLD? GC is a little cleaner. And the gold futures jump around a little bit more than GLD does. And you can't trade GLD at night, so you can't do this trade at night. You'd have to do it in the gold market. How did you know to buy gold at 1302? The gold fairy visits me every night at 11:30 and whispers in my ear, get long gold, get long gold. That's how I know. But it's really just by using the secret gold fairy formula here. So the secret gold fairy formula is the stops and targets. Stops are usually 6 points, which equals $600. And then the targets are either plus 20, plus 40, or plus 60. Okay? And I usually go for the plus 60. So let's go through an example really quick. I'm going to go back over here to the Trade It tab. All right. Yes, tape reading can be used on all futures, but in the after hours, it's kind of hard, though, because it's a lot thinner. All right, so the first thing we're going to do is we're going to look for the 130 close. So I'm going to make it a 1-minute chart. Ding, ding. All right, 1-minute chart on Friday. All right, so we're going to pretend you can't do this trade on Friday because you got the weekend. So you're going to do this trade Sunday night through Thursday night, okay? But we're going to pretend that this price action right here is Thursday night's price action, okay? Do you see this right here? This is 1:30 p.m. East Coast time zone. I only have 10 minutes, so I got to go fast. Does everybody see this is 1:30? And that's a 1-minute chart, and that's the close of gold at 1:30. You see that? So this is the 1:30 p.m. East Coast. This is called the gold settlement. Gold settled at 1323.70. Okay. Now, let's fast forward to the future. Let's fast forward and let's pretend that this right here at 1326, let's pretend that this right here is 11:30 at night. Well, we need, in order to do this trade, since we've got, number one, we've got gold in an uptrend, so we want to focus on the longs only. We need it to be 3 points above 1323.70, which would be, if you add 3 to this, right, this would be 13, what would it be? 26.70. So I would need it to be 1326.70 right here. It'd have to be 1326.70 in order for me to get long at 11:30. Why 11:30? That's when the gold fairies come calling. I don't know why. It's just always 11:30. The reason I do it at 11:30 is because you've got a lot of European markets opening up at the time. So gold will start ramping up around 11:30 at night, and it'll continue its overall trend. So that's why I do it at 11:30. So the bus just starts moving really slow, so I jump on the bus before it starts moving really fast. Does that make sense for the gold trade, guys? So daily uptrend is up. The settlement at 1:30 p.m. East Coast time during the day when the pit closes. Then I look at it at 11:30 at night and go, well, gold's in a daily uptrend. I need gold at 11:30 at night to be up more than 3 points so I can go long because it's in a good uptrend. Here's why this trade works. This is how gold trades. It goes up and consolidates, up and consolidates, up and consolidates, and then it retraces. And you can see that right here. Look, I'm not making it up. Up, consolidation, up, consolidation, up, consolidation, up, consolidation. Then what do it do? Pulls back. As opposed to the E-minis that go run, stop, reverse, run, stop, reverse, run, stop, reverse. So it's just a little bit more poppy and trendy in nature. Now, like I said, I build indicators for everything I do just because it makes my life easier. So what I do is for the Goodnight Gold, I've got an indicator, and you can see right here on this trade setup, you see where it says long at 1305.90. Get long right here. Place your stop right here. There's your target 1. There's your target 2. There's your target 3. So that just makes my life easier. At 11:30, this thing populates. Same count in the down direction. That's right. Both trades that I taught you today, both the The 8-tick reversal in bonds and the good night trade in gold both thought the European session starts at 3 a.m. Yeah, it does. That's the reason I get in at 11:30, Carlos, because I just get in it right before the European session. But you also had Sydney, Tokyo, Hong Kong, and Moscow open up before London does. You know, Sydney right now it's 4 o'clock, Tokyo it's 2, Hong Kong it's 1, Moscow it's 8 o'clock, and London it's what, 5 o'clock right now. So yeah, so that's why I'm doing it. I'm already taking into effect Sydney, Tokyo, Hong Kong, and Moscow, and London that opens up at that. Hubert, are you a millionaire yet? You have a system. Yes, I am. Yes, but it took me longer to make $1 million than I thought it would. I wanted to be a multimillionaire by the time I was 30. It took me a little bit longer than that, but that has nothing to do with this conversation. Let's see here. If 11:30, it's a bit higher. Great question, Ross. Kent Ross, great question. If at 11:30 it's a bit higher than 3, do you set the entry to pullback? So if the gold market is up at least 3 at 11:30, I'll do the trade. But if it's up more than say 12 or 15, I won't do the trade because I'll be chasing at that point. Yeah. If the difference is less than 3 and it has 2 time frames, no trade. So what I do is I use it as a filter. And I go, okay, if it's not up at least 3 at 11:30, I just go to bed. I do know folks that'll put a buy stop at 3 points above the 130 close, though. What is the success rate of the trade? The success rate is better if you just flip it out first thing in the morning, where you risk 6 points, and you usually make 18 on the next morning, on average. I would say the sweet spot is to risk 6 to make 20. And I make usually 40 points on it more than I make 60 points. Did you trade the GC into the Fed? Do you trade the Fed? I trade anything and everything all the time. All right, from past memory, you used to get long at +3 after 6 p.m. No, it's +3 after 11:30 p.m. So, yeah. All right, so I've got 6 minutes. I'll take your questions. Hopefully that helps you out a lot and makes you more money than loses you. I have got a special offer I want to give you here. Let me show you that. So I've got a course called My Favorite Trade Setups. I usually sell it for $197. If you want to buy it for today, for the first 100 tickets or spots or seats, whatever you want to do, I'll give you a 50% discount, $97. Now, the deadline is the first 100 people. You go to this link. I'm going to put it in the chat box so you can have it. You can also call the office. I've got Susanna. She's answering the phone today. She'll be more than glad to help you out. Here's the link in your chat box. And like I said, I know I got about 5 minutes to answer questions. I'll stay here and answer as many questions as I can until my time's up. My favorite trade setups. I've already taught you 2 of my favorite trade setups. Good Night Gold, and the 8-tick bond reversal. Tony, I really appreciate that. Tony says, best 97 you'll ever spend, people. Thanks, Tony. I appreciate that. How many setups will you discuss in that webinar? All right, so it's not a webinar. This is a pre-recorded class. Let me show you how this works. All right. So here's how it works. Once you click the Buy Now link, there'll be this Add to Cart button. You'll see my ugly mug right here with my monkey suit on. Just click Add to Cart, and then you have 1, 2, 3, 4, 5, 6, 7 hours of content. Okay, 7 hours of content. Oh, Toby. I said Tony, not Toby. My bad. And then I've got 2 hours of live trading, the setups that I just taught you. So 7 hours of content and then 2 hours of live trading. I just recorded everything for you. Okay. It's 100% money back guarantee. If you don't love this course, if you don't think it's way worth more money than you invest in it, please call me. I want to give you your money back. Okay. And it's a no questions, triple guarantee. You either love it or you don't keep it. Here's what you're going to learn in that course. There's 5 different modules. Module 1 covers my favorite way to scan the markets for swing trades and the best way to scan the markets for day trades. This is stock market. How to filter out the best trades to take. Module 2, I cover the 7 horsemen trades, which is 7 stocks that beat earnings 90% of the time, and then 7 stocks that beat earnings 80% of the time. That alone is worth $97, just knowing what those 14 stocks are. We also go through how to trade stock gap plays. We go through the gap and go trade setup. We go through the gap and crap setup, where something will gap up and just puke. So we cover that. In module 3, I cover E-mini trades, like how to trade the gaps on index futures, Dow, S&P, NASDAQ, Russell. The ambush trade setup, an 85-115 fade trade, the crescendo trade setup, all really good. Those are my 4 favorite index trades that I'm going to teach you. All right, and then I taught you already the famous Goodnight Gold trade where you risk $600 to make $6,000. And then I've got the Gold Rush trade and then the Gold Bug trade. I can't teach them all to you in an hour. Okay, and then I also taught you one of these trades today in Module 5, the overnight bond trade, where you risk 8 ticks, or where you risk 5 ticks to make 32, where you're risking 156 to make 1,000. And then I also have a sneak attack trade that I teach you in the modules too. So those are the courses that you get, the setups and everything. I teach them in really, really painstakingly detail. You have a checklist and PowerPoint and PDF, and they're all rule-based, and they're very easy to follow. I did kind of overload you with 2 setups today, the Goodnight Gold trade setup and the 8-tick reversal on bond. Here is your link if you want to order. You can also call my office, area code 859-963-3445. Hit me with all your questions. On gold, say you were up 6 points at 11:30 p.m. Do you buy it? I would buy that. I just don't want gold to be up more than 12 or 15 points at 11:30 because I'd be tracing. Have a strategy for crude trades? Yes, I do have strategies for crude. Do you ever update these? Yeah, I update them. But here's the thing: like, these are my favorite trades for a reason, because they're kind of timeless. They're kind of withstand the test of time. But yes, I do. As I practice this, each time I place a buy limit order, it fills at the current price. Why? I don't know. You may be, if you're trading on demo, a demo is not going to be the same thing as real. I would have to check out what you're doing wrong there on that. Scans based on cloud. Scans are based on both cloud and also Darvis Box. I currently do end of the day on Forex and also some intraday 5 minutes. Can you help me with that? I'd like to master before options. If you're going to trade Forex, use Ichimoku, use a daily and a 4-hour chart. That'll help you. Just got in. What are the dates? You don't need a date. As soon as you hit buy now, you're immediately taken to a page that you can view these in real time. They're recorded sessions. The class has already been taught. You will be watching the recordings of it. If you're going to open a new account for this Toss or TradeStation, I'm a huge fan of TradeStation. Hubert missed earlier is overnight bond trade along Sunday night. Overnight bond trade you could do as early as Sunday night. Yeah. Tell me more about Ichimoku trading. Sorry, I'm out of time. I can come back and teach Ichimoku in another webinar if you want me to. Do you get the indicators? Do they work on Ninja? You don't get the indicators. You'd have to buy those. Those would be extra. But yes, they do work on Ninja. Can the modules be watched more than once, or can they be downloaded? You can watch them as many times as you possibly want. Trend up on bonds, yes. How much are the indicators? Gregory, I'm not sure. You'd have to call the office. We've got a bunch of different indicators that we have. Let's see here. What about your tape reading course? Any offer and link, please. KJ, call the office. Area code 859-963-3445. They'll help you out. You use Ichimoku on a daily 4-hour. How about full-time trading 8 a.m. until 2? What time frames do you use? I would use a 60-minute on that. On your question, William. I just purchased your offers. Gregory, thank you very much. I appreciate it. Hit me with your questions. Sorry, you got 3 more minutes. 3 more minutes is what you got. I started talking at 12:05, so I'll wrap it up here in 4 minutes. Just bought. Thank you very much, Zane. I appreciate it. Hubert, can I see all the indicators on Thinkorswim platform? Can I see all these indicators? You should be able to. Now, I just want to be clear, like, my favorite trades comes with 0 indicators. Okay, like if you want an indicator, you'll have to buy that separately. Most of my indicators work on TOS, yes. Is the bond trade the best for a beginner? Yes, the bond trade is a very good market for beginners to start trading on, yes. If there is a gold trade for Monday morning, is there a gold trade for Monday morning, just bought the course? Richard, so Sunday night, gold opens up at 6 p.m. Look at it at 11:30 on Sunday night, and you'll see that there'll probably be a gold trade on 11:30 at night on Sunday. How do you determine how to trail your stop on a gold trade? What I do, Jamie, is once I'm up 20 points, I then start moving it about 6 points up. You're a great guy to follow. Oh, thanks, appreciate it. What part of the South are you from? I am from South Jersey. South Jersey. No, I'm from Lexington, Kentucky. Is where I'm from. Do you ever use a 5-minute on Forex like you do on bonds? Sometimes. I just bought it. How do I also get the Ichimoku? Ichimoku is on most platforms. It's on most charting platforms. You don't have to buy that. Do the indicators work for stocks and futures? Yes. Is there enough material and time and sales to learn it? Is there enough material on time and sales to learn it? I've got a course called Market Internals where I teach you how to read tape if you want to pick that up. Can you use the same ideal on the 10-year notes? You can, but you have to modify the trade because the 10-year notes ticks are a little bit different. Tell me about over-your-shoulder program. Eric, I would love to. I just don't have enough time. How much money, how many contracts do you trade with the U.S.? It depends on what I'm doing. Anywhere from 1 contract up to 30 contracts. Do you think bonds trade are easier than options? Yes, I do. What chart do you use for Sunday night at 11:30? I would just use a 1-minute chart on gold at night. At US, do you trade for Branson? I saw a photo. No, I don't trade for Branson. I know him, and we've been in a bunch of meetings together and stuff. But no, I don't trade for him. But I do know him. Trading on Ichimoku. Call the office. Area code 859-963-3445. Guys, I got 2 more minutes. 2 more minutes. Great stuff. I wish I were younger to take these and use them. Thanks. I appreciate it, Tim. Is this 97 one time or is it a monthly fee? It's a one-time fee. There is an offer after you buy the course if you want to do a trial to my Inner Circle membership course. You can do that, but it's optional. It's not required at all. Any free trade site available? You can go to my website, hubertcenters.com. I put out free videos every day. Can you enter the gold early on Sunday if it's up 3? Yes, you can. I need to learn bond trading. How do I do this? Recorded lesson. Pick up my favorite trades for $97, and I'll teach you 3 bond trades in this course. So what you can do is, like, my favorite trades is bundled to get your feet wet in how I trade. I have more advanced, more expensive courses, but you should start with this one first to decide which way you want to go on those. Can you place the live trades together at the same time to get up and running if I buy the course? Yes, I'm in the trading room Monday through Friday at 9:30 to 11. Your website says your Inner Circle is not ready yet. Yeah, I just don't promote it openly. It's a closed program. It's open. You just have to call the office or buy this course and then purchase a trial to the room or to the membership site. Thanks, I will bill it. We'll call your number, area code 859-963-3445. I'm out of time, guys. I really appreciate it. Thank you so much. I appreciate you guys having me. Round of applause for ValueCharts. They don't have to put these things on and wrangle up a lot of speakers for you guys to listen to. So thank you so much. Good luck. Have a great Saturday, and I'll see you on the next trading video and on the next webinar.
Okay, excellent. Thanks, Dave. Well, thank you for the introduction. And I'll go ahead and show my first slide here. Let's see here, get this set up. Okay, let's go ahead and do a test. Can everybody see my screen okay? Confluence candlestick patterns for low risk entries. All right, well, welcome everybody. Thanks for joining us today. And I caught the tail end of Hubert's presentation. It was fun to hear his different trading ideas as well. Dave, also thank you for being the moderator today. Dave is actually a super trader in and of himself. I learn a lot from Dave myself. He is a he runs the ValueCharts.com stock and options live trading room. If you have not had a chance to check him out, I would highly recommend it because you will not be disappointed. Okay, let me go ahead and jump into it. Let's we're going to jump into Confluence candlestick patterns for low risk entries. Now, Dave just introduced me. My background really is from the hedge fund space. I've been there for about 20 years now. I'm crazy about trading. When I was 19 years old, I left my engineering school to go up, and I actually moved up to Chicago, cold turkey, to work on the floor of the Chicago Board of Trade. So if that doesn't tell you that I'm crazy about trading or I'm very passionate about it. I don't know what will, but I spent about 2 years up there. When I turned 21, I leased a seat for a few months and realized that my real passion was relating to all the exciting things that were happening on the quantitative end using computerized trading strategies and the power of computers and servers. So I returned to engineering school, finished my degree, and then joined up, have been working with hedge funds for many, many years after that. So I'm more of a quant. I enjoy indicators, the power of indicators, and also the computerized trading strategies as well. Okay, can everybody hear okay? I'm getting some people saying that they don't have sound. I don't know if it's an isolated incident. Hopefully I'm not talking to myself here. Okay, excellent. You should be good. Obviously, if you can't hear me say that and you don't have sound, I'm using the best sound setup that I have, so hopefully this will be sufficient. Now, anytime we talk about trading, it's important for everybody to understand that trading does involve a great deal of risk. I'm not here to tell you that there are strategies that do not involve at least some level of risk, because every strategy in the market does, no exceptions. And so it's important to understand that. I don't want you to risk money that you cannot afford to lose. As a person to person, if you have money that you cannot afford to lose, I highly recommend that you do not risk that personally, okay? Because the trading is challenging enough. I found that when people trade with the added burden of trading with money that they can't afford to lose, it usually does not end well. Now, having said that, we are here to learn about trading. We are here to be part of that minority that actually is able to consistently make money in the markets. Rules, a CFTC Rule 4.41 doesn't really apply to anything I'm saying today, but I usually try to cover this as well. If you see hypothetical results that look really good, understand that there are limitations to those. As a system tester, as a person who's created many, when I say many, probably over 100,000 hypothetical results in my career, my goal is to make those as accurate as possible, but even with the best intentions, those have limitations. So understand that past performance is not necessarily indicative of future results. Now, just to make things a little lighter today, one of the things I enjoy doing is I'm a huge foodie. I love to travel to different parts of the world and try the local cuisine, if you will. I lived in the Cayman Islands for a brief period of time when I was working in the hedge fund space, and I highly recommend, if you get out there and you have the time, go to Calypso Grill. It's a little hard to find. You've got to work your way up to the upper northwest part of the island and drive through some back neighborhoods there. But if you break through to it, it's a restaurant right on the North Sound of the Cayman Islands, and it has wonderful food. I've never been disappointed there. They have super fabulous seafood recipes there. And also, if you sit outside, if you go there, I highly recommend sitting outside if weather permits, and you can take advantage of the breeze that comes right off of the North Sound there. They are known for a special dessert called Icky Sticky Toffee Pudding. We get it every time we go. It is so good that they actually named a street after it in the Cayman Islands. So if you have a chance, check it out. I think you will. I know you won't be disappointed. I never have. Keys to identifying turning points. Now, when we look at timing the market, when we look at identifying turning points in the markets, and by the way, I'll get to questions here in a bit, so just bear with me here. Let's see, what platform indicators work on? Well, somebody's just asking what platform, Gregory, what platform do my indicators work on? We build them across a number of different platforms, so check out ValueCharts.com and you'll see the list of trading platforms that we currently design indicators for. All right, so when you look at identifying or getting into a market, our goal as traders is to try to achieve profitability as close to inception as possible. That's the goal for the most part for most active traders. Now, there are strategies out there relating to trend following where by design oftentimes you get into markets at inopportune shorter time frames, but it's worth it because longer term you're guaranteed to participate, hopefully if the model's effective, guaranteed to participate in a longer term trend. So the give and the take of this is that if we are looking to time our entry, if we do it close to the bottom, let's say, of a correction, the market has the ebb, the cycle's moving down, we want to try to find that bottom as closely as possible. All right, but the reality is the closer we are to the bottom, the less data we really have to some extent that confirms that it is a bottom indeed instead of bottom fishing. Bottom fishing without the right tools can be very, very expensive. I do not recommend doing that, and that's really not what we're talking about here. We're talking about something a little bit different. But understand that as markets move up and move down, that we have two different ideas where they play here. One of them is if we try to buy closer to the bottom here, we have usually less confirmation that a bottom has occurred. If we wait, then we have more confirmation, but we have less profit potential in the next leg up. So if we wait for two major up bars, and I'll show you a chart of this in a second, then we've already eroded part of our profit potential depending on the time horizon we're trading in. For most active traders, that's usually swings or up moves. If you require confirmation, you are eroding your profit potential. So there's that battle between uncertainty and losing profit potential. So the idea here is to try to use candlestick patterns and combine those with other indicators to create something that's going to get us in closer to the bottom and increase the probability for success. That's what I'm going to be talking about today. Here's an example of this idea of risk, uncertainty versus profit potential erosion. So right now, is this a bottom if we're looking to be a buyer? Well, we have really nothing on this chart that shows us that this is a bottom. Sure enough, if we waited to find out what would happen, this market actually broke down. This is actually a good, by the way, a good sell setup in the markets that we watch for. Thomas and Dave will call out in the live trading rooms. But this first one was obviously a false bottom there. So that was not accurate. The market ended up selling off more. And then we have a second point down here that we say, okay, we now have a bottom because we've rallied hard for 3 bars off of that level. Now the problem with that is that rally, the 3-day rally off the bottom, we have more confirmation that we could be looking at a more meaningful bottom. But the problem with that is we've also eroded quite a bit of our profit potential when considering the entire, what's left of the move up. That's the constant challenge we have as traders, and that's what we're trying to eliminate as much as possible. Yeah, somebody just mentioned I have this problem in my trading. Well, everybody has this problem in their trading, so don't feel bad about that. That's a challenge for all of us. Even the best hedge fund managers in the world, we all have that challenge there. So what I like to do is I like to be a trader who focuses on trying to get in more strategically. So if I'm a buyer, like early on this chart, I'm not looking to get in after we've had a huge run up here, and I'm not looking to buy up here thinking, okay, this market's really showing strong buying, because I feel like most of the time we're due for some sort of a correction. So I'm the type of trader who wants to try to get in down here as much as possible. Now with that comes uncertainty, but again, part of what we're doing today is looking at strategies to utilize the power of candlesticks along with other types of tools, and some are proprietary that we use and others are not. I can show you some alternatives, or at least talk about those today. So in this example, the 3 bars up, we can see that this entire up move right here, if that's what we've waited for, we've eroded more than 50% of our profit potential, and the probability of us selling at the very top is probably not realistic. So this, in a perfect world, the second leg up here is all we have to work with our trade. So it can be dangerous if you're the type of trader who waits for the confirmation in these swings in the market. It can be a dangerous thing because you're not really working with a lot of profit potential once you get in. Let's talk about increasing the odds for success using candlestick patterns and other proven indicators. Today I'm going to focus on value charts. Danny, you're asking how is the 50% evaluated here? I'm just eyeballing this right here. So I'm using the bottom here. Let me pull up just to point this out. I'm using the bottom of this price move, which we can see that was the bottom. I'm using what ended up being the top of this price move up here just to demonstrate the idea that that there's a finite potential with every trade that we have. And this, you can clearly see that this is north of 50%. 50% of this entire move is probably right around this level I'm drawing. So that if we waited for this green arrow close level right here, we're talking about a confirmation that is north of 50%, probably north of 60% of the eventual move that we saw over the course of, call it 15 bars. That's what I'm talking about. Just understand the idea, the concept of uncertainty versus profit potential. Now, what I like to do is, as the developer of value charts and the value charts tools, I like to combine candlestick patterns with value charts. Now, you can use other things other than value charts. You can use stochastic oscillators. You can use RSI indicators and other ones as well. So it doesn't have to be just value charts. It can be Bollinger Bands. But I use value charts. I'm passionate about those tools. I've been working on those for about 20 years now. And I'll show you just ideas that you can take with you to brainstorm and think about different ways you can create higher probability entry points while you still have a degree of uncertainty and leaving the maximum portion of your profit potential for the upcoming trades. Now, we've actually created a product called Value Candles. That's a trademark of ValueCharts.com. That's combining the power of candlesticks with value charts. I'll show you that here in a second. My research with candlesticks and my experience is that these are among the best patterns out there. So I like the doji. Now, why do I have doji written twice? Because I use the doji pattern not only for bottoms, but also for tops as well. The doji pattern by itself, in my experience, is a more meaningful indicator or more meaningful pattern by itself for topping patterns than bottoming. Dojis can give you a lot of false signals on the way down. I don't ever use dojis by themselves, though, to trade. Never. I always combine dojis with other types of candlestick patterns, and I really do the same for all of them. The doji pattern, I'm going to show you what that looks like here in a minute. The hammer, the hanging man, the inverted hammer, and the shooting star. So all of these top patterns here are, I'll go ahead and change the color of my pointer here. Just a second here. Something a little easier to look at. Okay, so this whole section right here, including the morning star, and actually morning star is not including, excuse me. The top three here are including 1 bar candlestick patterns. So those are the ones, just everything north of the inverted hammer and the shooting star. So these top, I call them 5, but 6 if you include the bottoming and topping doji. These are my favorite single bar candlestick patterns. Below that, we have the morning star, the evening star, piercing pattern, dark cloud, bullish engulfing, and bearish engulfing. These bottom few, and let me color those differently here so you can see those. These are patterns that are involving more than 1 price bar. The doji, the star patterns can be 3. The piercing pattern and dark cloud involve 2 bars, and then the bullish engulfing and the bearish engulfing also involve 2. The negative to the bottom set here is that they erode your profit potential. So the top set do less, it really erodes your profit potential less than the bottom set. So really the top 5 up here are my favorite. Those are the ones I use mostly. The bottom set can be very valid as well and can be very powerful, but understand that with a morning star, if you want confirmation or a piercing pattern or dark cloud pattern or bullish engulfing or bearish engulfing, these are 2-bar patterns and they erode your profit potential. They can go a long way in your desired direction before they actually confirm the signal. Intro to value charts. And again, I'm going to get some questions here in a second, but so bear with me here. I want to make sure we have time to cover all of the material, and then I'm going to go ahead and get to questions here. So intro to value charts. What are value charts? Value charts are a tool that I designed to create a definition, a standardized definition across all markets for objective market valuation. You say, Mark, what the heck is that? Well, if you think of value historically in the markets, you think of what I would call subjective valuation, and that's the opinion of an analyst, and that's typically only as good as the skill of the analyst. And subjective valuation, when you think of value investing, that has lost a tremendous amount of credibility over the years because so many analysts are wildly inaccurate with their projections of the market. And as we now know that many of these analysts are actually working with a conflict of interest because they're representing the companies that they're recommending. So that they're actually they're more marketers than actual analysts. That can create a problem. Now, what I'm talking about is not that. I'm talking about what I call objective market valuation. Yes, this webinar, by the way, Doug, is recorded for your question. But objective market valuation, this value charts indicator down here at the bottom, is designed to only evaluate historical transactional price action, period. That's all we care about. If you think about any accurate valuation in any market in the world, take a step back and say to yourself, is my valuation based on transactional price action between buyers and sellers, where buyers have come together with sellers to negotiate and actually exchange money? That is the most important data we have to considering valuation in any market in the world, including real estate, including used cars, or any free market out there. So that's what this tool, ValueCharts, is built upon. If you can visualize, I'm drawing this by hand here, a moving average here. This is what we'll call a very simple definition of objective valuation. It's a moving average of median price activity, which is the high plus low divided by 2. And then you can see that is the most primitive definition, really, of objective market valuation. What ValueCharts is if you can see this orange line right here, that line is essentially serving as our 0 line down here in the ValueCharts price window. So we've created a linear definition down here, pulled that line straight across, and then plotted our bars around that to get a determination of the scatter, if you will, or the distribution of price around this line. And this is where ValueCharts become pretty powerful. So that's one thing to understand. And the ValueCharts here, and I'll show you in a second how we come up with these colors. There's 5 primary valuation zones. Over here, the other thing to know about ValueCharts is these units are not the same as the market that the ValueCharts are applied to. These are what we call dynamic volatility units. They're different from the stock. These are dollars per share up here. These are different. These are static units. The dynamic volatility units are designed to expand with increasing market volatility and contract with decreasing market volatility. So they continue to change over time, and they have to do that in order for us to have an opportunity to be accurate here with our deviations, if you will, from this 0 line in the ValueCharts price window. Let me go ahead in my next slide and show you how we actually define the ValueCharts price window tool. This is designed to be modeled after statistical standard deviations, meaning that the fair value zone here in the middle, that represents plus or minus 1 standard deviation of price action throughout this entire zone, about 68% over time. That's what it's designed to do. Now, it's not exact, but it's pretty close. You don't have to know anything about statistics, by the way. I'm just telling you where this comes from. There is a science behind this indicator and all of the indicators in the ValueCharts indicator suite. So fair value represents 68, almost 70% of price action or trading activity in the ValueCharts indicators. Now, if you go above that, you have moderately overvalued. Everything within the moderately overvalued level and above, so yellow plus red zones here at the top, that's about 16% of your price action or your trading activity over time. So moderately overvalued is about, it's an overvalued state. Extreme overvalued is represented by significantly overvalued, the upper red area, upper red zone, valuation zone here on the ValueCharts tools. This represents less than 2.5% of historical price action for any market and time frame combination that you're applying ValueCharts to. Same convention on the downside, moderately undervalued, and below is the bottom 16% of price action, essentially. The bottom red zone indicates the lowest 2.5% of price activity. So this is a science. This is really important to understand because now we can see the colors of these bars, or that the bars are trading in when we look at value bars or value charts or value levels, and understand that what markets are doing is they're starting to deviate from our definition of fair value. And that helps us to time our entries and exits much, much better. Now, last but not least, I gave you some statistics. These statistics are created by drawing from a tool we call Price Action Profile. That's this whole histogram over here on the right-hand side of your screen. These are advanced tools that have been developed in the recent years, and these are much more powerful than the standard tools you find on most trading platforms. But they're also much more useful. Like right now in this example, we can see that this market is trading at the upper end of fair value at 3.3. And then these are dynamic volatility units. Remember over here, all the ValueCharts tools and the price action profiles use these dynamic units to define valuation. Excuse me. And then you can see right now by using this histogram, and this histogram is derived from essentially stacking all of the price action up over here in the ValueCharts on one side of the screen. And you get this bell curve looking histogram. Above that, we can see that at the current price level, near the top of fair value, 27.7 of historical price action takes place above that valuation level, and 72% takes place below that. Now, also, you can see a table over here, some data. Right here, you can see with the over 8, it's 1.6% of the time does price trade. Again, over here on my ValueCharts price window in the upper red zone, that represents 1.6% of historical price action or less. And the bottom here is 1.5%. You can see over here from the statistics table, 1.5% on the bottom here or less. So we've gone over kind of some academic things here for you to understand where this tool comes from and why I use it, why I'm so passionate about using this with trading. Let's go into some trading examples. Now, most trading platforms cannot create what we call a value candle. The graphics just don't accommodate that at this point in time. And I'm going to show you what a value candle looks like. But this is the Metastock platform using the confluence of the value levels here. And the value levels are essentially defining the 5 different valuation levels. Between the green lines is fair value. The upper green and upper yellow is moderately overvalued. And then upper yellow and upper red is significantly overvalued. And then below we have, again, moderately undervalued between the lower green, lower yellow, significantly undervalued, really beyond the bottom yellow. So that just gives you an idea of what's happening here. And then I have an automated indicator here that's defining candlestick patterns. So I know, because there's some math involved with candlestick patterns where they have to meet certain criteria. Like for a hammer, we typically want the hammer body to be less than a certain percentage of the whole range. I'm going to go into candlesticks here in a second so you understand what I'm talking about. But this is just an idea of how this might look on a chart. It looks a little bit noisy for those of you who are new to this concept, but once you get used to the idea, this can become very, very powerful. So top value candle patterns. What is a value candle? It's combining the value chart level that the candlestick is trading within and with the candlestick pattern itself. So these I find are very powerful for determining turning points. This is just a representation that I created to show you what this might look like on a chart. Were we able to actually create this confluence of candlesticks and value charts? You can see here at the bottom that we have what we call almost a hammer pattern, not quite the definition of a hammer here, but you have a red tip on the bottom. That's part of the price bar that dipped into significantly undervalued. The upper yellow coloration is moderately overvalued trading activity. And then down here, this is moderately undervalued, the lower yellow, and you can get kind of a definition idea from the colors of these candles. So this gives you an idea of an indicator that nobody can really replicate. We're going to do this in our own trading platform that we're working on right now. Should be launched in the next couple of weeks. We will have value candles on our platform at some point, but that just to give you an idea what that is. Now, let's talk about dojis. How do you define a doji? A doji is essentially a price bar where you have the open and close almost at the same level. It doesn't have to be exact, but you want it to be very, very close. If the open and close are not at the same price level, then you could start to become more of what we call a spinning top pattern. If they're exact, then that matches what's called a doji. If the open and the close and the low are almost exactly or exactly at the low of the session, we call this a gravestone doji. All right, that's one of the patterns. If they're at the top, it's a dragonfly doji. So that's open and close and high here at the top. So there's different types of patterns even within the doji pattern that we can see. Now when we take the doji pattern, this is very close to gravestone doji right here in the chart. This is a yellow hat doji. Why are we saying yellow hat? Because you'll notice here that these value bands here are they're being plotted here. Let me get my pen going here. Right here for this candle trades mostly in fair value, but part of it goes up and trades in the moderately overvalued area in the upper yellow valuation zone, which we call moderately overvalued. So that's colored yellow. Now again, the software does not allow us to do this on Metastock nor any other platform for that matter, but we know that. We know that to be the case, and we label this a yellow hat doji, which is now taking a traditionally neutral pattern in candlestick study and turning it into something that now has a bearish bias to it. And the way we trade these is when we get this type of pattern, we're looking to enter on the open of the following bar, and then so right here at this level right here at the open. All right, I'm going to draw. In fact, I'm going to use a different color here so you can see that better. That doesn't conflict with all my other colors. Let me see if I can get a bright. I'm going to use a blue. So this right here, this opening level is blue. You can see that right here. I'm using this price bar following the candlestick pattern to determine that. So the opening of that, I'm going to sell short because this is a bearish pattern. I'm going to put my stop right above the high of the value candlestick pattern, above the high of the doji. Now, you say, Mark, I don't have value charts. What can I use? Well, you can also use stochastics. That can be a very nice tool as well. When stochastic oscillator gets overbought, call it over the 80 reading, along with the doji pattern like this, that could be also a bearish type of formation, and that can be very effective as well. So you don't have to have value bars or value charts tools to be able to replicate this. This is another example of what we call a yellow tip doji. Again, I'm going to get to questions here just in a second, but this yellow tip doji here is one bar, and you can see it's fairly close to the bottom of this correction here. It dips the very low end here. It's hard to see below this green line, the lower green line, into this yellow territory. It's not colored yellow because value lines don't have that ability, but it will be when we create the value candles on our platform. So this gives you a little bit of an idea of what's happening here. And this is a bullish candlestick pattern. Now, let me tell you something else we do. I not only look to combine candlestick patterns with value chart levels, I also look to combine this with other tools as well, especially momentum. I'm going to show you some examples here in a bit using that, because that only makes this whole process of trying to identify these strategic entry points more powerful. All right, we now have the the hammer pattern here. This is basically a pattern that involves the body. Forgive me for those of you who are who are candlestick pros here. This is just a review for you. The body, which is a solid portion of the candle, is at near the top of the candlestick bar, and then the tail, or the lower shadow here, represents greater than 2x the body. So we want to see that 2 times greater than the candlestick body in order for that to be a valid hammer pattern. And these hammer patterns are occurring after a market sells off, so they're a bottoming pattern. Let's take a look at some examples here. This is what we call a yellow-tipped hammer. Again, I'm using the value levels tool here, identifying this lower yellow tip on the Metastock platform. This is a very nice pattern oftentimes to tell me that the market could be bottoming out and there's a probability it could be going higher. And again, I like to combine this with more than just the candlestick and the value information, but also introduce momentum as well. When you get the confluence of all three of those, they can be deadly in terms of identifying strategic points. And I'll show you one that's happening right now in the stock market. Okay, percent R. Yeah, Gregory, thank you. Percent R could work as well. So that these, you have flexibility here. Let me, just 1 second here. Sometimes it does this. I'm going to fire back up my screen here. Okay, everybody should be able to see this. Now, going to the next slide here. Sometimes when I discard my line drawing, if you will, my writing, it backs me out of the presentation mode for PowerPoint, so I apologize for that. This is the opposite of the hammer. This is a hammer-like bar. This is essentially the same thing as a hammer, except for now it takes place after a run-up in the market, and that's a very important distinction in candlestick analysis. So this is really the same individual bar criteria here is used, where we want the body near the top of the price bar. The candle body needs to be right at the top here. It can have a little bit of a upper shadow here, but in general we want it to be very close to the top of the entire bar. And then below this we want the tail, if you will, or the lower shadow to be 2 times as large as the body. And they can be, when you see a green pattern here or a red pattern, all that's saying is that they open here. Let me go ahead and just get rid of these drawings so I can show you what I'm talking about. Okay, let's erase all. The open here is going to be right here. So the open is lower than the close. That's what defines the body in candlestick patterns. So this opening line is the bottom of the body. The closing line is the top of the body. Now over here, the red one represents the opening line at the top here, and then closing line at the bottom of the body. That's the distinction. And what this means is that a lot of professional candlestick gurus out there will tell you that they feel like this can be either a green or a red body here. It doesn't matter. As long as the body is relatively positioned at the high end of the range compared to the entire range, and as long as you have the criteria of 2x the tail here of the when compared to the body, that defines and validates the candlestick pattern. This is an example of what we call the yellow hat hanging man. Notice again, it's taking place in part of the zone, the valuation zone, on top of or north of this upper green line. That puts it up into the moderately overvalued zone. We know from the price action profile I showed you in a previous chart that this represents the top 16% of historical price action. So this oftentimes can be a very good tool to say, okay, we're getting a bearish formation here. Now, if you want to get really involved with your candlestick study, some people may say, well, Mark, to me, this is enough of a run up here in the market to label this as a hanging man. But some people may want more of a recent one. So some people like more of that recent positioning of the hanging man right after, the previous one or two price bars shooting up. So that's how some people define that. I am comfortable with having it after a general rise in the markets over the past, call it 10 days or so, but both can be effective. Do you create the name of Yellow Hat? I did not create that, William. One of our traders created that. Thomas Wood has created a lot of these names as well. Just naming convention. Thomas is creative in that way, and so I've just adopted his name there. Okay, for entering a trade, should somebody wait for prices to cross the high of the yellow tip hammer to enter when the next candle opens? William, that's going back to our last slide here. Let me just go ahead and just throw that up there to answer your question. You can do that. Okay, that's one way to do that for confirmation. Or another thing is, if this is a daily price bar, if you're doing confluence patterns and daily price bars, then you can drill down to intraday bars to try to hone in on your entry. So you can use this in a combination of ways. You can even do a trade with a bias, call this a swing trade bias on dailies, and then you can drill down to your 60-minute or your 15 or 30-minute price bars or even tick bars and try to find the same type of action happening intraday. So you get, again, a confluence candlestick and value type formation there. So that can be very powerful, kind of a setup within a setup. All right, this is what we call an inverted hammer. This is the flipping the hammer upside down, very similar. They can be red or green. Essentially, the open and close, it doesn't matter whether it opens or closes higher than the other. And the opposite is true for the inverted hammer. You want the upper shadow to be 2 times the size of the body. And so the nice thing about these automated candlestick tools is that they just do all the calculations for you and validate that. Now, let's say you say, Mark, what if it's 1.5% the size of the body? That's where your judgment comes into play. Depending how badly you want to enter the market, you can make that distinction yourself to see if you would say it's close enough for government work. I still am very interested in taking this trade. That can still be very effective. That's my experience, at least. Bollinger Band, yeah, the indicator you see on the screen is not a Bollinger Band. I'm going to show you here again. This is what we call value levels. Now, they look similar, all right, but they're very different. And Bollinger Bands essentially are designed, if you go to John Bollinger's website, to identify high and low portions of price. So that is essentially what it does. The value charts indicators are designed to do a lot more than that. They're designed to offer a standard definition for objective market valuation for any market and price time frame. So there's more to the value charts. You need to really study the different valuation zones and understand what it's telling you, but it communicates very, very powerful information to you, the trader. And once you see how the colors communicate the valuations of the market time frame combination, it becomes very powerful. And really within a second, you're going to know exactly what type of patterns are forming, what the valuation of a market is as well. And I will never trade without these tools myself. Okay, how can I get this on my chart? Yeah, you can. We actually sell these tools at ValueCharts.com. We are in the midst of working to create some tools for the Metastock platform as well. And that's how you can get those. So go to ValueCharts.com if you're interested. I'm not really promoting that within this webinar, but as a general answer to your question, it's ValueCharts.com. We have different indicator bundles across a number of different trading platforms there. Okay, can you have multiple time frame charts open at the same time with value charts? Absolutely. That's one of the most powerful ways to use it. So if you can get a confluence where you have undervalued across weekly, daily, and 60-minute, those have been some of the highest precision entries I've ever found. And then you throw momentum in the mix on a shorter term time frame, you literally have the tools that you need to find some of the most strategic entries that are out there in the markets. Again, let's just proceed here before so we have time to finish this up. The shooting star is the opposite of the inverted hammer. So you can see here, this is a topping pattern. We need prices to run up here, and this needs to be essentially near the top of a run up, and that can be red or green, meaning that the position of the body, whether the open is higher than the close, does not seem to matter very much, and that has been my experience as well. I like to have, I prefer to have this type of pattern have a close lower than the open if it's a topping, and the close higher than the open if it's a bottoming. That's my personal preference in the perfect world, but I'm okay with that. So this again, this is a what we call a yellow jacket shooting star. The shooting star is the candlestick pattern. The dot on top of it is identifying this, and then the yellow jacket has to do with the top portion of this price bar trading mostly in the moderately overvalued valuation zone. And we use these lines, all these lines here on my screen, to define what that is. Now here's another question you may have. Okay, Mark, how do you get in this trade? If I'm going to take this trading signal, I'm looking to buy at the open of the next slide here. So let me see if I can get that. I'm going to buy right here at the open of the next bar. That's this level right here. And then I'm going to put my stop above the highest high over the last couple of bars. Now I told you earlier, you could use the high of the previous candlestick bar right here. But when I have a resistance level with the preceding couple of bars that's higher than that, I usually like to go at the highest point over the last several bars. If you have a higher high, if you will, before the actual candle pattern occurs. So look for local resistance levels that are a little higher than the candlestick pattern. If you have that, my recommendation would be to possibly look at those. And in this case, you can see why that's important, because if I sold here and I had my stop at the candlestick pattern, then I'm stopped out there, so with a loss there. And this can happen sometimes. If I have my stop at the very top here above the highest resistance level over the past couple of days, or past couple of bars in this case, then that doesn't end up getting me. And this doesn't always work. Sometimes it can take you out of either situation, but I find that's a better way to trade. And then when you shoot down here and you start to sell off, one of the powerful ways to trade is what's called value range trading. And this is where once prices enter into the moderately undervalued zone below the bottom green band here, you may look to take profits. If it's just a quick swing trade in the markets, quick day trade, that can be extremely powerful as well. All right, let me keep on moving on here. Let's go with some real market examples. This is what a trading screen would look like when you apply the value levels with all of the value or the candlesticks as well. I've got a indicator that points out these candlestick patterns and confluence patterns between value levels and value charts, if you will, and calls them out and labels them. So this is kind of a nice deal. But you can see how when you see several, let me get my pen out again here, several examples, or if you see several different candlestick patterns that have occur one after the other in the same general vicinity, those can be pretty powerful. And that's what we see up here with those two bars. We see a red hat harami. It's one of the patterns that's a 2-bar pattern using these first 2 bars. And then we also see a golden doji. And that's a doji that occurs all in this moderately overvalued zone. This can be a very, very powerful confluence for a sell signal. So those are the types of things I look for. Right here, you have a nice yellow tipped doji here, and it's very close to being a yellow tipped hammer as well. Down here, you have near the bottom, you have a red tipped engulfing and a red tipped doji right next to each other. So those are nice patterns as well. And you can see other patterns up here. And this is actually a chart of Apple. See if I find my pointer here. We see a yellow hat doji. Actually, the yellow hat doji is right here. Excuse me, I'm drawing the wrong thing. And that turned out to be a nice topping pattern. The prices sold off, came close to taking out the high of the doji, but didn't quite make it. This is right here, a yellow tipped engulfing. That's a 2-bar pattern. The engulfing pattern, keep in mind, is going to erode some of your profit potential. You can see how far we are up off the lows here. In fact, I don't even think this is a very good color. Let me see if I can change this to something a little bit darker. Okay, so we're pretty far off the low here by the time we actually get that confirmation. But that's one that can still be valid. It can still be something that can point you to higher prices in a longer-term time frame, like a daily. Right here's another red. Let's see. This is a red-tipped morning star. Over here, not quite. Let's see. Yeah, that's not quite as I have my parameters a little looser on that definition, so it's not quite what I'd be looking for there. So, all right, let's go ahead and move forward. Again, another example here. In fact, the screen doesn't show that morning star pattern, by the way, is actually following a run-up from the previous chart, so you can't see that. It's a little confusing there. So just dismiss that. That might be confusing for some of you who are looking at the price action leading into that. This is a confluence of a number of patterns here. You have the yellow jacket doji, that's this green one right here. You also have a yellow hat engulfing right after that. So when you see several in a row right there, that can be powerful, and sure enough, it sends markets into overvalued, or this prices in the undervalued territory shortly thereafter. You have a yellow jacket doji here, and this was not the low. Now this is why I emphasize using momentum as well. So this is something in my mind that's not compelling enough by itself to take a long position. But if I have a nice momentum confirmation, I might actually look at doing that. There again, here we have a nice red tipped hammer. You have a nice red tipped morning star. Yeah, I need to check on that. The morning star looks like ignore that. That looks like it's the settings on that are not quite right on my indicator. So ignore that. Okay, the pointer is hard to see. I apologize. When I change it to drawing, it starts to get a little more challenging. Now let's talk about the idea of a stochastic oscillator introduced in the mix here, or that can be a momentum type indicator. What I like to do there, and I'll answer some questions here in just a minute, I like to use these patterns right here. So this is a topping pattern. I've got a red hat doji and a red hat evening star. I like to use that with the level of my stochastic oscillator. Notice that my first high, I'm going to put number 1 right there, number 1 up here. My first high is higher on my indicator, and then my second top is lower in the indicator, but my prices have gone to new highs here. So this is what we call a bearish divergence. So the stochastic is kind of weakening here, but prices are strengthening here. And then on top of that, I have a red hat doji and a red hat evening star. So I have both of those as potential patterns. So combining those together with a bearish divergence and stochastics can be extremely powerful. And what I tell you to do is really spend some time studying this, because you're going to be able to read that and make more compelling trades that way. Nothing else here to note on this particular example in terms of entry signals. Let me answer some questions. This is available for TOS. The ValueCharts tools are, and TOS does have candlestick bars as well. Is stochastic a momentum? You can use stochastics, Jerry, as a momentum indicator, yes. Okay, you still think gold is going, or has another $100 to go on the upside? Excellent question, KJ. Yes, I do. I think gold has a ways to go on the upside. So, but now let me just say that right now we could be in for a little bit of a correction. Now, this is a very much longer term projection. People have been following my gold predictions. I said at the end of the year in my webinar in the end of December that I thought gold was going higher, and it has so far. We've rallied about $150 an ounce, or maybe even almost $200 an ounce, but it has more to go, I believe. And by the way, I believe we are at the threshold of one of the largest generational commodity bull markets that we'll ever see. We'll never see something bigger than this in our lifetimes. This is a side note that I'm telling you about. If you're interested in learning more about that, we're putting on a workshop pretty soon about the mega commodity upcycle that we're approaching. I'm seeing such strengthening across the boards and so many of the different commodities right now. It's been probably a decade since I've seen anything even close to what we're seeing right now. All right, so William, you couldn't hear me. Yes, we are close to a bull market, I believe. I think gold could go a lot higher longer term, but here's the thing. If you're trading these moves longer term, you have to be very careful about trading with strategic entry points, because even if you're riding on a long-term bull market trend, if you're wrong on your entry point, then you're going to lose money. This is another example here. If you want to use stochastics, you can use the stochastic indicator where the arrows are to raise up out of the underbought area here. If you want to use candles as kind of a confirmation, so you can combine those two together. This is if you look at a nice bearish divergence here, let me throw up my pointer here. Right here's point number 1. This is point number 2. Notice up here you have a strong stochastic reading. This is point number 1 up here. This is point number 2 over here. So that gives you that bearish divergence here, weakening stochastic, but you have prices are not even really that much higher, just kind of holding in there. May not quite meet the formal definition of a bearish divergence, but I like to look at these as well, because it's dramatically weakening momentum here on the backside of this, and then you have a yellow hat doji, which is the bearish candlestick pattern as well. So I think you get the idea here of how to combine these. Again, this is a momentum indicator here on the Metastock platform that you can use. You're looking for a weaker reading there where the down arrow is here. We have a red hat doji that's poking up the very top of that price bar into significantly overvalued, followed by a red hat evening star pattern confirmation. So those can be very helpful as well. This is a really nice example right here of a bullish divergence. Notice how the momentum indicator is strengthening here as prices continue to sell off. So that's a huge red flag if you're short the market, but it's a nice reading for us or for any traders looking to buy. I have a red tip doji down here at the bottom here, the candlestick and value charts confluence, and then I have much higher momentum reading. That type of situation, in my experience, really increases the credibility of a candlestick pattern. Here's one where you have a golden doji right here, and then you also have a lower reading or weakening reading in your momentum, a bearish divergence there as well. Now with this trade right here, you probably you'd be very close to being stopped out. And by the way, when you put stops in markets, people ask me about this, I always put my stop beyond the highest high. So if you're looking to put your stop beyond the highest point of a candlestick pattern, the candlestick pattern before you enter the market, make sure you add one tick to that. Don't just put your stop at the high, because I've seen many instances where a market will go right up to that same level and not break it, will take you out of the market, and then will reverse and go the direction that you thought originally. So don't get stopped out in trades that you're actually right about. Now right here's an example of a lot of these downside value candlestick patterns that are just continuing to generate, but you don't have the momentum confirmation here. So momentum just doesn't tell us anything that is confirming with like a bullish divergence or a strengthening momentum picture, and that's why I like to bring in momentum, because it really keeps a check and balance on the different candlestick patterns, especially when you're looking at bottoms that I want to see. So I'm not interested in buying in any of these buy trades or any of those buy formations. Here's another one too. This could be a longer term momentum swing. If you look at the cycles of the market, this could be something where you say, okay, I'm getting bullish here. The momentum indicator is slightly higher than the previous point here, and I have a higher low in prices, and then I have two bullish value candle patterns, yellow tip doji and a yellow jacket doji as well. Okay, just got it a few minutes ago. The value charts, value charts I'm using here. I tend to use I like to use 5, 10, or 14 for my look back period in value charts, or my analysis period. So that's what I like to use as those. And I would just encourage you to try them out. If you have more of a choppy market that has huge up and down swings, more of a volatile market, you want to use larger values in your value charts tool. So I would be looking to use 10, 14, possibly even 21 if the swings in the market were too extreme. Otherwise, if it's smooth sailing and you just have these smooth, short-lived corrections, then I would recommend using a setting of 5 for your value charts tools. But that really goes beyond the content of what we're talking about today. If you have questions on that, make sure you attend our membership sessions that we have weekly that allow you to ask questions about how you actually set value charts. Okay, so more of the same here. Just you see momentum dropping off here compared to this other peak, and then you see a yellow hat engulfing pattern right here, which is the top, and so forth. So I think Dave's going to tell me that I need to wrap things up here. This is another example here of just using the momentum here with a secondary top, the down arrow right here, yellow hat doji, and then that validates that doji pattern, and again it sells off. You can use again what we call a value target here. Once you enter below the green line here into moderately undervalued, that could be a target. We call that value range trading. Again, a topic for a different time. All right, I'm going to tell you about one thing that's happening right now in the markets that you need to be aware of. If you trade stocks in any way, shape, or form, we are now seeing a beautiful bearish pattern right now in the weeklies. Very, very bearish pattern. All right. I like this pattern for a number of reasons. This is what we call a yellow hat doji, and because it's on a weekly pattern as well, that makes it much more powerful. Now, why I like that is look what's happened with price. We're still below the resistance level. This is S&P 500 March futures contract of 1846.50. Look at what's happening to momentum. Momentum's died off substantially, and then probably the most telling momentum aspect is our momentum histogram is still red. It's still negative. So this right now is a very negative picture for the stock market. The reason why I like this is because if it breaks above the resistance right overhead at 1846, then guess what? We know we're wrong. We have to reassess. But this could be one of those patterns that could potentially lead to an extended sell-off in stocks, or at least a substantial correction to maybe retest recent lows here. So I like this pattern. I'm looking for sell signals. I'm drilling down to the dailies. I'm drilling down to the 60-minute, 30 minutes for more precise entry levels. But we're looking to be sellers this next week of the stock market. stock market futures and markets like that. Now, if any of you are interested in learning more about these strategic entry levels, what we focus on at ValueCharts.com is we look at high precision ways to enter the markets using value, momentum, and price patterns. So we simplified it. I've done 30 years of research in the markets, and I have found that if you have those three components of technical analysis, including value, including momentum, and price, which is just a traditional price chart, you have the tools to identify some of the most powerful and high precision entry points in the markets. Now, this is a very inexpensive video. It's pre-recorded. We've already had this. People seem to really benefit from this. I'm going to show you the 6 different market types. You need to know these because the approach to trading different market types are different. I'm going to show you low risk and ultra low risk setups that you can use to incorporate in your current trading plan, or you can adopt if you want to as a new trading plan. 4 proven exit strategies to hold on to your winners, not get out of your winners prematurely, and to manage risk as well. How to convert swing trades into rainmaker trend trades, and how to risk a little and potentially make a lot. That's the whole goal here. And you have to be able to in my experience, in order to do that, you've got to use drill down strategies with momentum, value, and price. Too much to cover in this presentation, but we went over some very powerful value candle strategies. Again, you can use stochastic oscillators, %R, RSI if you want, in lieu of value charts, but combining all these things together using like my weekly outlook on the stock market, I'm now looking for drill down sell signals using our other patterns and setups that we use. When I combine those, then oftentimes I can nail the market tops, nail the turning points, and really enter strategically in trades. Last but not least, let me just point out that this class, I'm going to show you the strategy that generated 37 winning buy signals in a row in the S&P 500. And this is a strategy that I created back a couple months ago, and I'm going to show you exactly how it works and the tools I use to generate 37 winning trades in a row, trading signals in a row with that strategy. So that's I think that's going to be worth the $47 in and of itself. But for $47, I don't know about you, that's cheaper than that's half the price of a tank of gas in a Toyota Sequoia. So if you're trading seriously at all, then I would invite you to join us. Go to ValueCharts.com/max here to register right here at the bottom. Let me change the color of my pen, and then I've got to let Dave take over here. Just a second here. So right here, if you're interested in looking at this video, you can have instant access to that video. ValueCharts.com/max, and it does use proprietary tools, so I'm just telling you up front. If I could find replacement tools, I would tell you about them, but some of the tools that I do show you are proprietary, and there is no replacement for them. They're the only ones I know of in the market that can do what they can. Okay, can you use this regular index options trades? Yeah, absolutely, Jan. You can use this on options, on index, on ETFs. All of this applies. Thanks for your presentation, Mark. Okay, affording expertise. You and Hubert are the best. Thank you, Kent. Yeah, Hubert's a great friend, and I always enjoy hearing his trading ideas as well to complement what I'm talking about. And let's see, do you have value charts Canadian stocks? We will. Well, that's our plan, William, is to have Canadian stocks incorporated in our platform, but we need to research the laws and regulations that affect all of that. Okay, is that swing trade you asked earlier a trading strategy? Yeah, Gregory, that's actually the swing trade or the value range trading that I referred to is something that I talk about in this Forex or this class right here, strategies to maximize profits and minimize risk. So for $47, I check it out. That is incorporated. It does work very well in Forex. I have a question about Forex. Thank you. Okay, what's target? Target for natural gas and bonds. That, KJ, that is a good question. I don't have time to cover that, unfortunately. I am bearish bonds longer term. I've been bullish all the commodities, including natural gas, but be careful. A lot of these commodities have had some big run-ups. They will have violent corrections, so be careful. Okay, it's overtime. Yes, it's overnight trading, Gregory, for the swing trade. Be careful in overnight trading. I'd be careful with overnight trading, but you can still do the same thing. Put the stop in the market, use the same type of strategy, but you can still use that. All right, now I'm excited to roll things back over here to let let's see, our next speaker, Jeff Gibby, come, and I know he's going to have a great topic to talk about, and I know that Dave Aquino is looking to get back on here. So Dave, I'm going to turn it over to you. Thanks everyone for spending the time today to let me present to you about the contact, about value charts and candlestick patterns. Good luck with what you're saying. If you have any questions.
Let's go ahead and make sure you guys can see my desktop. It should be broadcasting now, I think. This isn't the platform I'm intimately familiar with, but I'm pretty familiar with this platform. So let me know if I can you guys see my screen? All right, good. Just give you a quick introduction to this. Is a brand new class for me today. Wrote it from scratch actually over the last couple of days, and I think you guys are really going to enjoy it. I'm excited to actually do it. To give you an introduction to me, I've worked for Metastock for the better part of my adult life. This year I think I'll celebrate 18 years, but I need to do the math to be sure on that. Started in inside sales, which was a lot of fun. Now I'm in charge of our channel partnerships, which has been incredible. Has allowed me to meet some of the best people in the industry, like Price and Hubert, and people that are a lot smarter than me, and has been very, very enjoyable. I've traveled the world. I just got back from New York. The first trip I did internationally was to train some Saudi sheiks. It's been a lot of fun, so I very, very much enjoy it. It's also been something that I very much enjoy in terms of, getting. Well, I just very much enjoy it. Let's leave it at that. So, I do need to read a legal disclaimer. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of the software, trading strategies, or any information provided in connection with the company. In addition to that, I just want to stress that I'm not in the business of giving out financial advice, and I'm not really licensed to do so either. So we are going to talk a lot about Metastock today. Everything that I'm going to really talk about is how you can use the tools and how to kind of use our brand new tool, the Forecaster, and in what I think is a sensible workflow. So I'm going to talk a little bit. I think it's important. I'm going to talk a little bit about the MACD and how we calculate it and how you can look at it. And then I'm going to kind of use that as a workflow for an indicator to kind of go through and find trading opportunities for like Monday and how to test those to see really kind of what works well. And hopefully we'll be able to go through all of this material in time today. So let's go ahead and get started. There is a lot to talk about. About Metastock. So we were started in 1982. I came on board in, I think it was 97. It was 1997 because it was 2 years after Reuters bought us. We've had a lot of fun. We've basically released 2 different data feeds, Quote Center and Zenith. Zenith's very, very cool. I have people that sign up for Zenith. And we're not going to talk about it except for right here. But I've had people sign up for Metastock Zenith and then call me and tell me that they're saving $1,800 a month because they don't have to get Bloomberg anymore. It is a very, very cool news feed and offers a lot of fundamentals. And if that's something that you're interested in, you should go up to our video and or our website, take a look at some of the videos. It's a product that we white label that Thomson Reuters built, and they spent like $1 billion on it. So it's a very, very cool product. This year has been quite exciting for us in the Metastock office in Salt Lake City. Number one, we bought ourselves back from Thomson Reuters so that we could kind of accomplish some of the things that we wanted to accomplish, like developing out Metastock, and we've been ramping up programmers ever since. We also released a brand new tool that I'm going to show you today. It's called the Forecaster. And the Forecaster is something that you haven't seen out there. I've never seen anything like it. It's a brand new way of looking at data. So we'll get to that. But people are liking it, particularly like our option traders. We're pretty proud of ourselves. A couple of things that we're kind of proud of is the first one is we've actually been rated 23 years in a row the best software in our price category, and that includes this year. Our real-time software won this year too, and it's won about 10 years in a row. So the other thing that we're kind of proud of is every year we'll do a survey of our database to ask how our users are doing with Metastock. And I'd have to look at the exact number, but I believe it's north of 80% say they're more successful because they use our software package. So that's Metastock in a nutshell. Now let's get to the class. Today I'm going to really kind of dive into one specific methodology. I want to be really specific that the systems I'm talking about today is just one simple system. It's a MACD. And there's 40 or 50, but I think this is a good way to kind of go through kind of a sensible workflow so that you can understand maybe how to use Metastock to help you identify which trades you should be taking and that kind of stuff. So we're going to kind of focus on the MACD indicator. It was created by Gerald Appel in the late 70s. And it's actually a pretty simple indicator. I'm going to go into the calculation of it just because I find a lot of people trade the MACD, but they may not understand how it's calculated. I think that's important to understand what we're doing when we're trading. So in a nutshell, the MACD is a trend following indicator. And the calculation of it, and I'm sure you've heard like the trend is your friend, befriend the trend, all those kind of things. But the calculation is actually pretty simple. If you take a 0.075 or a 26 period exponential moving average and subtract it from a 12 period exponential moving average, you're basically going to get a histogram, like the histogram that we've got up here. Okay, and that's what we call our MACD line. Okay, so it's really just the value of a longer term moving average from a shorter term moving average, and it's a comparison of two moving averages. So when you start to get into a bit of an uptrend and the stock starts to move a little bit quicker, you'll notice that it starts to get a little bit more bullish. You'll see a divergence between the two indicators. The shorter term isn't moving, not a divergence, that might be the wrong term, but you just see a bit of a separation. They're not moving in different directions, they're just separating a little bit. As you get a little flatter, you'll notice that the MACD value declines a little bit as the moving averages get closer. And so what we're really doing is this is a tool that's very well equipped to measure a trend and kind of how strong we are in a trend and that kind of stuff. There's a couple ways, and then what they do to add to that is they actually put just a 9-period exponential moving average on it. Or they call that the signal line. Okay, there's a couple of ways that people that you can interpret this. You can look for overbought and oversold. You can look for, and Dr. Elder calls this the most powerful signal in technical analysis, but you can look for a divergence between MACD and price. Today, what we're going to kind of focus on is probably the simplest interpretation method, and that's to compare the MACD signal with its 9-period exponential moving average. So for example, right here we've got a bit of a cross up, if you can see where my cursor is on the screen. Right here you've got a little bit of a cross up, and you would say that the stock is beginning to get bullish, okay? And we label that, this is actually a chart that's taking out of Metastock. If it crosses down, as it did kind of prior to that, you're going to be in a bearish zone, okay? And obviously, like if we anticipate the stock's going to go up, what we would want to do is we would take a long position. Okay, so that's a calculation method. That's what we're going to kind of focus on today. So right here where we switch from a bearish to a bullish, the Metastock software will label a sell signal for us. When it crosses up above, you're going to get a buy signal and a sell signal and a buy signal and so forth and so forth. So in a nutshell, hopefully that's a good definition of MACD for you. Maybe you learned a little bit today if you didn't understand exactly what it was doing. But really, I just want to kind of lay the groundwork for what we're going to be talking about. And let me see what we've got question. Reuters news released earlier. Here's some questions. Is this only good for Metastock platform or will it work on TradeStation as well? I think actually that was a question for the previous guy. And I believe ValueCharts will work on TradeStation. I could be wrong on that. Is Reuters news released earlier on Metastock than it is to the general public? I hear you get news 2 minutes earlier. I'm not sure exactly about 2 minutes. I do know that they have certain embargoes in their time series, and we actually don't have an embargo. So the stuff that they distribute out to the new websites and stuff like that is embargoed, what they call an embargo. And depending on the sensitivity, it's delayed, and they have all kinds of rules that I really just don't understand. So, but yeah, it is real time in our platform. Dom says when I put a MACD, I'll show you how to add a MACD. I'm going to go into Metastock now, actually, and we're kind of going to get this demo underway. That's about the extent of PowerPoint that we'll use. I just wanted to kind of use it to kind of launch me into how to use the program and what we can do with the program and that kind of stuff. So let's start by opening up a chart, okay? In Metastock, and we're pretty much going to go through every single power tool today. We're going to talk about opening charts and scanning and system testing and forecasting. Forecasting people love. Let's just start with the chart, though. I'm going to open up Apple. And I'll just go ahead and type this. Since it's in Amex stock, I had to put .o because we get our data from Reuters, and that's just kind of the symbology that they use for over-the-counter stuff. Okay. Now what I'm going to do here is I'm going to actually leave this at a default. And what I'll do is I'll attach the expert advisor. What I'm going to do, now you'll see there's a lot of different built-in rules here. Since we're talking about MACD today, I'm just going to attach MACD. And this is one of the changes that we recently made, is the ability to actually attach an expert as you're opening up a chart. And it's quite helpful. So I'm going to go ahead and open up the chart. It's going to go ahead and grab my data for me. And because I attach that expert advisor, you've got the MACD buy signals and sell signals already showing up on the chart. Okay, now what I'm going to do is I'm actually going to show you how to put the MACD on the chart as well. So right here we've got what we call in Metastock our indicator quick list. And I really like the way they designed this because it makes it pretty easy to add stuff to your charts and stuff like that. Here we've got them all added. Okay, if you want to add a MACD, let me go ahead and just click on this. What I'm going to do is I'm going to hold down my mouse button. I'm going to drag it. And if I can drop it pretty much anywhere I want to. Since it's a MACD, I'm going to put it in its own inner window. So to do that, what I'm going to do is I'm going to go up to the top right here. Just drop it right there, and you'll notice Metastock will open a empty inner window for me. Now the signal moving average should be there by default. I've got it highlighted red here. I'll go ahead and click on OK, and now I've got the MACD on the chart. So if that's not showing up for you when you do the MACD indicator, I would actually recommend you contact me and I'll get you in touch with our support team and we can help you figure out why. I'm going to change that to an histogram, which I forgot to do at open, but that's not a big deal. I just double click on it. Metastock's pretty simple to change. And then I'm just going to change that to histogram, apply. And then that'll look exactly like what it looked like in the PowerPoint. Okay. Down here we do have the buy and sell arrows that are coming in. And I can come in here, and I like Metastock commentary. I can actually come in here. It'll kind of give me the current statistics on the MACD. It's going to tell me if there's any crossovers that happened, any buy-sell signals, that kind of stuff. So very, very simple to kind of read, pretty simple to manipulate. And this actually, we are just talking really kind of primarily about the crossovers, but this will look for overbought, oversold readings, as well as divergences for price, and alert you to those as they happen during the day. So the one problem I have with this Apple chart is right now I don't necessarily have a trade for today. And so if I'm, well, I should say a trade for Monday because really there's not too much trading today unless you're looking at Forex, which I don't. So are there a couple more questions? What is the purpose of the expert advisor? That's a great question, Haley. And if I miss questions, please retype them. There's a lot of questions. There's a lot of people here. I'll do my best to talk. The expert advisor actually, it'll do quite a few things. It's actually going to give you the buy and sell signals on the chart for the system that you're looking at. And this is the MACD. We have ones that are built around candlesticks or Bollinger Bands or stochastics. It's also going to provide the trend ribbon. So right here you can see your bullish or bearish or bullish or bearish. It'll also kind of give you, well, of course, the commentary. If you've got it set up, it'll also alert you. And by an alert, it can pop up an alert on screen. If you kind of have a chart open with an expert attached and you want it to, it can actually send you an email. So it's really kind of, the expert advisor is going to be more of kind of alerting you to what's going on in the chart. Hopefully that answered your question. Absolutely. Just a question to zoom into the chart. Let's go ahead and do that. With Metastock, let's go ahead and do, what we'll do is we'll actually just kind of click on this little zoom button and that'll zoom us in incrementally. There's a couple different ways to do that. And you'll notice just to show you how exactly how they tie in, if I put a horizontal line where this buy signal happens, you'll notice it's on the same bar as that crossover. So it should be exactly perfect in terms of giving you the alerts on the signals and that kind of stuff. They will match up. Okay, so as I was saying, the only problem I have with this chart is if I want to trade right now, this MACD buy signal was probably like the 10th. Right now it's the 22nd. And if I really wanted to trade today, I'd probably want to have something that had a fresh buy signal. And that kind of leads us into another very cool tool of MetaStock. What I'm going to do here is I'm going to go back to our Power Console. And like I said, we're going to go through these one at a time. But what I can do here is I'm going to actually do an exploration for a MACD buy signal. So I'm going to go ahead and basically select this as an exploration. Again, there's tons and tons of scans in here that you can run. I'm just kind of going with MACD today. I'm going to go ahead and click on Next. And then I'm going to actually kind of select a group of stocks that I want to scan against. Earlier, I scanned against the optionable stocks. So I said, okay, out of all of the 4,000 optionable stocks, which ones have a buy signal? And it took about 5 minutes to complete. Because I don't want to try and entertain you for 5 minutes, I'm going to actually do the S&P 100 this time. And so I'm going to select this right here. I'll go ahead and click on Next. And we're just going to start the exploration. Now what this is going to do is it's basically going to go through the S&P 100, and it's going to identify stocks that actually have a buy signal today, which is a very, very cool feature. And it's a great prospecting tool. So right here, and I think you'd all agree that was faster than looking at 100 different charts. So I'm going to click on the reports. I'll just show you what this looks like. This is just going to give you a grid. In the case of the S&P or the S&P 100, we only had one stock that came up. Okay, I'm going to save that to the list I saved earlier, which is our MACD buy signal, which had about 97 stocks that showed up on there. So I'm just going to create a list of the ones that have a buy signal right now. I'll click on OK, and that adds that to the list. Now, there's a couple of different ways I could look at this list. If I wanted to, I could go look at the charts and kind of evaluate them and see which of the 98 different stocks kind of had the best parameters. And that's a very valid way to do it. It's certainly easier to look at 98 charts than it is to 4,000 charts. The way I like to kind of take it from here is, since I'm looking for a MACD buy signal, what I'm going to do is I'm going to go in and say, okay, if I took all the buy signals off of this chart, and let's say I took the sell signals as well, and let's just say that every time the software told me to buy, I bought, and every time the software told me to sell, I'm going to sell, how would that work for me? Okay, and we call that system testing, and that is something that you really can't do in TOS. It's not available in a lot of platforms, but what I want to do is, I know I have buy signals on these 97 different securities. So wouldn't it make sense for me to look at the ones that work best with this particular buy signal? In other words, what I want to do now is I want to take the system tester and say, okay, out of the 97 buy opportunities that I have, show me which ones, if I took every buy signal and every sell signal over the last 1 year, 2 years, or 5 years, or 10 years, show me the ones that work best for this particular instrument. And I do the system test with that. So I'm going to come in here, and I just click on System Test. I'll show you how to set this up. This runs very quickly in MetaStock. What I'm going to do is I'm going to test this expert system against my list. Okay, and I see there's a lot of platforms that offer system testing, but not a lot of them do multiple securities and multiple stocks. In this case, what I want to do is I want to take my list and find the very best MACD candidates. So I'm going to go ahead and click on Next. Okay, I'm going to do about 440 days. I'm working with daily charts today. You could do intraday if you want. Everything that we're talking about you can apply on a different time frame. In this case, I'm going to work primarily with daily bars. Okay, on my trade options, I'm going to start with $10,000. Every time I get a signal to go long, I'm going to take 85% of the available equity. So my first trade would be 8,500. If I build that up to double my account, it would be twice that. I'm basically what I'm going to do is every time I get a buy signal, I'm going to buy. Every time I get a sell signal, I'm going to sell. Since it costs us money to trade, I'm going to basically calculate $5 in to get in, $5 to get out. So I'm going to go ahead and click OK here. And I'm just going to go ahead and start this. Okay, and you'll see this is actually going to run very, very quickly. Well, it should run really quickly anyway. It's going to go through those 97 buy signals today and tell us which ones have performed the best historically. I'm actually doing pretty good on time. I usually kind of get off on a tangent. Let's see if there's any questions before we look at the reports for this. Okay, Tibor asks, how does one select a range of stocks? Why do we now have MS 2012 to check? Oh, you don't have to, actually, Tibor. Tibor asks, I think for the scanning, but it's the same in all of them. How do I select more than one instrument? It seems like, Tibor, I know you. Actually, I think we've exchanged emails. But if you want to, you notice the box there that says select all? That'll select all of the instruments in a given list. Okay, you can go in and check mark the ones that you want and that kind of stuff, but I would just click on the select all. When I ran my scan, I actually ran it through all 4,000 stocks that way. I hope that helps you, because checking them one at a time is probably a pain. So hopefully that'll save you a little bit of time. There's just that select all button at the top that'll grab the whole list for you. Yes, these are default MACD settings, Samuel. This is included, Comfy, this is the systems that everything I'm talking about today is included in the basic system for Metastock. They're not part of add-ons and stuff like that. I bet it's a great pain, Tabor. When you get a buy signal, does the system, this is a great question, Dave. I'm going to read it out loud. When you get a buy signal, does the system tester calculate the entry from the close of the current bar or the open of the next? That's a really good question. Let me show you the answer, because you can change it if you want. Let me go back to the system tester. Okay, and on this options page, under trade options, where it says trade execution, I've got that selected as realistic market prices. Okay, and what that means is that's going to wait until the end of the current bar. It's going to wait for the bar to close, and in this case, make sure that sell signal still exists or that buy signal still exists, and enter on the open of the next bar. So if you're looking at daily bars, obviously that's the open of the next day. Now, if you want to change that, you just uncheck mark this box right here, and you say, I want to delay or I don't want to delay, and you say open at whatever level you want, whether that's the open, the high, the lower, the close. So you do have control over that. I just left it as realistic market prices. And you'll notice, since we're back in here, you can calculate in your system tests, slippage, and all kinds of stuff. So by default, it's going to be what we call realistic market prices, and that just means it's buying on the open of the subsequent following bar. Hope that answered your question. Let's look at the reports. Okay, so let's go ahead and go back. Now that that's already done, I just have to go back and I can actually look at the report without rerunning it. So right here, you'll see this little R. It means the report's done. I'll go ahead and click on the report. I'm going to do the one that I completed just now, although it's the same one I ran earlier. Click on View, and now this is going to organize. I'm just going to pull this out to full screen for you. It's going to organize them based on the number that it ran them by. Now, I'm going to sort them by net profit. Okay, so obviously the idea here is let's go ahead and find ones that actually work really, really well. Okay, I already know all of these have a buy signal because I ran a scan on them. I want to find something that works well here. So I don't necessarily want to take a buy signal on a stock that doesn't work. So I'm going to ignore those, focus kind of more on these ones right here. Okay, and we can see here just on this first page report that our best performing system made about 238% profit. In that 2-year span, I think is about what I did, 522, 2012, almost 2 years. It took about 99 trades, which is pretty frequent. And out of those, it had a 49.50 win-loss ratio. And we can kind of compare it. The next best performing system was this Valheat Incorporated, and it had about 67 trades, and that's kind of pulling it back a little bit. 38 of those were winners and 29 of them were losers. Okay, there's New Link Genetics here and you kind of get the idea. And once I kind of pick this report that I want to see, let's just say I wanted to kind of go look at this a bit closer, I'll click on View right here. It's going to give me profit. It's going to give me our performance versus buy and hold, which actually this one underperformed buy and hold in this particular scenario. It's going to give us our profit loss index and our risk reward ratio as well. And there's a lot of numbers that it gives you, and I certainly am not going to go through all of these because we've got a lot of ground to cover. But if you have questions on it, Metastock's pretty helpful with its help. Just realized that kind of sounded a little funny. But it's very helpful with its help. And so if you have questions about what certain calculations are and how they're calculated and what they mean, click on this help file, and it's actually going to go through everything and kind of tell you exactly what's good, what's bad, what's indifferent. Okay. It'll also give you position excursions, trading efficiency. There's all kinds of stuff here. I like to pay attention to like our wins versus our losers. I like to look at my average profit, which in this case was $622. I like to compare that to my average loss, $406, to kind of get a feel for if I'm going to be comfortable with this system. Okay. I also like to look at maximum consecutive losses because if you're going to start trading this, you're going to have to be prepared to take 5 losers in a row. Is that something that you're comfortable with? Okay. And that's not a yes, that's not a true false question, that's a personal question. If it's not something that you're comfortable with, maybe you should look for something that has a little bit of a better batting average or something along those lines. Okay. Over here on these tabs, we have orders, we've got positions, and we've got equity. And this will kind of give you an idea of how it performs overall. This is a great visual indicator because I always say is if you're trading your own money, this line is going to be very, very valuable to you. And so this will give you an idea how that performance worked over time. With this particular example, I don't see any huge drawdowns. It was pretty steady. We had a bit of a non-making money period here. But overall, I'd say this is okay. I'd look for a better one. But, you know, you have all kinds of time when you do the free trial to actually look at different systems and equity curves and that kind of stuff. Let's answer a few questions. Is the buy-sell based only on MACDs? In this case, it is, Regelio. In this case, we're doing buy-sell signals based on the MACDs, but that's only because that's the system I selected. There's probably around, don't quote me on this. When I say around, I mean I don't have an exact number, but there's probably around 40 to 50 systems that are built into Metastock. The one that I tested was based on the MACD buys and the MACD sells. Although, if we wanted to, I run a whole hour-long class sometimes about system testing and looking at stocks. If we wanted to, we could take literally all of the systems that are Metastocks and test them against all of the stocks that exist and really kind of come up with some pretty highly correlated examples. So I want to show you the system tester though because we've been working on that like crazy and it's really, really cool and it's something that you've never seen before. So this is just kind of giving you an idea of how the system test works. How well does the current win-loss ratio predict the next win for each individual stocks? Have you back tested that? You know, I haven't actually. I do know that I've been trading with pretty much the same methodology for years now, and it's called RMO, but that's another class as well. And that works pretty well, although you'll take 7 or 8 losers in a row on it. Do the testing results repeat going forward? You can actually, with Metastock, you can. I'm going to try and answer this question to the best of my ability for you. You can actually test a period of, let's say, 7 or 8 months back in time when you set up the test and say, how did it work from, let's say, let's just say 2011 to 2013, or whatever range you want. The data for daily data through Reuters goes back to 1980. So you can go in and say, okay, how did this work? And then you can actually kind of go in and test it again if you want. So there's different ways to do that. What we're going to get into is kind of statistically looking at price activity to determine what a price is likely to do. And I'm going to get into that in just a few minutes. It's very unique to Metastock. We're putting a patent on it. Hopefully we get it. Fingers crossed. But I've never seen anything quite like it in the market. I think you guys are going to enjoy it. Good question, Ray. You can absolutely build your own systems. You can build your own tests. You can build your own indicators. You can build your own explorations. The only thing you can't build your own of yet is forecast events, but that'll be added this year. The forecaster is brand new, and so we haven't plugged our language into it just yet. So, but the things that I hear about Metastock in terms of the language are, well, for me, just based on personal experience, I know Price came in earlier, and I helped him create his systems for Metastock like 5 or 6 years ago. Now, I'm a sales guy. I am a little bit more of a technically minded sales guy, but I'm definitely not a programmer, and the syntax that we use is very, very easy. In fact, I'd recommend you try it. And the other thing is if you don't want to write it, you just want somebody else to write it for you, for $35, we have a formula writer that'll actually write any type of a system for you. So, and that's pretty cheap for a programmer. Danny, I believe this is going to be recorded. Okay. And there's a couple of questions more about forward testing and things like that. True forward testing isn't available in Metastock, but that is something that I think is slated for later this year. So the nice thing is, like, now that we've bought ourselves back from Thomson Reuters, is we have more programmers than we've ever had, and they're really, really smart, as you're about to see. And so let's kind of come back in here. I've actually already pulled, I think, this stock up, the MACD buy signal, to kind of give you an idea of the forecaster and how that works. So, and it's pretty cool. People like this thing quite a bit. So far we've talked about charts, the expert advisor, getting real-time alerts, scanning, system testing. We've had those tools for a number of years, and they're very, very cool to use. We're very happy that last year we actually released a brand new power tool. And this power tool actually kind of is what we've got a patent on. We call it the forecaster. And I've already loaded it up. I'm actually doing pretty good on time here. I thought I was all worried because I have so much ground to cover. I've already loaded it up with the MACD buy and sell signals to kind of give you an idea. So I've system tested a few of these different things. And before we kind of get into the cloud, let me kind of just talk about what this does. First of all, I've only selected the MACD cross up and cross down. There's around, I think, 52 events. And again, that's the word around, give or take 10, either way. But these are different events like 52-week highs, a MACD buy signal, Bollinger breakout, that kind of stuff. And the purpose of this tool is to actually perform a lot of statistical analysis on a security and say, every time this event happens, is there a statistically likelihood that there's going to be a change in price? And we call it a forecast. So I'm going to go back here into the forecast cloud. This, I believe, was a stock we were just looking at in the system test. Okay, and what we've got here, before we get over here, I'm going to hide this a little bit. Pay no attention to the man behind the mirror, or the man behind the curtain. I want to kind of give you an idea of kind of some of the calculations that we use. I do want to make it evident, or really, really apparent, that we are not just using these statistics to generate our clouds. We're actually using some kind of proprietary mathematics to kind of do event smoothing so that we can kind of get a better accurate prediction of what's going to happen. But okay, so this is a MACD cross-up event, okay, and we know that there's going to be a current one because I scanned, and that's how I found this stock. But in this particular case, this event occurs 8 times within the last 833 days. On average, it happens every 93 days. Statistically, it'll be about 7.3% higher with a standard deviation. I don't read all of these statistics, but it kind of gives you an idea of kind of like what kind of details it's looking at. Okay. Also, if I click over here on the event dates, it's going to actually give us the dates that this actually happened on the chart. I'm going to go ahead and move the chart back down so that we can see it. Oh, and of course, I crash right in the middle of my demo. Let me write down this symbol real quick because I'll just kind of pull it back up real quick. NLNK.O. I only crash during demos. So let me go ahead and click on continue here. Is it going to let me continue? It is. Okay. Good. I feel lucky at this point. In this particular case, I've got two. Every time a MACD happens, this is kind of the predicted price behavior. Now I want you to pay attention. Right now I've got the MAC focus at 90 days. And I can do like a 30 days or 180 days. I'm going to push that out to 180 days. Okay. Over here, this map intensity is important. Right here, so you see where it's darkly shaded blue on the kind of the outside of what we call our forecast cloud. That's only like a 30 to 40% probability that it's going to land in that particular area. Whereas when it gets bright red, we actually say it's going to be between 60 to 70% likely. And when it gets yellow, which doesn't happen very often, but is powerful when it does, it's actually a 95% plus probability that it'll land in that particular zone. Okay, so this is kind of our anticipated price movement after an event happens. We have a bullish tendency, and it looks like right around at 90 days, it actually forecasts a pretty likelihood of a rise of 40%, which is actually pretty impressive. Let's go ahead and click back to the chart, and I'll explain that to you. Maybe that's where I'm going to kind of have problems, is going back to the chart. So let me actually see if I can get rid of that forecast cloud. Here we've got kind of the price activity when these events have happened on the chart. Okay, so statistically what we do is from these what we call events, which in this case is MACD buy signals, we start to measure the likelihood of price change. Okay, and if I click on the cloud, it's going to attach that same cloud to the thing. And our option traders absolutely love this because it gives them an idea of what options they should be looking to do and maybe what levels they should be putting them at and all that kind of stuff. Okay, I can also take this option forecast, or I'm sorry, this forecast cloud, I can put it on previous events to see. Obviously in this case it didn't work very well because we had an abnormal price movement, but we can kind of see how well it was predicting previous events. And a lot of times you'll see it just really hang out and hover in these high probability zones. Now it doesn't work every time, but it does give us a 60% probability to be right there. And it was right there. So that's kind of what we call a forecast cloud and the forecaster. And it's, like I said, it's a very unique tool inside of Metastock. We had one of our options guys, Don Fishback, if you're familiar with him. He called us just to tell us that he loves this thing, and that we didn't know how powerful it was. We're like, well, we designed it. We designed it to be powerful, but it's been very, very, very well received in the marketplace. People are enjoying this, and so it is version 1. We just barely started putting this out. Back in November is when we released this. We are adding quite a few things to it, including the ability to make your own event marker data. So you'll be able to code for it as well. Couple more questions. Let's see. Is this, okay, I already answered, is this being recorded? That's it. Dom asks, I have the RAG-E system. Why can I not do a scan with it? I don't know. I'll talk to Osmond, my coworker, and my teammate here, and see if that's something that we could help put together for it. I'm a very old Metastock user. Thank you, Rodney. We appreciate you using Metastock. I have 6.5. Is there an upgrade offer? Absolutely. 6.5 is actually the first version that was year 2000 compliant. So you do have a very old version, but that's okay. You can upgrade to the new version of Metastock, and I believe the cost is about $220 on that one time. So yeah, you can absolutely. Keith asks, are you going to ever improve your option tools? And the answer to that is actually yes. We're actually looking at some different technologies and different things. If you have some ideas on like what you would want to see, send them in to me. Absolutely. What we're actually kind of been doing right now is kind of trying to kind of give you some brand new tools. So, but things are moving pretty fast here. It kind of again has the feeling of a much smaller company than it was last year at this time. So, yeah, absolutely. I think it's probably going to be past 14 though, to be frank about it. Good question, William Worthington. I hope you're okay with me using your last name in here. Metastock will work with stocks, futures, forex, whatever you want. We cover about 182 global exchanges. So when we did kind of negotiate our purchase back from Reuters, we made sure to keep the data because they're very, very, very good at data. So anyway, okay. I think that's about what I was going to show you. I'm just kind of going to wrap up a little bit. We'll have some more time for Q&A at the very end here. Appreciate you guys coming in. When I kind of do a new presentation, maybe that was a little fast, maybe it was a little bit slow, but I'm always nervous about time. Sometimes I go really long, sometimes I go really short. So what I really wanted to do is kind of find what I thought was a good workflow for everything. So kind of get an idea of all the things that are included and all the tools that are available. Again, the Metastock platform has been rated #1 in its price category for 23 years in a row. A lot of our traders say that they're more successful in their trading because they use this. I believe that was 84%. But again, I believe it's a thing there. Give it plus or minus 10%, and you'll have the number. Some of the things is like really my goal today was to kind of give you an idea of kind of the power of Metastock. Certainly, it's a huge tool, and I've trained Saudi sheiks for 2 weeks on how to use it. So really, there's no way. There's so many of these things I can break down into like an hour class and talk about. Really, my goal here was to either get you interested in what we call a free trial or what we call an extended trial. And both are pretty good options. I'm going to actually give you both of them. And you can decide for yourself which ones are going to be the best for you. So Metastock, there's basically 2 versions. Let's get past all these. There's our end of day version, which is like normally like $59 a month. And we still call it Metastock end of day, but with 13 we actually added intraday hourly update bars. So every hour you can actually see what the market did that day, or the stocks that you're interested in did that day, or are doing that day during the day. So it is actually really cool. You can also scan on that snapshot data, so you can just scan intraday, and it's actually a very, very cool addition to the end of day software. And that's only $59 a month. Basically, that's for a whole region, so that would include stocks, North America, South America, or if you're interested in Europe, Middle East, and Africa, that's another region, or Asia Pacific. I should be able to remember all these regions. Okay. Also includes FX data, and so it's $59 a month is what you'd pay for it, and you can either do that on a free trial, or you can do that on what we call an extended trial. Now, the extended trial is what I say to you is if you buy 1 month, then I'll give you 2 extra months. And the reason I like to do that is because that gives you a really long time to play with the tool, right? March, April, May. If you signed up for today, you'd literally be running the software until May 22nd. And by then, you should be able to figure out, is this thing worth $59 a month or $250 a month? Is it returning that investment to me? And at that point, it should be a very, very easy decision. And at the end of the day, like, you basically, for that try, you're paying $20 a month. So very, very good offer. People really like it because it gives them plenty of time. Also, a couple of questions that I always get is, does it lock me into a contract period? No, you can cancel at any time. Also, Metastock, the real-time subscription obviously includes the real-time data. There are some exchange fees that are applicable with that. You might pay, like for example, New York charges $1, NASDAQ charges $1. New York Amex, I don't even know what to call that anymore because they got bought by New York Stock Exchange, costs $1. Those you'll pay every month, but the base fee for the platform you won't pay until May again. Okay. It also includes Metastock Zenith, which includes the real-time news. People love that product. And I actually, the first guy I sold was up in Canada. Right after we launched, went and did the Traders Expo up in Canada. And one of the first people, I'm not sure it was the first person that bought, but he came up and he called me a few months later and said, thanks for selling this to me. I'm saving $1,800 a month because I'm not playing for Bloomberg anymore. So it's very, very cool. I'm also going to, because it is a powerful tool, my goal today was to convince you that it's a powerful tool that has unique features like system testing and forecasting and full market scanning that are helpful for you. But the better you understand how to use the tool, the better it's going to work for you. So we will, if you do that extended trial, we'll send out this DVD for you. If you just do the free trial, we'll give you the digital version. Okay, so either way, we're going to do the training. And you'll also be qualified for a free month of training from learnmetastock.com. And they basically do a class every Tuesday, Wednesday, Thursday. That's every week. So that's basically, let's see, 3 times 12. Let's see, is my math good today? That's 12 hours of instruction plus 60 hours of recorded content. And he does a really good job. It's a different company. Started by our old sales manager here, but he does a really good job of showing you how to use Metastock and Zenith. And he even gets like special guest speakers in to talk about methodologies. And I'm throwing that in for free with either your trial or your extended trial. So the special offer today is a free trial or an extended trial. Our sales guys are kind of out because it's Saturday, but you can, if you have any questions, you can call them at 1-800-252-9901 and just mention the ValueCharts webinar today. The website for the extended trial is metastock.com/valuecharts 341. If you want to do the trial, just take off the 341. If you have questions, you can email me. I'm going to kind of go through these questions real quick, or actually I can take as long as we need to. But I'll go through your questions and see kind of, I'll do my best to kind of wrap this thing up. So, okay, let's see. Johnny Pham says, I think I know Johnny too. I'm pretty sure I know who you are, Johnny. How fast are the server's execution of orders? That's a really good question, William. We don't do trading in Metastock. We are implementing trade execution, but I think it'll be like later this year or Q1 of next year. So we will be implementing trade execution, but Metastock will not trade for you. You would use your own broker. So it depends on how fast that is in the meantime. Johnny says, great feature with Metastock now. The past let you help know the future or maybe help predict it. Dennis, thank you for coming. William asked a question, is 1 hour the lowest time frame you can go? Absolutely not. You can go down to a tick interval if you want. You can go to 1 minute. You could do a 2 or 3 minute or any kind of time frame there that you want, up to an hour or a day or a week or quarter. So you can do whatever time frame you want, William. Eve asks a really good question. Is the software Mac compatible? No. Well, it is. We actually, let me kind of phrase this the best way I can. We have a lot of users that use Metastock on a Mac, but it requires that you install either Parallels or a program called Boot Camp, and it requires that you buy a copy of Windows, XP or Windows 7 or Windows 8, whatever you want. But we've had users that successfully use it. So it's not Mac native, but you can run it on a Mac as long as you're willing to buy Windows 2. The other thing that sometimes people will do, and it does run, I've seen it run on a Mac like that, it runs pretty well on the Mac hardware with those requirements. Some people will just say, well, you know, if with the cost of the Windows operating system, I could get a Windows machine for $300 at Walmart or something like that. And that may be something to consider as well. Dom says, I am one of these guys who changed to Metastock from Bloomberg, and I am very happy. I save like $20,000 a year. Dom, here to serve. Is the subscription fee tax deductible? I am not going to give out tax advice. I know in certain cases it can if you're trading as a business, and particularly if you have a thing. I would do what I always say, and just consult a tax professional. I wouldn't want to get you in trouble with the IRS because of anything I say. Tybor is going to send me a question. Cool. Any way to add virtual trading to Metastock? Not yet, but we're probably going to add it for you. Things are moving really fast now that we are in charge of ourselves again. If I have 3 favorite indicators, Brad asks, how can I save them to a template? That's easy. Let me show you that real quick. Okay. If, going back into Metastock real quick, if I always wanted to look at this expert advisor and this indicator and the volume and all that kind of stuff, just right click here. And you can actually save this as your default template right here, which means every time you open up a chart, it's going to apply that as a template. The other thing that you can do is just click on File, and then Save As, and then just change it to a template here. You'll notice I have a lot of different templates that are available, so just make a name for it, and you've got that as a template. To apply a template, if it's not your default one, you can just right-click here and go Apply Template, and it'll bring up your list of templates, and you can just say, well, let's do this. Let's do this a BBTK one. Boom. Okay. I use crossover. Okay. Oh, William has, I'm not sure what he's saying, but he says he uses crossover and it's easier on the Mac resources. So that might be something to look at. Scott asks, is this recorded? I'm pretty sure it is. Rodney asks, can you use other data sources in Metastock? No, actually no. And it's one of the things that we've actually done. I don't have an indicator that's applied to this template. This only happens if you're a power user of Metastock. I'll just go ahead and remove that from the chart there. William's saying crossover is cheaper and it works really, really well. So look into that. I've not heard of that before. Also, you might want to, if you decide to go down that route on a Mac with Metastock, you might want to call our support team and see if they've had experience with it as well. Don Page says, for tax deductible, it depends on which province or state you live. Again, check a tax expert. Keith says, good. I hope he's talking about my Temo today. Bill asks, why can't we use more than one expert advisor at a time? I actually think that's on the docket for 14, but it's not there here. Can version 12 load TC2000 end-of-day data in the same way as version 10 or 11? Richard, 12 can't, 13 can. So they added ability to do local data. And let me clarify that. It's not exactly the same, but it's not terribly hard either. William says, if I sign up for the $59 extended trial for 3 months, will I have access to intraday charts as like 1 hour time frames of 5 minutes? Actually, glad you asked that question to clarify. While we did add like intraday daily bars, like the what we call hourly snapshot data, it's still just daily or higher. So that would just have your ability to look at the current day. So for example, if we're in the middle of the trading day and you're in the $59 subscription, you'd be able to see what Apple had done on a daily bar, but you wouldn't have like the intraday increments like hourly, 30 minutes, 10 minutes, and stuff like that. Samuel says VMware Fusion is also a good program to run on Windows app and with a Mac. Thank you for that feedback. Okay, so again, it's a really cool offer. I would recommend Metastock. I love it. I wouldn't trade without it. But again, here's how you get it signed up for that. Metastock.com/ValueCharts 3-for-1. Or if you want to do just the free trial, by all means, just take off the 3-for-1. If you have any questions, drop me a message. I just dug out from being out for a week from New York Traders Expo, so my inbox is kind of empty right now, so it shouldn't take me too long to get back to you. And I'm going to call it for today. I really appreciate ValueCharts for having me. Appreciate you guys for coming in on your Saturday and kind of listening. I hope at very least you learned a little bit about the MACD. But sometimes I feel like the option professor at the end of these things. Try the software. It is a fantastic piece of software. And we had another of the experts we work with in the office the other day. Actually, I'm going to tell a different story. Just got back from the Traders Expo this last week. was talking to one of our customers who was over at the booth, and he said he made 100. I think he said he made 105% last year using the RMO, which is another system. If you want to email me, I'll send you a good training on that. That's inside of Metastock, but it's a great tool. So try it out for 3 months. If it helps you make money, keep paying for it. And with that, I'm going to wrap up for today. If you guys have more questions, just drop me an email. And thanks for coming. Appreciate it.
Jeffrey, thank you very much for that great presentation. I remember back in the day when I started trading, Metastock was the platform that I started out with, and excellent opportunity there for anyone that would be interested in Metastock. So great, thank you, Jeffrey. Again, I just want to give a final thanks to everybody for attending today. I know it is a Saturday. Everybody's always busy with their lives, family, and everything. So I'm going to keep everything short here. Just wanted to say thank you. The recording is being made. I will be processing it. You should be able to get a copy and view the video on ValueCharts.com in the blog section. And hopefully should have that up sometime tomorrow. And then that way you'll be able to access it. If you have any additional questions, feel free to go ahead and contact us at support@valuecharts.com, and we'll be able to assist you. Again, thank you for taking the time to listen to our presentations today, and everybody have a safe and great weekend. Take care.